Over the next 7 hours, I'm going to hand you everything that you need to know to become a profitable day trader this year, even if you've never opened a chart in your entire life. And this information is coming from my 9 years of experience doing this professionally at this point. I'm going to walk you through what day trading is, how to read charts, mastering candlesticks, choosing the right platforms, and I'm going to give you guys the exact strategies that I personally use every single day to make 6 figures a month with trading. I'm gonna break down my short but effective daily trading routine, how to scale your account the right way without blowing it, what to actually do when you hit a losing streak. I'm going to show you how to use other people's money to trade with so you don't have to risk a single dollar of your own. I'm gonna be completely honest, people charge thousands of dollars for less than what I'm about to give you guys in this video. And I'm giving it to you for the freebies. I'm giving it to you for $0. I'm giving it to you for nada. So take this seriously. Anyways, who am I? My name is Joovier, and like I said, I've been day trading for over 9 years now. In that time, trading has completely changed my life. I was able to buy my first home for over $1 million. I bought my wife her dream car. I bought myself my dream car. And most importantly, I gained financial freedom, time freedom, and location freedom. I can literally live wherever I want to. I can buy whatever I want to. I can take care of my entire family and my friends. I'm married, I have 2 kids. I'm able to provide for them and give them a lifestyle that I never even knew was possible. Now, over the last 9 years, I've consistently been able to make 7 figures a year with trading. And in the process, I've helped over 24,000 people learn how to change their lives with trading too. And that's why I'm not holding back anything in this video, because I want you to have the skill that can set your entire family free the same way it's done for me. Now, I'll be honest, I almost didn't make it to where I am now. The first trading video I ever watched was some old guy on YouTube, and every single thing he said, it sounded like straight Chinese, Japanese, every single other needs that I don't understand. He overcomplicated it so much that I actually quit for a period. I tried drop shipping, I tried Amazon FBA, I tried affiliate marketing, I tried so much foolishness, and I wasted so many years, and I lost so much money chasing all these other kind of make money online things. And it's really because I was convinced that trading was too hard for someone like me. I thought it was only for a specific kind of people, or only rich people, or only this demographic of people. And the worst part is that almost a decade later, people are still teaching it the same exact way that almost made me quit years ago. They're overcomplicating it. They're making it full of a bunch of jargon. It's designed to make you feel stupid, so you go and buy their course or something like that. I don't know why they do that foolishness, but that's not what this is. I teach it so simple that a 10-year-old can follow it. I know that because I've actually been able to teach a 10-year-old how to trade. So if you're over the age of 10, you stand a pretty good chance. Now, I have to be real with you guys. Trading is not a get rich quick thing, and don't believe a single person that ever tells you that. It took me personally over 3 years to get to where I am now. But if I had a video like this when I first started off, it would have saved me tons of losses, tons of sadness, tons of trial and error, and tons of money. Realistically, most people know that day trading can be hard, but the hardest part is doing it alone. And trust me, from all the people that I've helped at this point, the ones who do the best are the ones who have at least one person on the journey with them. So before we get into this, I highly suggest that you guys share this video with a friend or a family member or a group so you can support each other on this path. And I'm not just saying that to get more views. I promise you guys, if I could teleport back in time and have somebody else to learn trading with, I 100% would. It would have been a lot more entertaining. It would have been a lot more easy for me to stick to trading if I had somebody else doing it with me. So share it with whoever that person is that you're thinking of, or whoever that group of people is that you're thinking of. But with that being said, grab some paper, a pen, something to drink, and maybe even your favorite snack, because over the next few hours, not only will you and I become very good friends, but we'll be diving deep into a topic that can change your life forever. Let's jump into it. Now, first of all, what the heck even is day trading? Now, I feel like so many people make it way more complicated than it actually is. It's simply you buying a stock or you buying a crypto and you selling it within the same day. This is completely different from what you probably grew up hearing about, which is like the typical investing where your parents or your grandparents or whoever told you to buy a stock and then hold it for freaking 30, 40 years, hoping that you get rich. This is not that. Day trading allows us to enter and buy whatever it is and sell it multiple times in one day to be able to make a lot of money based off of small fluctuations. So instead of us waiting for, let's say, the stock of Tesla to go from $100 to $300,000 and make us a whole bunch of money, we can make money if Tesla is at $100 and then it goes to $101. Like, we can make a lot of money versus with regular investing, you'd only make $1, right? There's other benefits to it as well, being that if you have a stock and the price of the stock goes down, you lose money. You cannot make money if the stock price goes down. But with day trading, we can. We can make money no matter if the stock goes up or the stock goes down. And it doesn't take too much time at all. In this video, we'll kind of dive into how much time and how I trade, so I'm not stuck here at my computer for freaking 300 hours a day, and I can just do what I need to do. I can make my money with trading, and I can just go enjoy the fruits of my labor. But that's essentially what day trading is in the simple form. Now, before we get into like the strategies and the platforms and all that cool fun stuff, I feel like I need to bust some myths first, because you guys probably have all these assumptions about day trading that you've heard either online or from your parents or all this stuff, and I just want to set these things straight. This is coming from someone who has been trading for over 9 years at this point. All right, so the first myth that I usually hear all the time is that day trading isn't a real career. You're probably gonna hear this from boomers and freaking old people or people that have never even tried day trading. But the truth is that day trading is honestly one of the oldest professions that there is. It's one of the oldest careers that there are. Banks, hedge funds, Wall Street, prop firms, private equity companies, they all have teams that are literally made to trade. Like, they literally put millions, if not billions of dollars into day trading. You go to the bank, you deposit money into the bank. What do you think they do with your money? They don't just sit there and hold the money inside your bank. No, they go and trade using your money and leveraging your money so that they can make even more money. So yes, day trading is a real career. Now, the next myth that I hear a lot is that day trading is just like gambling. Gambling, like going to the casino, playing blackjack. I gamble, right? I don't gamble. I have gambled. I'm not like addicted to gambling or something, but I've gambled before. I've played blackjack. I've played roulette. I've lost money each and every time. Day trading is not like gambling for a few reasons. Gambling essentially is just random luck. Trading, you have the opportunity to use a defined edge from a tested strategy, and you have the opportunity to use risk management. All these things probably sound crazy to you, but trust me, by the end of this video, it's all going to make sense. But you have your edge that you've tested, you have your strategy that you've tested, you are able to manage your risk, and you are able to essentially win just like most casino owners win versus the people that actually go to the casino and lose. Now, I'll be honest, trading without a system, that is pure gambling. Like, when somebody comes on here, if like a new trader comes and then you just randomly end up buying or randomly end up entering a sell position or something like that, that's gambling. But what I'm teaching inside this entire course, it's not gambling. I teach you how to make it more structured and actually have a system behind what you are doing. Now, myth number 3 is that you can't actually make money doing this. People think that. People tell me that all the time. I am on social media. I post my trades consistently. I've done that consistently for over 6 years now. And you would not understand or realize how many people message me and say, yeah, you made $10,000 on that trade, but can you actually withdraw that? No, I'm just doing this for freaking fun. Yes, I can withdraw the money. All the money that you make with trading, you can withdraw that. You are able to pay your rent, buy vacations, buy a car, freaking buy sneakers, ball out at the Louis Vuitton store, whatever you want to do. This is actual real money that you can put inside of your bank account and do whatever the heck you want to do with it. Really, majority of people that don't actually make money with day trading, it's either because they don't have a strategy and a system, which we're going to completely go over inside this video, or they over leverage, meaning they don't have any type of risk management, which again, we're going to go completely over inside this video, or they quit too early. Trust me, I don't think if you watch through this entire video that you're the type of person to quit. Now, I wanted to quit multiple times in my journey, especially in the beginning when I wasn't actually making money. But I'm going to give you guys the secret that kept me going and how I keep other people motivated to stick through to actually see the results with day trading. Now, myth number 4 is that people think you need tens of thousands of dollars to start. They think only rich people day trade. They think that you need to have literally hundreds of millions of dollars to be able to actually see results and make money with trading, and that's wrong. It's actually extremely wrong. And I'm going to give you guys a cheat code later on inside this video where you don't even have to use your own capital. But the truth is, you don't need to risk thousands of dollars of your own money. You can use prop firm capital, which is what we'll get into later on. You can trade their money, meaning you don't have to risk your own money, and you get to keep most of the profits. Most of the time, you get to keep 80 or 90% of the profits that you make using other people's money. Like I said, we're gonna dive really deep into that later on inside of this video. Myth number 5 is people think they have to spend all day trading or all day at the charts. But the truth is that once you know your strategy, the entire trading day can take 30 to 45 minutes. I'm going to show you guys exactly how later on inside this video, but here's a quick little rundown of how my day looks and how I teach people to have their day look when it comes to trading. I've taught people that are full-time in school, people who have full-time careers, and they still have enough time to trade because of the way that I trade and because of the way that I teach how to trade. So the first 5 minutes is honestly you just marking up your charts or planning out your trades. The next 10 minutes, you're doing a little bit of back testing, which we'll get into later on inside of this video. And then it takes about another 5 minutes to just plan out the exact entry that you're going to have and kind of build the game plan for that trade. And then it's going to take you about 10 to 20 minutes for you to set alerts. You're going to wait for your entry. Once the alert goes off, you're going to place the trade, and then you're literally just going to walk away. That's it. And then another 2 minutes, once your trade ends up winning, you're just going to review the trade because you always want to learn from every single trade that you take. That way you can be better for the next trade. And you're going to review the trade and then another 3 minutes to journal the trade. That's all part of reviewing it and making sure you're tracking it, making sure you're being able to learn from your mistakes and also learn from your wins. This is literally exactly how my day looks every single morning. The same exact thing over and over again. And it's not me sitting here with 300 million screens and taking 14 hours out of the day to trade. Now, the next myth is that day trading is a get rich quick thing. I do not want you guys to think that you guys are going to watch through this video, then tomorrow you're going to be making $100 million. That is not the thing. Trading is a skill, like a life skill that once you learn this, it's something that you can not only use to get yourself financial freedom, give your family financial freedom, but also something you can teach and pass down to your kids. Like the real timeline for me, it took over 3 years to be able to start being consistently profitable. I was not consistently profitable for an entire 3 years. But I'll be honest, if I had the video that I'm making for you guys right now, I would have saved myself a drastic amount of time. And in my inner circle, when I'm working with people one-on-one to get them to profitable or get them to actually be able to consistently make money trading, I'm able to get them to that point a lot faster than it took me. This is usually how I like to set expectations for people, right? And I'm not saying that this is gonna be you. I have people that have done this faster. I have people that have taken longer to do it. I personally took longer to do it. But the first 1 to 2 months, you're gonna be on a demo account only. This is when you're learning the charts, you're learning candlesticks, you're learning your strategy, and you're probably going to feel extremely lost. After watching this video, you might be a little bit better, but you're still gonna feel pretty lost. But then the next 2 to 3 months, you're gonna be able to build your edge through hundreds of practice trades. This is like your testing phase or your back testing phase. I mentioned back testing a little second ago, and later on inside this video, we're gonna dive into exactly what that is and show you exactly how to do it. But that's usually the route that is next on this whole learning process of learning how to trade. But then from months 3 to 12, that's when most people start seeing their first profits. They have their first small live trades. They might get some prop firm accounts, and then they start getting their first payouts, meaning they're able to start taking money out and paying for things with the money they made from trading. And then honestly, after that first year, the next 1 to 2 to 3 to 4 to 5, 10 years is all about scaling. It's all about getting more consistent with the way that you're trading and leveraging the knowledge that you already have to make even more money. Now, another myth I hear a lot is that you need like a freaking crazy setup. Like they think my computer right here, I have 3 monitors. I ain't gonna lie, I do have 3 monitors, but you don't need this. Most of the time when I'm traveling, like if I'm in Dubai or if I'm in any other country, honestly, I just have a laptop. That's it. And that's all I need. Like you don't need 30 million screens. Some people think you need like a crazy gaming computer or you need like, I don't know, some super expensive computer. As long as you have a laptop, anything that is from the last 5 years, honestly, if it's from the last 10 years, it might still work. It'd probably be a little bit slow. I would probably get irritated with it, but if you have a working laptop, if you have a monitor, one screen is fine. You don't need multiple monitors. And if you have solid internet, you're going to be good. You can even do this from your phone. Like there's multiple times when I'm out and about and I'll trade from my phone. Now, I wouldn't suggest you learn how to trade from your phone or from like an iPad, just because in my personal opinion, it's a little bit harder to get, I guess, familiar with trading on such a small screen. So I would suggest you learning how to trade from a computer or from a laptop or whatever it is. But then once you're comfortable with it, you can trade straight from your phone. Like I literally have made hundreds of thousands of dollars trading from my phone, and you're perfectly fine with that. So that essentially covers most of the myths that I hear around on social media and things like that. A lot of things that stop people from getting into trading. Hopefully I can clear that up for you guys. Trust me as a beginner and a lot of people that I work with in my inner circle have the same exact questions when we first start off, or the same exact false beliefs. So I just wanted to make it clear and plain that these are just myths. This is not real life. This is not how real trading actually looks. But at the same time, I don't fault you for thinking or believing those myths, because like I said, me and the people inside my inner circle, all the beginners that I work with, we all went through the same thing. We all thought the same exact thing. All right, now let's go into the types of day trading. I kind of mentioned a little bit earlier that there are multiple different types of things that you can trade. So let's dive into that. And then also I'm going to tell you guys why I trade this specific thing, which is futures. So there's really 5 major markets that most people trade. There's the futures market. That's what I trade. There's the Forex market. I traded Forex market for the first, 5 years of my trading career. There's the stock market, there's the options market, and there's the crypto market. Keep in mind, I have traded every single one of these markets, and I've made money in every single one of these markets. I started with crypto originally, and then I got into Forex, and then obviously I had stocks along the way, and then I got into options, and then I got into futures, and now I mainly trade futures. Now, depending how old you are, you probably remember back in 2019, 2020, when you would walk in the mall and random people would come up to you and say, Forex this, Forex that, like try and get you to be on a Forex IML wave or whatever. Forex is not that scammy thing that you thought about before, where you had to get recruited into a group and then they rented out Airbnbs and y'all was just chanting Forex, Forex, whatever the heck them people used to do. That's not what Forex is. Forex essentially is just trading currencies, meaning you're trading, let's say, the price of or the value of $1 versus the value of like the Japanese yen, right? If you've ever traveled outside the country and you would exchange, let's say 100 of your US dollars, and they gave you a certain amount of whatever that local currency is, that's all Forex is. Like it always fluctuates. Like in Dubai, they have the AED, and $1 is worth 3.67 AED. But sometimes $1 is worth 3.61 AED. So trading Forex is simply trading the fluctuations between 2 different currencies put together. That's what Forex is. Stocks, you're really trading companies, as you probably know. Like if you're buying a stock of Tesla or Apple or Amazon, that's essentially what stocks are. That's what your parents probably told you about, just buying the stock and holding it until eternity. Then there's options trading, which you can trade options or contracts of stocks. It's, in simple terms, very high level simple terms, it's just a leveraged version of trading a stock. Then there's obviously crypto. You've probably heard of Bitcoin. You've probably heard of Ethereum, Solana, things like that. That's mostly trading crypto coins. And the cool thing about trading crypto is that it is 24/7 with all the other things we talked about, futures, Forex, stocks, and options. It does have days or hours of the day where you can't actually trade it. But with crypto, you can trade it literally whenever you want to. But I trade futures, and this is why. This is a few reasons why, I should say. So futures for me is best for day trading. It's best for catching these short moves. It's not really good for holding it long term, but that's not what me as a day trader does on a consistent basis. I just want to get in and out of trades, and futures allows me to do that very simply. It also has very clean price action, meaning there's less like manipulation and scamming. With Forex, in the Forex space, they have all these different brokers that are owned by like regular people like you and me. And what they'll do is they'll make you lose trades so that they can make more money. There's none of that with futures because it's completely regulated, meaning they have to follow the rules or they will get shut down or sued or go to jail and things like that. So that's why another reason why I love futures, because it is regulated. The next point is that you're allowed to trade with leverage. Similar to how options trading is, how I mentioned you can trade with leverage or be able to make a lot more money with less money. It's also with futures as well. You just get to take bigger positions without having a whole bunch of money inside of your account. And then it's super prop firm friendly, meaning you're able to get funding from other people and trade their money in the futures market. For me, it's the simplest one to learn out of all them. But once you learn futures trading, you can transfer that knowledge over into Forex. You can transfer it to options, stocks. You can transfer it into all the other different markets. And that's what I've done. As I mentioned, I started on all these other ones, and learning one market allowed me to easily transfer into the other market. But if you learn futures, I got to futures kind of late. But if you start in futures, you would actually be able to transfer that knowledge very easily into any of the other markets and be able to profit from that once you've mastered futures trading. All right, so now let's understand the major things that we're actually trading in futures, meaning the major pairs or the major tickers that we're trading. Because as futures traders, we're able to trade really a bunch of different things. We're actually able to trade indices, which is basically stocks, like a group of stocks. That's one indice. You're able to trade energies, like you can trade natural gas or crude oil. You're able to trade agriculture. You're actually able to trade like corn and things like that, which I've personally never done, but I'm sure somebody out there is making money trading corn futures. But there's a bunch of things that you can actually trade, but I just want to go over the major ones that most people end up trading. I'll give you guys kind of which one I like trading or which ones I personally like trading, and I'll tell you guys exactly why. So I guess first starting off, these are the major four Forex pairs that most people trade. I say pairs, sometimes I'll say pairs, sometimes I'll say tickers, sometimes I'll say contracts. Like right here, you'll see this is ES, that is the ticker, which simply just means the shorter version of whatever it is that we're trading. Like this ticker is ES, but we're actually trading the S&P 500. This ticker is NQ, but we're trading the NASDAQ 100. So just think of the ticker as the shorter way of saying whatever it is that we're trading. But these are the major four pairs or tickers that most people trade: ES, NQ, YM, and gold. If I'm being completely honest, you don't need to trade multiple pairs at all. If you just focus on one pair and master that one pair, you will be absolutely amazing. And we'll get into this later on inside this video. But each of these tickers, each of these things that you can trade are all going to have different personalities. Some of them move super fast. As you see, we have descriptions of them on the screen right here. But like some of them move super fast. Some of them move slower. Some of them are great during this period of the day. Some of them are great during another period of the day. So if you learn one, you get to learn a lot of the small little nuances about it. Nuances, however the heck you pronounce that word. You get to learn all that about these tickers. So I wouldn't suggest you go and try and master or trade every single ticker out there. It really depends on your personality. But most of the times I have beginners start with NQ because it is like the most, I guess, widely traded futures ticker, because it is the most volatile, meaning it moves the most. It gives like the biggest moves, essentially just allows you to make more money in a shorter amount of time. It is really good for learning how price actually behaves, because it does respect certain areas or does show certain patterns and things like that very frequently. So it just allows you as a new trader to get used to actually trading. Most people end up sticking with NQ. For me personally, my favorite pair to trade is YM. Gold, which was GC, the ticker GC. I used to trade it when I first started off. It burned me. I lost like 60,000 in the first few weeks of trading. We'll get into this story later on and how you can avoid that. But I did it all on gold, so I have a bad taste in my mouth for gold. I don't trade it anymore. My favorite is YM, like I said, and I'll also trade NQ and ES sometime, but most of the time it's YM or NQ. All right, so you know the futures contracts, you know the tickers. Now let's get into understanding them. And also I want to go over some key terms that you guys will probably hear me say throughout this video. I'm just going to give you definitions for them so you know exactly what they are and why I'm saying them. So future contracts, essentially in simple terms, are just legal contracts to buy or sell something at a predetermined price. Meaning if we are buying, let's say buying NQ, right? We're saying at this point, we'll buy this amount of NQ for this amount of dollars. Now, most of the time, you're not actually buying the thing. You're just buying the contract to buy that thing. So let me put it into simple terms. Imagine you have this Joovier bobblehead thingy, right? And let's say it cost me $50 to make or something, but it's a high collectible item and it's always going up in price. Somebody sells me the contract, or somebody offers to create a contract saying that, okay, I want to buy this, or I have the opportunity to buy this from you for $100, right? But then 2 years goes by, they have that contract still to buy this for $100, no matter what other people are paying for it, and you have to honor that contract. Since they have that contract to buy it for $100, and this is now worth $100,000, that contract that they have to buy it for $100 is worth a drastic amount of money, a huge amount of money. That's essentially what futures contracts are. It's not necessarily that you're going to buy this bobblehead, but you have the option to buy this bobblehead at a certain price. And because you have the option, or you have the contract to buy this underlying ticker at this specific price, that contract itself is valuable, gets more valuable. That's essentially what futures contracts is. That's usually the way that I try to describe it to people. But I just want to go over some key terms so you kind of understand them for yourself. So there's contract size, there's margin requirements, and then there's buying a contract or selling a contract, right? So first of all, contract size is the amount of the underlying asset that each contract is buying. Remember, I talked about with the bobblehead, I can have a contract that says I can buy one bobblehead for $100 no matter what the actual price of it is for. In this analogy, like with ES, the contract we're buying, every time we buy one ES contract, we're having the opportunity to buy 50 S&P 500 shares. Same exact thing with NQ. When we buy one NQ contract, we're creating the option or the contract to buy 20 NAS 100 shares. Now, as I mentioned, this is kind of irrelevant because you're never actually buying 50 S&P 500 shares or 20 NAS 100 shares. Like, that's just never going to happen for 99.9999999% of people. But I just want you guys to be aware of what an actual contract is and what it is that we're actually trading when we're trading futures contracts. Now, the next definition I want to go over is margin requirements. So even though your contract says you can buy 50 S&P 500, you don't have to have enough money to buy 50 S&P 500 contracts, because I don't even know how much the S&P 500 is right now, but to buy 50 of them, you would need hundreds of thousands of dollars inside of your account right now to buy them. That's not the case. Remember, I mentioned before, with futures trading, they give us leverage, meaning we can essentially borrow money to be able to buy these things. And the margin requirements is simply the amount of money that we need inside of our account to purchase one contract. I know this sounds a little confusing. It's going to make so much more sense once we hop on the charts and I show you guys how to actually do this, but you need to understand these definitions. So think of margin requirements as like the minimum amount of money that you need inside of your account to enter a trade. The next thing that you're going to hear me say is buy or sell contracts. When I say buy, that means I'm going long, meaning if I say buy right here, I'm assuming that this is the cheapest that price is going to be. And if price goes up, I make money. So if I enter a buy and price goes up, I make money. If I enter a sell, I'm able to profit on the price of whatever I'm trading going down. As I mentioned earlier, this is not like stocks. This is not like you just buy it and you hope price goes up. With futures trading, we can make money when price is dropping and when price is going down. So when I enter a sell of a contract, I'm going short, meaning that I want price to go down, because the more that price goes down, the more money that I make. So I just wanted to clear that up so everybody understands that. Now let's dive into kind of what this all looks like, right? Because there's a few things that I want you guys to just be aware of. So we already talked over here about the symbol, which is the ticker. It's just the short version of the actual name that we're actually trading. This is the contract. This is the margin. This is the tick size. And then this is the tick value. So we understand tickers already. We understand contracts. This over here is showing you guys examples of NQ, ES, YM, and GC, which we already went over. Margin, remember, this is the amount of money that you need inside of your account to open up a trade, to enter into a trade. So for NQ, you need $1,000 inside of your account. And this is for most brokers or most platforms. We'll get into what brokers are a little bit later on, but just so you understand it right now, brokers are simply just like your bank account. That's where you keep your money and that's where you actually trade from. So you need at least $1,000 inside of your broker account to open up one NQ trade. But you'll notice here that we have micro versions of every single ticker or every single contract. So NQ cost us $1,000 to be able to even get into a trade. That doesn't mean that when we enter a trade that we lose $1,000. That's just how much money they want to see inside your account for you to enter into a trade. But that's NQ. But you see we have micro NQ, which the ticker is similar. You just add an M in front of it. So then it becomes MNQ instead of NQ. But you only need $100 to be able to open up one micro NQ trade. And you'll see the same thing across the board with ES and YM, how the micro version of each of them is just 1/10 the price of the regular one. So like you can honestly start trading with $50 inside of your account if you traded MES or if you traded MYM. So I just want to have this sheet for you guys. You're probably going to come back to this multiple times, so you can screenshot this and just have it handy so you know how much money you need inside your account to open up one trade. But then let's get over to tick size and tick value. This is how we are able to calculate how much money we'd make when we enter a trade or how much money we're risking when we enter a trade. But let's start off with tick size. Think of ticks as increments on how the price of something moves. Like right now, if you're looking at the price of Bitcoin, right, it can go from, let's say for easy numbers, $100 to $101, and then $102 and $103. That means it's moving in one tick increments. If it's going from $100 to $101, it's moving in one tick increments. For NQ, it's different. Each tick increment is 0.25. So it'll go from 100 to 100.25 to 100.5 to 100.75. That's it moving in 0.5 tick increments. And you'll see that NQ does that and ES does that. And obviously the micro versions of each of these will follow that same path, meaning they're going to stay with 0.25 increments. And then YM is one increment, so that's super simple. If it goes from 100, then goes to 101, it moved one tick. GC, which is gold, moves in 0.1 increments. So if it goes from 100 to 100.1 to 100.2, it moved in one, or it moves two ticks. If it went from 100 to 100.2, that means gold moved two ticks. Now we understand increments now. We understand what that looks like. But here under tick value, this tells us how much money each tick movement is worth. So let's say we entered for a buy on NQ and the price of NQ was $10, right? And then the price of NQ went from $10 to 10.25. It would have moved one tick, meaning we would have made $5. Now, if it had went from $10 to then $11, price would have moved four ticks. 0.25 times 4 is $1 for all my math people out there. It would have moved four ticks. So then we would have made $5 times 4 ticks. Because remember, each tick is worth $5. And it's as simple as that. You would do the same calculations for each of these. And it gets super simple once you're on the charts and you see it. There's a super simple way to find the ticks or to see how many ticks price is moving. And then you would just do the calculations of, okay, if I'm trading NQ and if I'm up 100 ticks, that means I'm up $500. It's super simple to do the math. But you'll notice here that the tick value, similar to the margin, is just 1/10 of what the normal one is when we're talking about the micros versus the normal. So like I said, this sheet is like a cheat sheet for you to have. It's super, super cool just for you to be able to tell how much money you're risking on a trade or how much money you'd make on a trade if any of these contracts went to a specific price. So we went over symbol, we went over the contract, we went over what margin is. Remember, margin doesn't mean that if I enter NQ that I lose $1,000. That's just simply, I just need $1,000 inside my account to even enter NQ. And then this, keep in mind, this is all for one contract. You can open up multiple contracts. Like you can buy one NQ contract or you can buy 10 NQ contracts. And the difference would be if I buy 10 NQ contracts, I would need at least $10,000 inside of my account. And each tick movement would be worth $50 instead of $5 since I have 10 contracts. The tick size would stay the same, meaning the increment where it changes would stay the same, but the tick value goes up depending on how many contracts I open. So if I bought 5 contracts of NQ, each tick value would be worth $25 instead of $5 with one contract. And it's the same thing across the board with all these other futures contracts. All right, so we've went over futures contracts. I gave you guys the most popular ones and we went into understanding futures contracts. Now we need to talk about something extremely important called trading sessions. You need to understand that there are specific times during the day that a lot of movement happens in the futures markets. So I'm going to show you guys when to trade and what to trade during those periods. So the market is broke into 3 major trading sessions. The first one is Asia session. That starts at 6 p.m. and goes all the way up until 3 a.m. Eastern Standard Time. That's the window for when that is open. Think of trading sessions as like the work day. So we know in America, most of the time people work like from 9 to 5, right? It's the same thing when it comes to these bankers. They're in the office. Remember, like trading is done by institutions. It's done by banks, private equity firms. It's done by all these huge companies, and they're not working 24/7. In the US, they're working the regular same hours that we would work, meaning if they're working, they're trading. If they're trading, they're moving the markets. Us as what is called retail traders, which is just like regular people, we don't move the markets. I could be trading with $1 million, $2 million, $5 million. Me buying 10 NQ contracts is not moving the markets. I'm not affecting the markets. It's the big banks and all that, the huge hedge funds and all those people, big conglomerates that are actually moving the markets. And like I said, they're working during specific windows. So in Asia, their work window is 6 p.m. to 3 a.m. Eastern Standard Time. London session is from 3 a.m. to 8 a.m. Eastern Standard Time. Well, it's actually from 3 a.m. to 12 p.m. Eastern Standard Time, but New York session starts at 8 a.m. So there's actually an overlap. All right, I fixed it. So it's from 3 a.m. up until 12 p.m. is when London session is, and New York session is from 8 a.m. to 6 p.m. Eastern Standard Time. Now, London and New York overlap for a period of time, and that is the juiciest part to trade most of the tickers that we went over inside of this video so far. So you'll notice here that London session goes all the way up until 12 p.m. Eastern Standard Time, and New York session starts at 8 a.m. So from 8 a.m. up until 12 p.m. Eastern Standard Time, New York session, which is American traders and banks and hedge funds and all that stuff, they're trading, and London session, banks, hedge funds and all that stuff are also trading at the same time. So that's when there's the most volume and the most kind of movement. Asia session is kind of on its own, 6 p.m. to 3 a.m. Eastern Standard Time. It's slow. I personally don't trade Asia session at all. Most of the time people skip it. London session, it kind of wakes the market up. Big moves start happening there. Like you'll notice at around 3 a.m. Eastern Standard Time, you'll start seeing price move again versus being slow during Asia session. And then New York session is the main event. That's like where the most volume happens, the biggest moves. That's where I make all of my money in. As it says right here, London opens the day, New York runs it. A lot of times, like these two coincide. And when you're trading during that window, when they both overlap, that's when you're able to see like the great moves and the big moves and things like that. So now you understand the 3 trading sessions. Now, it's important to know, and I mentioned before, that certain tickers work better during certain times of the day, meaning they work better during certain sessions. So like during London session, gold is actually pretty good to trade during London session. You can trade it during New York session as well, but it does work very well during London session as well. I do know a lot of traders that trade gold during London session, but then New York session, man, you got to stick with NQ, ES, and YM. You're going to see huge moves with NQ, ES, and YM during London session, specifically that window for when London and New York session overlap. Now, of course, you still can trade NQ, ES, YM, gold in any of these different sessions, the London session, Asia session, or New York session, but this is just when you're gonna see majority of the movement. And like I said, you can trade gold during New York session, but we're not talking about gold. Gold, I already told y'all my story with gold. It burned me too much. I don't play with it, but I'm not gonna lie. Gold, especially recently, has been absolutely killing it during London session. So it might be something for you to kind of look into if you did want to trade later on inside the day. I personally like getting all my trading out the way within the first hour, like I said, 30 minutes or 45 minutes of the New York trading session. So just be aware of that. Now, there's one other thing that you do need to be aware of. So yes, the New York session starts at 8 a.m. Eastern Standard Time, but the market doesn't actually open until 9:30 Eastern Standard Time. What I mean by the market, yes, you can trade it whenever you want to, but the stock market opens at 9:30 Eastern Standard Time. And right at 9:30 Eastern Standard Time, when the stock market finally opens, that's when you're going to see a huge spike of volume. You're going to see price do crazy things every single day, Monday through Friday at 9:30 Eastern Standard Time. So just be aware of that. So yeah, that's the trading sessions. And this is kind of what I usually suggest to kind of lean towards trading during each session, just based off the fact that that's when you start to see those big moves with these specific tickers. Real quick, if you're getting value out of this so far and you haven't shared this video with a friend yet, I highly suggest you take 5 seconds to do it right now. We're about to get into the majority of the meat of this video, and you're gonna want someone else to go through it with you. Honestly, just trust me, trading can be extremely lonely. It's way better if you have a friend or someone you trust, someone you like, that'll hold you accountable and you can hold them accountable to stay along this journey and actually be able to see results with trading. So share it with whoever that person is or whoever those people are, and let's dive into more of the fun stuff when it comes to trading. All right, so now let's go over the types of analysis. There are really 2 main types of analysis, one being fundamental and the other being technical. We're gonna dive into what each one is, which one we use, why we use each one in specific times, and honestly, we just have to be aware of both types of analysis, even though most of the time we focus on technical analysis. But as I mentioned, there's 2 main ways to actually read the market. Fundamental analysis, that kind of teaches you what to trade. That's going to be studies around the underlying value. Things that affect fundamental analysis could be the economy, like if we're in a recession, supply and demand, like if there's a war and it cuts off being able to get, let's say, food going to a specific country, or oil or something like that. That's supply and demand. News events. So think like if you own Apple stock, right? Or let's say you own an iPhone and recently 300 iPhones randomly exploded. That's a news event that will probably badly affect the Apple stock. So that's news. Then there's earnings. Earnings is essentially when companies report how much money they made in a specific quarter. So like if they planned on making, let's say, $1 billion this quarter, but they ended up making $2 billion, that's great news, and that will affect the company positively. So these are things you need to be aware of. Now, technical analysis gives you the when to trade, essentially. So that studies essentially price action on charts. What you're seeing most of the time when you're seeing traders trade, like those candlesticks on the charts or line charts, or when they have and draw boxes and things all over the charts, which we're going to get into later on inside of this course itself. That's the main thing that us as day traders use. We use technical analysis, but we also have to be aware of fundamental analysis. So just a more deep dive into fundamental analysis. As I mentioned, it's the why behind a market's direction. So like the economic data, like CPI news comes out, or unemployment rates come out, or just news events that come out that affect the economy overall. That is part of fundamental analysis. You just have to be aware of that. Later on inside the course, I'm going to show you guys how to actually find fundamental analysis. But then also like central bank policy. So like when interest rates go up and things like that, that's all going to affect it and be part of fundamental analysis. Earnings and company news, as I kind of explained what earnings is. And then company news is obviously, like I gave the example of, let's say Tesla decides to make a car that is now $3 million or something, I don't know, and investors think that's good or bad, that will affect the Tesla stock itself. That's just an example of Tesla news or company news. And then supply and demand events, as I mentioned, oil, food, gold, things like that. When there's not enough of something, or if there is too much of something, that is fundamentally going to affect the market. That's essentially what fundamental analysis is. Now, technical analysis on the other side, which is, like I said, what we as day traders focus on, for the most part, is the when of every trade. So price and looking at price tells you everything when it comes to technical analysis. So you'll be able to see support or resistance, which we get into later on inside this video. You get to see candlestick patterns, trending and moving averages, indicators. These are all parts of technical analysis. And obviously we're going to cover all of this inside of the course. Now, this is, as I mentioned, really what most traders focus on, but you can't ignore fundamental analysis. As I mentioned here, technical analysis drives the trade. It lets us know when we can actually enter a trade, when we should close out a trade. It gives us our when, like that's when we're taking action. But we can't be oblivious to fundamental analysis. We need to understand what's going on in the overall market. If the market is selling down, and we can see on a chart, which is technical analysis, that the market is selling down heavily, fundamental analysis will tell us why it's selling down heavy, right? So as I mentioned, as we are trading futures, because that's what this course is about, you're essentially always going to be focused on technical analysis, but keep your eyes open to fundamental analysis. This is how it works together. So fundamental analysis, you check the calendar, and I'm going to show you guys exactly where to go to actually find fundamental analysis, like I mentioned, because a lot of the majority economic events, they're like planned out. So like it'll say Tuesday at 2 p.m., whatever, this is going to come out. So you could just be aware of that, and I'll show you where to find that. And then how I essentially plan it out is I look at that calendar that we're about to go over in a second to see exactly what's going to happen on that day. And I make sure I'm not really trading around that time, or if I am trading around that time, I just am aware that these news events are going to come out. And then technical analysis, that's where I'm going to spend majority of my time. That's the reading the chart. That's looking at where the trend is going, where the price of something is going, key levels, support or resistance, entries, exits, everything like that. So just a quick little recap. Fundamentals tell you the why that the move is happening. Technical analysis tells you when to make that move. So day traders essentially execute on technical analysis, but you never trade blind to news. You need to be aware of it. Know the chart, read the chart. Know the calendar, read the chart, click the button. It is simple as that. Now let's go into how to actually find the fundamental analysis. All right, so here we are. This is where I go to find my fundamental analysis. Now, to be clear, this is where I find the planned fundamental analysis, meaning when the government has certain meetings or they release certain numbers, a lot of economic data will come out on here, and that has a date and a time, so you can be aware of it. But remember, fundamental analysis is not just planned events. It could also be something crazy that happens. Like if 300 Teslas blow up randomly, that's going to affect the stock price of Tesla. Or in any example, that is just something that we cannot plan for. It's something that isn't on the calendar. We don't know that today somebody could start a war, or tomorrow somebody could end a war, or whatever it is, right? So that is something you have to be aware of. But this website right here will give you the planned events that are happening. It is forexfactory.com. I like it because it's super clear, super to the point. I'm going to show you guys how to read it right now. This looks super confusing. It's not that confusing at all. A lot of times at the top here, it'll have like major news events that are happening right now. Like, but at the time we're shooting this video, we're currently hopefully about to end this war that's going on. So it has events like that. And obviously this isn't something that is planned. This is just like kind of breaking news. And honestly, if you're just on social media or if you watch the news every once in a while, you'll be able to hear events that aren't on this page happening, the ones that can't be planned. But now the ones that can be planned, right? So you'll see, you don't really have to pay attention to any of this. You can scroll down here onto this calendar. You'll see it says today that I'm shooting this is May the 20th. And it'll show you everything that is planned for the day. It also separates it based on currency, impact, and then what the actual news is. And it shows you what time it is that will happen, right? Now, you don't realistically need to focus on anything where the currency is not USD. Us as, I guess, America or the United States, our dollar and our events kind of affect a lot of the world. So a lot of the things, really the only thing that you need to focus on is any news event that is USD and red folder or orange folder. So they separate it as far as the impact on how much the news event will affect the market based on 3 color codes. Yellow folder news will barely affect the market. Orange folder news can affect the market. It probably won't do anything too crazy. Red folder news most of the time would do a lot. So realistically, when it comes to me, I don't like trading around red folder news at all. If it says USD and red folder, I'm not trading around that time. I usually like to give it about 10 minutes before and 10 minutes after the planned time. So right here today, we have a red folder USD news at 1 p.m. So I personally, even if I don't trade that late, but let's say I did trade that late, I wouldn't take any trades between 12:50 all the way up to 1:10 because I'd like giving that 10-minute buffer before and 10-minute buffer after. Now you'll notice here that we have some red folder news right down here, but the currency is AUD. I don't care about that. That realistically is not going to affect any markets that I'm trading or any markets that we go over inside of this entire course. So you really don't have to worry about it. Like I said, you only need to focus on USD, red folder news. And then this obviously tells you what that red folder news is for the day. And here is the cool part. As I mentioned, these are all planned. So you can go forward one and you'll see the news events that's happening tomorrow. So as you see on this day, we don't really have any red folder news that is USD. The most we have is USD orange folder news at 8:45 in the morning. You don't really need to worry about the numbers over here. This essentially tells you what the news event comes out with. Like the flash services PMI, the numbers that they are expecting is 51.1. Previous, as you see right here, the previous numbers were 51. So this is just telling you kind of what the news event did itself. You really don't have to worry about that at all. Just worry about the fact that you should really not be trading news. Trading news is gambling because you never know what is actually going to happen. But what I'll do most of the time, every single morning, I'll come on here and just look to see if I have any red folder news events planned out for the day. If I do, I'll just put a block inside my calendar to not take any trades between 10 minutes before and 10 minutes after. And I'll do that every single week. So every week you can actually go forward. So this is next Monday. There's a bank holiday, so the markets will be closed essentially. Next Tuesday, there's really no red folder news that I have to worry about. Wednesday, no red folder news. Thursday, we do have red folder news right here. That is USD, and that's at 7:30 a.m. So I won't be trading at that time. Friday, we don't really have anything. So this is a great website for you just to use to be able to see all the planned events. But as I mentioned, this isn't going to show you everything. They don't have on the calendar when a war can end or when a new pandemic could start or something like that. You just have to be aware of things that are going on inside of the world. But this is a great tool to make sure that you're checking every single morning so you don't get shocked when something crazy happens that is caused by a news event. All right, so we understand different type of analysis. We understand where to find analysis. Now let's go over the platforms that we're actually going to use to trade and do technical analysis to actually enter our trades and things like that. There's really only two platforms that you need. You need, first of all, a broker, which a brokerage is think of it like a bank account that you're actually going to trade from. That's where you're actually going to store your money in. That's where when you make trades, that's the platform you're going to enter the trades on, meaning you're going to buy and sell on that. When you make profit, that's where you're able to withdraw from into your bank account. That's essentially what a broker is in simple terms. Now, you'll also need another platform, a charting platform. The charting platform is where you plan out your trades. Yes, you can plan out your trades on the brokerage platform, and we'll go into how to use both of these platforms that we're about to go over right now. We'll go over how to use both of them in depth in a second here. But honestly, the brokerage platform charting is super ugly. I don't recommend it. Very ugly, not nice to use. That's why we have a charting platform, then we have a brokerage platform. So the first platform is the charting platform, and what most people use and what I have used my entire career is TradingView. It's absolutely amazing. We're gonna have a full deep dive on how to use TradingView, but just go in here, create yourself an account. You can get started for free. They do have different pricing plans. Realistically, I think they have like a 7-day free trial. Some days they have 30-day free trials. So just whenever you're watching this, go on there and just sign up for a free trial so you can just start using the account and kind of playing around with the platform itself. But TradingView is where we're just charting up our trades and planning out our trades. We're not really doing the execution on there right now. Now you can connect your broker to TradingView. We'll talk about that later on inside the course part where we talk about how to use TradingView and things like that. But TradingView is just where we're charting. Tradeovate is going to be the broker, right? This is where you're actually going to deposit money into. This is where you're actually going to be hitting buy and sell, where you're going to be able to withdraw your profits from. This is what you need. Now, there are so many different brokers out there, honestly. Tradeovate is just the one that I personally recommend. It's the one that I use. It's the one that I
kind of tell all of my students to use. Reason being is because to me, it's like the most simple one out there. There's a whole bunch of other platforms that they're great because they let you do so much stuff, but it's also bad at the same time because it has too many options. It confuses a lot of beginners. That's why I always recommend Tradeabate. So this is the Tradeabate account. You should come in here and open up an account. Be aware, I'm not going to walk you through how to open up an account, but do be aware they will ask you for questions, since they will ask you like more so personal questions like your address and all that other stuff, because this is essentially like opening up a bank account and you have to get approved for it. Now, you shouldn't have any issues getting approved for it if you are inside the United States. If you're outside the United States, there are other brokers that you can look into. One is called Interactive Brokers. This is another platform that you can look into if you are outside the country. Even if you're in America, you can use this as well. But if you're outside the country, you can't really use Tradeabate in specific countries. So a backup option for everybody that's watching this that is outside the country, Interactive Brokers is another good one that a lot of people like. But if you can use Tradeabate, I do suggest Tradeabate because it is very, very simple. But as I mentioned, they're going to ask you more so personal questions like your career, address, your name, obviously all that stuff. And then you have to get approved. So I do suggest for everybody to go and create an account. It's free to create an account and get the whole approval process going. That way, when you are ready to trade, you don't have to wait a few days or wait for a week for them to approve you. Just get it out the way right now so you have it in your back pocket and you can fund it and do all that stuff later on. But like I said, these are the main two platforms. We're going to dive into how to use both of these in a second. Just remember, TradingView is for planning out your trades. Tradeabate is for executing your trades and for storing your money inside of it and for being able to withdraw your profits outside of it. All right, so now let's go over how to use Tradeabate. So when you create your account and you get approved, and if you sign up for the live trading and all that, this is kind of what that home page is going to look like as soon as you log into your Tradeabate account. I want to go through all of these. Live trading is obviously where you trade your live account. You have market replay, which is good for back testing. We'll get into later on inside this video. I actually prefer to back test on TradingView, which we'll get into later on inside the course as well. Then you have simulation. This is like a paper trading account or a demo account. This is so you can practice trading while not actually risking your own money. It's just fake money. And that's honestly where I suggest every single person that's watching this, and as a beginner, this is what I suggest you to be on. You should not be live trading your own live funds as soon as you get into trading, because you will blow your money. You will lose all of your money. I am 99.999% sure that as a beginner, you will lose all your money in trading. So you should be practicing on simulation so you don't have to lose your money. So let's go into here because I'm going to walk you guys through the entirety of the platform, not just the entirety of the platform, how to set it up and everything like that as well. So when you first get into here, regardless if you go on the live chart or the simulation account, right now we're just going to be on simulation so I can show you guys examples and stuff like that. It's going to look like this. Now this looks absolutely disgusting, looks very ugly, looks very, very confusing. So I'm going to show you guys how to not make it look like that. So what you're going to do, you'll see in the top right corner of all these little boxes, these little X marks that say close all of these out. Every single one that you see here, close them all out until you have your black screen right here. It might be a white screen depending if you are on dark mode or light mode. That's completely up to you, but it'll be a blank screen right here. Now let's go over what you see right here first before we dive into how to actually get your charts and stuff on here and how to actually trade. So up here, you have this plus button where you can add modules. We're going to click that in a second. That's going to let us put the chart up on there or anything else you want to put there. Right here, we have trading. We can press that and the trading panel will pop up. We have alerts here. We have search. And then this will tell you what time it is, in case you didn't know what time it was. Here's your account. So if you have, right now you see it says demo account. And it has account numbers. If you were on your live account, it will show you your account numbers here. You can switch through to multiple different accounts on here. Here, it shows you equity and then open P&L. Equity is simply how much money is inside of your account right now. And then open P&L is just how much profit you're in right now if you have a position open. This would show if you were up, let's say $100 or down $300, whatever it is, it would show right here. And you're going to see it a little bit later on inside this video. Here we have the day margin and the initial margin. So day margin essentially is how much money you have left to be able to trade. We kind of went over that already when we talked about the margin requirements needed to be able to open up any futures contract. But this just shows it to you how much you have available to be able to trade with. Then over here, you have your settings icon right here. We'll go through that in a second here. You have your current news. You have your chat over here. And then, hold on, let me drag this over. So you have your chat over here, a bunch of things that I really don't use at all. All I use for the most part is this settings button right here. Now, let's hop into kind of how to get this chart back on here. So if we press plus modules, add module, you can see we have a bunch of different options here, but what we're focused on is this chart option. So what you do, you'll click, hold it, and drag it right into your chart, and you'll see this pop up. This is chart. This is lets you put in whatever ticker you want to look at. So we already talked about tickers, but let's say we just want to open up an NQ chart. We'll just type in NQ, and you'll see different monthly charts here. Just go to the first one. It always has the most recent one that's up to date. It always has the most recent one right there. So just press this first one, NQM6. Now you'll then have your chart open. You see candlesticks, you see a chart. We'll go over candlesticks and stuff here in a second. But you see your charts, you see all these other lines and all this other stuff that might look a little bit confusing. I'm going to show you guys how to clear all this out. But then you'll also notice that we now have the ticker that we're trading up here. It shows you the price, shows you the bid and the ask. Which you don't really have to worry about too much when it comes to trading futures, because most of the time they're going to be the same number or right about the same number. Then you have some buttons here. You have buy market, buy bid, sell ask. These are buttons that you'll use to actually enter into the market. You see this number that says 1 right here. This is what you would want to adjust if you want to have different amounts of contracts. So right here, if I press buy, I would open up 1 contract. If I change this to 10, and I press buy, I would open up 10 contracts. I can change to 15. I could press sell, and I would open up 15 sell contracts. And then this button right here is exit at market and close. So if you just want to close your position out right away, you would just press that button. And I'll show you guys how to actually enter trades on here in a second as well. We'll go over that. Then you have ATM. So this is where you'd put your stop losses and your take profit. I'll show you guys how to set that up in a second. And for the most part, that is all you need to worry about when it comes to this panel up here. Now on the chart, you'll notice we have these different icons. So I mentioned that you can do your planning of trades on your broker. This is the broker. I mentioned you can do the planning of it on here, but realistically, it's just much smoother to do it on TradingView. But if you did want to do it, you can do it on here. So you have options to zoom in right here, zoom out. You have crosshair, so I can not show crosshair. So you see when I move my mouse around, it doesn't have the lines that follow it. Versus if I do turn it on, you see the white lines that follow it. Right here, we have data box. You can press that and just see more data on the ticker that it is that you're trading. And then drawing tools. This is where you're able to click. And if you want to draw a line on your chart, you can use that to draw a line. You can click and draw shapes. Let's say you want a rectangle. You can do like that. So it does give you optionality to be able to plan your trades out here on the platform itself, but it's just much smoother to do it on TradingView. Now here you have lock menu items on chart. So if you did have a bunch of drawings on your chart, you can press that and lock it in place so it doesn't move. I don't use that. I don't use the drawing tools on here either, if I'm being honest. Right here is time period. So this is whatever time frame you're looking at, and we'll go over time frames, what it all means later on inside this course. But right now we're on the 1H time period, which means we're on the 1 hour time frame, which just tells us that each of these candlesticks that you see represents what happened in 1 hour. We'll get into all that later on inside of it, so don't worry if you don't understand that. And then right here, we can actually change. So if you press candlesticks right here, we can actually change the chart type of chart that we're on. I can go to a line chart, and you see now we're on a line chart. Here, chart settings. So we can change and mess with kind of a lot of the settings that we see here on our charts. I don't really mess with that too much because, like I said, I really only come on here to execute my trades. I'm not really doing too much else on here. You can have configure chart elements. So this is something that you probably will want to press because you see we have all these extra things on here. This down here, this up here, this little purple line right here. What you can do is just press when you press configure chart elements, you can press the trash icon and it will delete all that stuff off your chart. So it's just a clean chart. So I do suggest you doing that because we want it to be as clean and clear as possible. Here we have indicators, which we get into what indicators are later on inside the course. But this is where you're able to add indicators and kind of put them on your charts. And then we have template list. So once you've saved kind of how you want your charts to look, because in the chart settings, you can actually change the color scheme from dark to light. You can change also I believe it isn't here. Yeah. You can change the color of your candlesticks as well. If you don't want them to be green and red, you can change that. So if you want to set up your charts to look like super, super beautiful and you want to never have to touch the settings again, you can just save it as a template here and it'll save it automatically default. So you don't have to do all that all over again. But that's all the different tools that you have on here. Now, it's one thing you have to be aware of. When we're trading futures, which is what we do, you have to get something called market data. If you don't have market data, your candlesticks are going to be behind. Right now, currently it's 11:04 in the morning. Since I have market data, I can see what price is doing at 11:04 in the morning. If I don't have market data, I would see 15 minutes ago what's happening. So obviously you can't trade like that because you can't trade based off candlesticks that happened 15 minutes ago. So you need to get real-time market data. And how you do that, you come over here to application settings, and then you'll come over here to subscriptions right here, and you'll just scroll down. And what you want to do is under market data, you want to go and get the CME bundle. Now you don't need to get level 2. I have level 2, but you can get level 1. Level 1 is fine, but get the CME bundle. There are a bunch of different market data subscriptions that you can get based off of everything that I talk about trading inside this video. You should get the CME bundle because that will give you access to real-time market data for all the tickers versus you having to get market data for each one individually. So yeah, once you have that market data, then you're good. You have to pay for it. I think it might be like, it changes. It used to be like $4 or something, I think. I don't know. I think right now it might be $7 a month. So yeah, just be aware of that. But once you have your market data subscription, now you're actually able to come on here and trade. I want to walk you guys through how to actually trade so that you guys know exactly what to do. So one thing that I do like turning off automatically, I forgot I had it on. By default, it has it on. If you come over here to chart settings, because you'll notice when I drag my chart that it automatically puts it back. And I don't like that. I want it to be able to drag my charts freely. So press chart settings right here. And then under continuous auto fit, just press that and turn it off. That way you can drag your charts and it won't automatically snap it back. Little hack for you guys, because it's something that annoys me. So let me show you guys how to actually enter inside of trades just so you have it. I know you guys don't understand what candlesticks are and things like that, but I just want you guys to understand the buttons to press for when you do come back and you know what to do. So you know how to actually enter the trades. So if I think that the market is going to go up right now, I can simply just press buy market. You'll see that I'm now in the trade. You'll see my open P&L. If it's in parentheses, that means I'm in the negative. So right now I'm negative $80, negative $90. But if it does have parentheses, then it will, that's showing that that's how much profit I'm in. That is me opening up one buy market. Because remember, my contract is right here. The amount of contracts that I'm opening up is right here. So I opened up one contract of NQ for buy, meaning I think that price is going to go up from the point that I entered. You'll see the blue line right here that popped up. That is essentially my entry point. So if I enter for a buy, I want the candlesticks to be above and go above the blue line because that means I'd be in profit. Right now, obviously, my entry is right here and price is below it. That's why my open P&L is for a loss right now. But let's say I just want to manually close my trade out because I'm like, okay, I don't want to lose this much money, or this is the maximum amount of money I want to lose. I just want to close this trade out. I can just press exit at market and close. And you'll notice that my open P&L is gone now because I don't have an open position anymore. And you'll see that my equity, since I closed the position out at a loss for like $350, my equity now changed because I lost money. Now, same thing vice versa. If I was to open up a sell market, that means I'm obviously betting on price going down. I would do the same exact process. So right now, the blue line is above where price currently is. So my entry is above where price currently is. So I'm currently floating in profit right now. So if I were to press exit at market and close, I would close out the position at whatever profit I have right now. So let's close it out. I think it closed like break even or whatever. But anyways, you would see if I made profit, I would then have equity put back into my account based on how much profit I made. Now, I can obviously play around with this and I could open up 5 contracts if I wanted to and press sell market. And that will get me into the trade for 5 contracts, which obviously makes the P&L go up and down much faster. You guys understand that now when we talked about going over how to calculate your risk and the tick value of each tick. So obviously the more contracts you have, the higher the tick value for each tick will be. But I'll exit at market and close here. You'll see my equity is down. I just lost 3 for 3. No, but yeah, obviously I'm just joking around, opening up random trades for you guys to see exactly how it looks like to open it. Now, most of the time, you don't need to use buy, bid, or sell ask. Just always, for the most part, just use buy market and sell market. Most beginners are never going to use buy bid and sell ask. For the most part, I don't even use buy bid and sell ask. I'm just buying market, selling market, or I'm using something called a buy stop or a sell stop or a buy limit or sell limit. And we get into that later on inside of this course as well. So one thing that you do need to be aware of when it comes to trading on Tradeovate is there is something called a stop loss, which essentially is something that automatically exits you from your trade that you're in when it reaches a certain point. I told you guys that this ATM thing is how we set that up. So what you'll do is you'll actually come and press settings right here, and you have to set up your own ATM kind of default. Now, how I usually like to do it is you'll press on right here, and you'll ATM name, you can name it literally anything you want to name it. Right now, I'll just leave that blank for right now. Leave it as ticks. You want TP and stop loss. TP simply means take profit. SL means stop loss. Take profit is when it reaches a certain point in profit, close the trade out automatically. I'm okay with that profit. Just close my trade out. Let me take my money. Stop loss is kind of the opposite of it. It's like, okay, if it goes this much in negative, close me out automatically. I don't want to lose any more money. And if it gets to this specific area, I was probably wrong about the trade, so let me cut my losses here. Now, take profit, you'll see it has numbers next to it. This is the amount of ticks that you want it by default to be set to. What I suggest most people do is put this to 50, and same thing with stop loss, put this to 50. This is just default to get it on your charts, and then stop loss type, leave it at stop. So that's it. Now press save here, and you'll see now instead of it saying off, now it has like this ... because I didn't name the ATM at all. But you'll notice here when I press buy market that I don't only have that blue line that popped up, but also these red lines. So if I entered for a buy, the top red line will be my take profit. The bottom red line will be my stop loss. Meaning if price comes all the way up here, it'll automatically exit me out of the trade for a profit. If price comes down here, it'll automatically exit me out the trade for a loss. We'll see if it does it right now. And keep in mind, this is because I entered a buy position. If I entered a sell position, here, look, it might hit my stop loss right here. You see I'm negative 800. Let's see. But anyways, as I was saying, if I enter a sell position, this would be reversed. So if I sold right here, the bottom red line would be my take profit. The top red line would be my stop loss. Now, I told you guys this is just default. You can actually click over here and drag it up and down. What I always suggest is once you enter the trade, drag your stop loss and your take profit to where you actually want it to be. By default, we just set it to be 50 ticks away. But most of the time when you're actually trading, it's not just gonna be 50 tick stop loss and 50 tick take profit. Let's say you planned out your trade on TradingView before you enter the trade and you said your stop loss is gonna be up here for sell, right? And your take profit was gonna be right here for a buy. How I would set that up, so let's exit market and close. How I would set this up is I would say, okay, this is gonna be, I'm looking for a sell right now. This would be my stop loss. This would be my take profit on my sell position. This is just buying up. I'm trying to do an example here, Mr. NQ. So let's say I sold, I press sell market, and let's just do one contract. I press sell market. You see I have green lines now. This just changed based off of you can actually change all this inside the settings, the configuration settings or the chart settings. I forget which one exactly. I think configure chart elements, and you press it and you're able to change the sell fields, profit trades. Yeah, you're able to change it all in here. You can change the colors and all that stuff and play around with it if you want. But let's say as I mentioned, I automatically got entered into the trade and my stop loss and my take profit were put at 50 ticks both ways. I would just drag it to align with my originally planned areas. So I drag, in this instance, my take profit for this sell down to this white line. Then I'll drag my stop loss for this sell up to this white line or wherever I planned my stop loss being at, and then I'm set. So I just have that default 50 ticks ATM settings just so that the stop loss and the take profit lines show up on the charts. And then I drag them to where they're actually supposed to be. Now I want to show you guys an example of this actually hitting the take profit. So let me just drag this super close, and you'll see when price touches it, it automatically takes me out the trade for a profit. and you see it closed the position out, and I actually made money on that because it hit my take profit. Now it would be the same exact thing if it hits my stop loss. This is a sell. So if it hits my stop loss here, let's say it comes up here. If it's going to come up here, it's not going to come up here. It's just selling down. Anyways, you guys understand what I am saying. But that is essentially all the things you need to know when it comes to trading on TraderVate. Now, when we go over how to use TradingView, you'll see that you can actually connect your TraderVate to TradingView and trade directly from TradingView as well. And we'll go over how to do that in the course video on how to actually use TradingView. But if you want to use TraderVate, this is exactly how to do it. This is how to set up your charts. This is what all the buttons mean. This is how to enter trades, exit trades, everything like that. So first of all, what is TradingView? TradingView is a platform that us as traders go to plan out our trades. You can actually plan out your trades. You can practice your trading on there. You can enter your trades straight from TradingView. It's kind of like the hub that every serious trader uses. Now, when you first come to tradingview.com, you're going to come to this screen right here. It might look a little bit different based on when you actually come to it. They might change this picture of this spaceship dude above the world. I have no idea what this has to do with trading, if I'm being honest. What does an astronaut over the world have to do with trading? I don't know. It doesn't matter. But either way, you'll be on this page right here, and you'll have the option to get started for free. But the first step you want to do is to create an account. Now, you'll press get started here. You'll have a bunch of different options. For now, you can just get started for free. You can get a free trial for 30 days on either one of these plans. We'll go over the plans later on, but you can get started on either one of these plans for 30 days for free or get the top plan for 14 days. But just go ahead and create your account. They're going to ask for super simple information. You can sign up with your email address, with Google, whatever it is. So I'm going to log into a fresh account right now so we can start going through the walkthrough. All right, so once you've created an account, you'll see that this will pop up on the side here. Right now, I have a 30-day free trial on this fresh account that I made. But what we're going to do is hover over products and press super charts. This is going to take us to our charts at the moment. Now, you're probably looking here, it probably looks super confusing. I'm going to break all this down so you understand exactly what you're looking at and how to get the most out of it. So first, let's start over here. As you see here, this is a watch list. You'll see a bunch of different names here, or tickers as we call them. These are simply different charts that you can go to. So SPX is the chart for essentially the S&P 500. NDQ is the chart for QQQ or US 100. And here's just, you have stocks. These are just like base ones that are here. But we'll talk about a little bit later on how to create your own watch list. But that will allow you to go to the actual pairs that you want to look at. Like here you see we have cryptos, we have Forex, we have futures, stocks, all these things. You're probably not trading each and every one of these, so you probably want to create your own watch list. But we'll get into that a little bit later on. This part right here that you see, this is the chart. This is where you're actually going to see these things called candlesticks. We're going to go over a high-level overview of what candlesticks are and how to understand them in a second. But let's finish going over the tools. So on the left side panel, you'll see your name up here. You'll see your profile. You'll be able to go to your settings and everything like that. And then right next to that, this is the symbol that you're on right now. So the chart that we're looking at, we're currently on NDQ. If I press this right here and type in, let's say BTC, I can actually go to the Bitcoin chart. So here, now I'm looking at the chart for Bitcoin. You'll see over here this plus button. You can actually press this plus button and add something to compare your charts to. So right now we're on Bitcoin. We can compare it to SPX, which is the S&P 500, and you'll see it'll pop up right here. But realistically, I don't ever use that ever, if I'm being honest. Right next to it, you'll see the time frame. So when we go over candlesticks, you'll understand time frames a little bit more. But right now you see it says 1M, meaning we're on the 1 minute time frame. So each of these candlesticks represent what happens in 1 minute. If we click on it, we have a bunch of different time frames we can go to. If we want to go to the 5 minute time frame, we can just press 5 minute, and each of these candlesticks represents what price has done in 5 minutes. We can go to the 1 hour chart, the daily chart, the 1 week chart, the 4 hour chart, whatever it is, you have full range to do that, and that's where you do it at. Now here next to it, you'll see the symbol of some candlesticks. If you click on it, this essentially allows you to choose what type of chart you're looking at. Right now, we're on Heikin-Ashi charts. We can press line charts, and you'll see we're now looking at line charts. We can press it and go to bars charts. We can press it and go to so many different charts. But for now, let's just go to regular candlestick charts. Next to that, you'll see indicators. Indicators, think of them as like sidekicks. They help you see what price is trying to show you, but they put it into a different viewpoint. And I'll give you guys examples of that a little bit later on inside this video. But indicators are, a lot of people come into trading and they think that indicators will tell you when to buy and they tell you when to sell. That's not what they're for. They're meant to use together with the strategy that you trade, in addition to the strategy that you trade, to give you more confidence in the trade. But that's indicators. And when you click it, you can search a bunch of indicators. There's so many different indicators here that you can pick through and play around with. But right next to that, you'll see these 4 squares. What this lets you do is have templates for your indicators. So if you always use 10 different indicators, you can create a template. That way, every time you load up your charts, it's there. The same indicators pop up. Here you see there's alerts. This is something that I use a lot. So when I'm trading, I'm not sitting here looking at my charts all day long. I'm waiting for price to like get to certain points before I actually enter into trades. And these alerts allow me to do that, because if I press alert, I can actually add alert at any area on the chart that once it hits that area, it'll actually send me a notification to my phone. Now, for example, here, you want to set this up though, where next to notifications, click it, and you want to make sure it says notify in app. That way, when you have the TradingView app downloaded on your phone, you'll get a notification to your phone that's saying, okay, Bitcoin is at that price. Maybe you should try buying now, or maybe you should look for a buy. So that's something that I use a lot, alerts. Now, replay feature, this is for testing. I told you guys that on TradingView, you can test your trading out. You can do something called back testing. We're going to get into how to do that a little bit later on in this video, but this is how you do it with this replay feature. And then here you have undo buttons. You can undo, you can redo, whatever it is. And that's essentially this entire top bar up here. Over here, you can actually change the chart layout. So if you look at this square, you can actually press this and have 2 different charts next to each other. Right now, I guess on the subscription that I'm on, which is the basic subscription, it doesn't let you do it. But if you had upgraded, you'd be able to have 4 charts on the same screen. So for example, you'd have one chart here, and then you'd have another chart here, and it can all be a bunch of different charts. So that's just one thing to keep in mind. You can change that here. This right here, you can create layouts for your charts itself. We'll get into customizing your charts in a second here. And then here is just some other quick search tool. You have your settings tool. You have full screen mode if you wanted your charts to be full screen. You can take a screenshot of your chart. And then here's the trade button, where if you actually wanted to enter trades, I told you guys you can actually trade straight from TradingView. Like I said, we'll get to that later on in this video. I know it's a lot that we'll get to later on in this video, but we will get to it and you'll see exactly how to do it. Now, if we come over here to the left side panel, this is where you have all your drawing tools, meaning you can press this right here and draw a line on your chart, or you can press the arrow next to it and you have a bunch of other things that you can draw. Same thing on all of these. They have a bunch of different drop downs for a bunch of different tools that you can use. And the cool part is, if you always, let's say, use this trend angle, if you hover over it and press this little star button, it'll add it to your favorites. And when it adds it to your favorite, it'll hover over here. So let's say I always use a ray. I always use a parallel channel. Let's say I always also use a brush all the time and an arrow marker. You see it added it to my favorites over here. That way I don't have to search for it over here through the tools. I can just click up here and use whatever it is that I'm trying to use. Let me delete all of this. So yeah, that's something cool to keep in mind. These are all a bunch of tools that you can play with. You have text and things like that. You have emojis here, even though I don't know why you'd want to put emojis on your chart. To each their own. You have this ruler icon as well, where you can technically measure how big a candlestick is. You have a magnifying glass, magnet tool, a bunch of different tools here. Obviously, your remove objects button here as well. A cool little, I guess, tip or trick for you guys is if you use a mouse when you're actually like trading, if you press the scroll button down, that will actually delete whatever it is that you're hovering over. So let's say I have a drawing right here and I want to delete it. Instead of manually pressing on it and pressing the delete button, I can just press that scroll wheel and it'll delete it. That's a super quick tip for you guys. I have a bunch of actually quick tips for you guys that you guys probably would assume, because I've been doing this for 8 years and I spend hours a day looking at this platform. I know the ins and outs of it. I feel like I know it better than I know myself at this point. But anyways, on the bottom of the scroll wheel here, you'll see what time of day it is. So you'll see this is 9 a.m. over here, 10 a.m., 11 a.m., 12 p.m., 1 o'clock, all that stuff over here. Now, that's essentially a lot of the main features that you're going to see on TradingView as far as the tools and the different things that you need to understand to even be able to really see what's going on once you're on this platform. Now, we talked about these candlesticks. I just want to break these candlesticks down for you very, very quickly. So basically what these candlesticks are, it allows us to see where price is at the current time and what price has done before. Right now, if you remember, we're on the 5-minute time frame, meaning each of these candlesticks is telling us exactly what price has done through the last 5 minutes. Now you'll see they're all different shapes and sizes. You see we have these sticks on the bottom. We have these thick parts. They're all different colors. So what does this mean? What are these candlesticks showing us? Let me break it down for you simply because a lot of people made it way too complicated when I was first starting off. So these skinny lines that you see, those are called wicks. The thick part that you see, that's called the body of the candlestick. So you'll see we'll have wicks on the top, wicks on the bottom. Simply what these wicks are showing us is showing us that price at one point was down here and price at one point was up here. So during this entire 5-minute candlestick, because remember, each of these candlesticks is showing us what happened during 5 minutes because we're on the 5-minute time frame. Price was up here during this 5-minute interval and price was down here. Now on green candlesticks, the bottom of the body, that's where price started at. So let's imagine this is the 10 o'clock candlestick right here. 5 minutes passed, this one ended, and at 10:05, this candlestick started. So at 10:05, price was right down here. And this is 10:05. So when 10:10 happens, the next candlestick would print itself. And as soon as the next candlestick prints itself, this candlestick will close. And on green candlesticks, otherwise known as bullish candlesticks, the top of the body is where price closed at. So it started down here at the beginning of the 5-minute interval. And at the end of the 5-minute interval, it ended up here. Now it's vice versa with bearish candlesticks or red candlesticks, meaning the wicks mean the exact same thing. Price has been down here and price has been up here. But the difference is the top of the body is where price started at and the bottom is where price ended at. I want you guys to see this. So we started up here. Price had went up here at one point. It went down here at one point. But when this 5-minute candlestick ended, it ended right here. And then as you see, the next candlestick started at the same place that the previous candlestick ended at. That's why price started right here. And this candlestick looks like it's going to end somewhere around here, meaning it's going to close up here. Now, that is the same exact thought process when it comes to all of these candlesticks. So for instance, this candlestick started right here. It went down here at one point and it closed all the way up here. Then the next candlestick started where the last candlestick ended and it closed down here. And you'll see these all throughout, and that's how you get these different shapes and sizes on your candlesticks. Now, I mentioned before that we would go over indicators. Indicators are meant to be used to help you. If you've been looking on the bottom of my charts, you can see this down here where you see green and green and red, all different sizes, right? This is actually an indicator. It's called a volume indicator. This is showing us, okay, how many people are actually buying versus how many people are actually selling. If we look at this part on the indicator, you see it's a huge green candlestick, which is simply showing us that there's a huge amount of buys. And as you see, it's aligned with the candlestick on the actual candlestick on top of it. And you see how big this candlestick is? That's showing us that there were a lot of buyers in here that caused price to go up. If we look here, we have this candlestick right here, or this indicator right here with a big red bar showing us that it's a lot of sellers right at this time. If we line it up with the candlestick above it, so if we line it up, it's talking about this candlestick. So this candlestick, even though it's not much bigger than this one, this still had a whole bunch of sellers in it. So this is just one indicator. If I'm being honest, I don't really use this indicator too much. So what you can do if you don't want this on your chart is if you click on it, you can actually just press delete. Now, if we press indicators here, I told you guys there's so many different indicators. You have your technical indicators, which is just like indicators you'll see pop up on your chart. Like, for example, we can press this moving average exponential and you'll see this line pop up. You can type in any indicators that you might find on YouTube or that your friend might have told you about, or if you watch any of my other videos, I talk about indicators that I use as well. You can type it all here as well. You can also create your own indicators if you are a coder. You can implement it straight into TradingView. I'm not a coder. Then they also have like some fundamental indicators, which is simply just showing us more news related indicators or indications. But most of the time you'll stick to technical indicators if you do end up even using indicators in itself. Like I said, it's not a necessity, but it is something that can be helpful in your trading. Now, one of the cool things about TradingView is that basically everything here is customizable, and I've customized my charts to look a lot better than what this looks like. This is just plain with like this white background, these candlesticks. You can actually change all of that. So if you press your name here on the top left corner or the picture of your name, you can actually change it to a dark theme by hitting this switch. Just press yes. You see everything went black, right? Which to me is a lot cooler. You can do whatever you want to do. You can keep it on light theme, but then there's also so much more that you can adjust. Let's actually delete this indicator. One thing I forgot to mention, when you do put an indicator on, it'll pop up down here and you're actually able to delete it with this button right here. And you'll see the indicator left the screen. But you're actually able to right click on your screen and press settings and customize essentially everything on the chart. So if I wanted to change the candlesticks, I could change the body of it. Remember, we talked about the body of a candlestick versus the wick of the candlestick. If I want to change the body of the candlestick to purple, right? Keep in mind, this first one is always going to be the bullish candlesticks, meaning the candlesticks that go up, or the candlesticks that were green. So if I wanted to change my green candlesticks to purple, this is the one I would change. If I wanted to change my red candlesticks to, let's say, I don't know, yellow, I could do that as well. And then I would just mimic that color across the board so that all of the colors are, I think I chose the wrong colors if I'm being honest, but it doesn't matter. So that all the candlesticks look the same. I can make it look like this, a little bit of Kobe action here. You can change it really to whatever you want, and then you can actually save it as a template as well. So every time you open up TradingView, it'll look like that. This is a super ugly colorway, so I'm gonna actually delete that. But if we go back to settings, we can change the status line, which is essentially this over here. We can change a lot of the things up there. If we want to take things off of there, we can do that as well. Super customizable. The scales and the lines is essentially this over here and this down here. We can change so many things about it. You can play with it if you want to. I really don't play around too much with it. This is perfectly fine to me. Most of the time I just change my background and I change the colors of the candlesticks. You can go to canvas. You'll notice here these white lines that you have here. A lot of people don't like them. So the way to take that off is if you actually look at grid lines right here, you can just press none and that'll turn that off. So if you don't want that, you can do that and just press OK. And there's just so much you can customize with it. So definitely if you're the type of person that I guess wants to make it your own, play around with it, change the colors of the candlesticks, change the chart type. It can make trading a little bit more fun versus just staring at a bland white chart with green and red candlesticks. All right, so now that you understand how to use TradingView, you understand all different tools, you know how to change the colors of your candlesticks and add indicators, let's go into how to test your strategy on here, how to back test. So I mentioned this tool over here called the replay feature. If you press this right here, you'll notice this blue line will now pop up. What this allows you to do is, let's say if I were to click right here, it would delete all the data after that. So it would delete all of this right here. Let's click it. It's going to make me upgrade right here. I think if I press this, it'll just, I'm a non-professional. Basically, almost every single person watching this would be a non-professional. I just press confirm really quickly. Actually, let me just log into my other account versus doing all this. Because if you want to use that replay feature, you're going to have to upgrade your subscription, whether you pay for it or you use a free trial. But let me just go into my actual TradingView account now to walk you guys through all that. All right, so here we are. As I was mentioning, when you press this replay feature, the blue line will pop up here. And let's say I wanted to click right here. You'll see it deleted all that data before it. Now, the reason why that's cool and very important is that as traders, we need to practice our trading. But if you just scroll back and you're like, okay, I would have sold right here because I saw this red candlestick. But the only reason you're saying you would have sold right here is because you already saw that price continue to sell down to the downside. It just gives you inaccurate confidence in your trading. So in order to do it legitly, you have to go back in time so you can't see what happens after it. And that's how you are able to practice it. But like I was saying, once that blue line pops up, you can literally just click anywhere and it'll delete all the data before it. So you can't see anything before it. And then what you're able to do is either press this play button and you'll see the candlesticks will then start to move and start printing. Or you can press this forward button where it'll just go by one candlestick at a time. It'll fast forward one candlestick at a time. Because here, when I press play, as you see, it went very fast. You can change the speed, how fast it goes, by changing this down here. If I wanted to change it to, let's say, 1, you'll notice that when I press play, it goes a lot slower. Or you could press this button right here and just fast forward individually yourself, candlestick by candlestick. And then also this right here, you're gonna see 1 hour. This is simply the interval that is gonna fast forward. So if I press skip fast forward one time, it's going to go fast forward one 1 hour candlestick. And the reason it does that is because I'm on the 1 hour time frame right now. If I go to the 5-minute time frame, you'll see this will change to the 5-minute, meaning it'll print a new 5-minute candlestick again. Now you can actually change this setting if you wanted to. I suggest to keep it kind of in sync with whatever time frame you're on, because it makes it much easier. But then you have this button right here. This essentially will just jump to real time, meaning it'll end your replay session, so you're not in backtest mode anymore. Now you can get out of backtest mode again by just pressing replay again, and it'll close all that out. But that is essentially how you're able to use the replay feature to be able to backtest any strategy that you want to backtest without you being able to cheat, because you already know what's going on, because you already see all the candlesticks. All right, now you know how to backtest, but that's fake money, essentially. That's practicing. I told you guys before that you're actually able to trade directly from TradingView. So let me walk you through exactly how to do that, because that's really how I trade majority of the time. Over here, if you remember, I said you have this trade button. You could just press trade right here, and a bunch of options will pop up to link your broker. Keep in mind, TradingView is a platform. It's a trading platform. It is not a broker. A broker is essentially the platform, or like your bank account. That's where your money is held. That's where you're actually taking the trades at. But if you have a broker already, and I've made so many videos about setting up your broker, this is the broker that I personally use, Tradeovate. But if you have your broker already, you can simply just press it and it'll ask for your login instructions. Let's say my broker is TradeStation. I can press TradeStation and I can choose whether it's a live account or a demo account. And let's say it's a live account, I'll press connect. And then it'll prompt me to log in on my broker account. And once I'm logged in on my broker account, I'd be able to actually trade straight from TradingView. Now, I'm going to show you guys exactly what it looks like when you're trading is from TradingView. But let's just go on this paper trading right here, because TradingView does have a paper trading feature, which allows you to demo trade or trade with fake money, so you can practice actually trading. And I do suggest that for definitely all new traders, they should be on the demo account just to start off. So let's press paper trading, because it's going to be the same exact layout versus if I had logged in on any real brokerage. So we'll press paper trading right here and just press connect. You'll see this panel will pop up down here, and on this panel, it'll show you your account balance. Keep in mind, this is all fake money here. Account balance, it'll show you your equity. It'll show you your realized P&L, which is your profit and loss on your demo account. Or if you had your real account connected, it would show this information as well. Your margin, available funds, all those things. Also, if you're in a trade, it'll show your positions down here. You can look at your order history, which will show you all your trades that you have taken. You have balance history, which is showing you your realized P&L based off all the trades. And yeah, it has a trading journal here as well. So this is essentially the pop-up that pops up when you connect whether your brokerage or your paper trading account. Now, what you can do right now is just minimize that, because I want to show you guys exactly how to even enter trades itself. So it's very, very simple. Once you've connected your account, you can actually see that this buy button and this sell button are actually connected now, meaning you're able to actually press it. And when you press it, it'll enter you into a trade of whatever stock or crypto you're on right now. Right now, we're on the Bitcoin chart. So if I press buy right now, you're going to see I get entered into the trade. This blue line will pop up, and this is showing me my profit or my loss at that moment. Right now, I'm negative $250 currently, which this is fake money, so I don't really care. Now I'm negative $17. Now you'll see to the side of it, you have SL and TP. This simply stands for take profit and stop loss. The cool thing about it is if you press, let's say stop loss, if you don't know what a stop loss is, this is simply like you putting protection where if it gets to a certain point in the negative, the trade will automatically close you out and stop you from losing too much money. That's what a stop loss is. Take profit is the opposite of it. A take profit is essentially where it's like, if price hits this profit level, it'll take me out of my trade because I'm okay with that profit level. But like I was saying, if you click and drag, let's say stop loss, and drag it down, this is exactly where price would get me out of the trade automatically, because I set my stop loss. Same thing with take profit. If I drag it up, if price taps where I dragged it to, it would get me out the trade automatically. I can try and simulate this. So I'll drag it closer to where price actually is. We'll see if price taps it. Oh, price tapped it. So this took me out the trade automatically, and that closed my trade out. Now, if I press this button down here to open back up my chart, I can see that my trade was already taken. I can go to balance history here and see that this is the trade that I had taken, the day and the time I had taken it. my realized profit and loss, meaning how much I actually closed the trade for. And then when I'm in a trade, if we go back to positions, let's just press buy. So I'm in a trade. You'll see it pop up right here. This is the trade that we're in. You can see we entered at this price. This is our unrealized P&L, meaning we haven't closed the trade out yet. Our market value, our leverage, all those things. You can see all your data here when you actually are trading it. Now, a cool little tip as well for you is we went over the drawing tools and things like that. We didn't dive into any specific ones, but these are the ones that I use the most, which is a long position tool and a short position tool. When I'm looking for buys or I'm planning out my trades to be a buy, I would use a long position tool. When I'm planning out my trades for a sell, I use a short position tool. Now what it does is, let me click it right here. Imagine I'm saying I'm gonna buy it right here. I click exactly where I'd buy it. You're gonna see this green box pop up and this red box pop up. Now, this is a symbol of my take profit, or I guess a drawing of where I'd put my take profit and where I'd put my stop loss. The red is obviously my stop loss. The green is my take profit. So what you can do is, let's say I'm planning, since I entered the trade here, if price sells down here, I want to close my trade out at a loss right here before I lose too much more money. And then same thing with a take profit. If I drag it, let's say right here, this is where I'm planning to take profit at, because at this point I would have made enough money. That's what I like. Now here you'll see some stats on the long position tool. You'll see risk to reward ratio, which simply means that if price hits my stop loss, I'm risking whatever amount, but if it hits my take profit, I'm making the same amount. I guess for a better example, if I drag my take profit up and you see this goes to a 2-to-1 risk to reward ratio, if price hits my stop loss, for example, let's say I'd lose $100, but if it hits my take profit, I'd make 2 times as much as I'm risking. So in this example, if I'm risking $100, I'd make $200 if it hits my take profit. So this tool is really just used to plan out your trades. You drawing this on your chart does not enter you into a trade. It doesn't do anything. It just lets you plan out your trade. But what you can do is, if you right click on it, you press create limit order, it'll actually fill out all this information for you. That way it has your entry, it has your stop loss, and it has your take profit automatically, and you could just press buy. That way you don't have to press the buy button and then drag your stop loss and then drag your take profit. That's just another tip for you guys that I use a lot when I'm using TradingView. All right, so now you know all the tools, you know all the features, you know how to customize it, you know how to back test, you know how to trade. Let's go back to the part about subscriptions. I want to dive into that, and there's a couple things that you actually have to do before you can actually start trading on here. So if we press our name over here and we hover over it right here, we actually should go into settings and billing. But the reason we need to go into settings and billing is because if you plan on trading in the futures market, or you plan on trading stocks, or you just plan on trading futures itself, you need to buy something called the market data subscription. If you don't, when you go to any futures ticker, let's say a futures ticker is NQ. If you go to NQ, the candlesticks are going to be delayed, meaning right now it is 3:36. But it would show you the candlesticks from like 3 o'clock. You would not be able to see the current candlesticks because your charts are delayed. In order for it not to be delayed, you need to purchase real-time market data. And this is how you do it. Like I said, you hover over your name, go to plans and billing, and then you want to go to subscriptions right here. And then you want to get real-time market data. I always suggest, for me and all my other students, I suggest for them to get the CME group, just because it allows you essentially to have real-time market data on basically every major futures pair if you do plan on trading futures. So that's what you're going to need to get. And as far as your plan, right, there's multiple different plan options that you have, as we've went over before. Realistically, for most beginners, the essential plan is going to be enough. There's obviously, you can go through all these different things and choose what you feel like you need the most, but essentially the essential plan, no pun intended, is enough for most beginner traders. When you get more complex, or you're taking it a little bit more serious, you can then go and choose any of these other plans. Like right now, I day trade full time, and I've been doing this for 8 years, and I'm only on the premium plan. I'm not even on the ultimate plan. For the longest time, I was actually on, I believe, the plus plan or the essential plan. I think it was the plus plan. But like make your own decision on what you need. You can look at all the different stats and things like that here based off of what you need. But like I said, the majority of the time, if you're a complete beginner, the essential plan is enough. And make use of that free 30-day trial and get the most out of it. All right, so I know we already went over candlesticks pretty briefly on the trading view video, but I just want to give you guys more of a deeper dive on it to make sure you guys fully understand it. As I said, many people make it way too complicated, but I just want to make it as simple as possible for you because it's really not that complicated at all. So we're going to dive super deep into it, and you guys are going to have a bit of a cheat sheet to kind of just be able to screenshot, print off if you want to have it, so you know exactly what candlesticks mean and you just learn it much quicker and much more efficiently. So first of all, why do we even use candles? A candle is the market shouting who won, meaning did buyers win or did sellers win? So line charts show one number per period. Candles are going to show 4. It gives us way more data using candlestick charts than line charts. You're going to see the open, the close, the high, and the low at a glance without having to go too much into the weeds and look too long for it. That's what the benefit of using candlestick charts versus using regular line charts or things like that. The shape tells you the fight. It tells you who controlled and who pushed back. This is how I like to look at candlesticks, essentially the bulls versus the bears. We kind of hinted on bulls and bears means, or bearish market or bullish market means. So a bearish market simply means that the market is going down. So bears are winning or sellers are winning. A bullish market means the market is going up, or bulls are winning, or buyers are winning. So I like to just have that concept in my mind because that's helped me learn it a lot quicker. But once you can read one candle, you can read any chart. And that's why it's so important that you guys understand it, and why I just wanted to dive even deeper into it. So here's the anatomy of a candlestick. As I mentioned, every candle is going to tell you 4 things. It's going to tell you where price opened, meaning where price started at, where it closed, where it ended at, the highest point it went, and then the lowest point it went. So on a bullish candlestick, which is a green candlestick, the bottom of the body of the candlestick, that's the open. The top of the body of a bullish candlestick, that's the close. Then the highest point of the wick, that's the high that it went. The lowest point of the wick, that's the low that it went. Now, it's the same thing on bearish candlesticks, except the open and the close are flipped. So the open is going to be, or the start of the candlestick is the top of the body of the candlestick. The close is going to be the bottom of the body of a bearish candlestick. Now, when it comes to the wicks, it's the exact same. The bottom wick is the lowest point it went, and the highest wick is the highest point that it went. So bullish candlesticks, bearish candlesticks, this is your cheat sheet right here. Take this, print it off if you want to, and you'll be able to learn it a lot quicker. Now, green versus red. This is super simple, but just in case you don't know, green candlestick, buyers are in control. Closed, finished above open, meaning where price started at, price ended higher. That's bullish for this candle. A bigger body means a stronger move most of the time. And later on inside the course, we'll go over candlestick patterns, because there's certain looking candlesticks that give us kind of looking into the future of what could happen next. They show us patterns that allow us to know, okay, the market is probably going to go up after this candlestick, or it's probably going to go down after this candlestick. We're going to go over candlestick patterns in a second here. But just in simple terms, a bigger body equals a stronger move. Now, red candlesticks, that means sellers are in control. That essentially just shows us that the close, meaning the ending of the candlestick, finished below the beginning or the open of the candlestick. So like you'd say, this candlestick was bearish. Now, a bigger body, obviously same thing, means a stronger move. So just be aware of that. All right, so now what does the body of the candlestick tell us? I kind of hinted on it already. If we see a big body, regardless if it's bearish or it's bullish, it's just showing us that there's a strong move. It's either that if we have a big bullish body, there's a lot of buying pressure to the upside. If we have a big bearish candlestick, there's a lot of strong momentum to the downside. Now, a small body just signifies it's a weaker move, meaning there's more indecision. Neither side won by too much, meaning the bulls didn't win by too much or the bears didn't win by too much. Now, if you see a tiny body or essentially no body, that's a doji territory. And we get into what dojis are later on inside the course. That's just a candlestick pattern that shows us what indecision is. It's meaning it really just shows us that price opened and closed basically at the same exact point. It could have had big wicks to the upside or downside, but essentially it opened and it closed at basically the same exact price. Now, what do the wicks tell us? Because the wicks do tell us an important story, and you need to be aware of it. So if we have a long lower wick, buyers stepped in because it's showing us that price tried to go down to an area, but it couldn't stay below there. So it created a huge wick to the downside, but ultimately the body of the bullish candlestick finished higher than it started with. So that's just showing us that sellers pushed price down, but buyers rejected the move and pulled it back up. It's a bullish signal at the bottom of a downtrend. It's a great candlestick to see if you want to look for buys. Now, vice versa, if we see a long upper wick, meaning there's a huge wick on the top, that means sellers stepped in after buyers tried to push price up. So let's say we had a huge wick to the upside, but price still ended up closing bearish and closing below where we opened at. That's just showing us that price tried to buy up, but all the sellers and all the bears stepped in and sold price down, signaling way more stronger bearish momentum. If you're looking for sells, that's kind of the candlestick that you'd want to see. So one candlestick has 4 prices on it. It's going to tell you the full story of the entire fight. Green or red, that tells you who won. The body is going to show you essentially how strong or how much they won by. And then the wicks tells us who got rejected, essentially who tried to win and won for a little bit, but ultimately ended up losing. If you can master this, then patterns make sense, candlesticks make sense, charting makes sense, and you will be able to predict the markets. All right, so now let's go over candlestick patterns. So there are 5 patterns that actually matter. It's kind of the main patterns that most people look at. And I'm going to show you guys real examples here on the slideshow. And I'm also going to go on the charts and show you guys them as well, so you guys see them live in action, essentially. So why do patterns work? First of all, patterns are humans repeating themselves. So every pattern is a footprint of a buyer versus a seller battle. As we already talked about, the candlesticks show us who won the battle, who lost the battle, who was winning the battle, who ended up ultimately winning it. So same battles repeat at support, resistances, and trend turns, meaning if we're trending to the upside, we'll see certain patterns that tell us the trend is about to end. If we're trending to the downside, we'll see certain patterns that tell us that that trend is about to end as well. So context is everything. The same pattern in the middle of nowhere is noise, and we'll go over that on the charts here in a second. And confirmation matters. So one candlestick alone is a guess. When you can have 2 candlesticks that tell the entire story and give you more confidence, that is a signal. So if you're able to see 2 candlestick patterns that align, it just can make you feel a lot more confident about what's about to happen next. But I'm going to show you guys these candlesticks first, why they work, the signal, and then also when it fails. So first of all, the first candlestick pattern I'm going to show you guys is the hammer candlestick. This is a bullish reversal candlestick after a downtrend. So the signal, meaning what it looks like, it's a small body at the top with long lower wicks. This essentially just tells us that buyers crush the sellers. Now, when does it work? It works when you see this at the bottom of a downtrend near support or with extra confirmation. So in this example here, you see we're trending to the downside, and then we got the hammer candlestick, which is a small body at the top of the candlestick, with a long wick on the bottom. Once we got that, price started going up, and we'll show examples of this on the chart as well. Now, when does it fail? It fails in the middle of a range with no follow through, meaning if price was just chopping up and down, consolidating, as we went over before, you seeing a hammer candlestick is not going to be that confident, right? Now, let's go to the shooting star, which is essentially the opposite of a hammer candlestick, meaning we have a small body on the bottom with long upper wick, just like this. That just tells us that sellers crush the buyers. When it works is the opposite of when a hammer candlestick works. So it's going to work when price is trending to the upside, and then we get a shooting star candlestick, and that's telling us that price is probably about to reverse to start going back down. Now, it fails at the same point. It fails in the middle of a range when there's no follow through, or if it's in the middle of a trend itself. So that's the shooting star candlestick. When we see a shooting star candlestick, we should be looking for sales because the market is probably about to reverse. Now, here's a bullish engulfing, and how I think about engulfing, because there's bullish and bearish, which we'll go over in a second. A bullish engulfing simply means that the bullish candlestick basically is bigger than the bearish candlestick that was before it. So in this example, you see the candlestick is this small, and then we have a bullish candlestick that is much bigger than that one. I think of it like it ate the other candlestick, or it could eat the other candlestick, how big it is. But that's how I think about bullish engulfings. Usually after we get a bullish engulfing, price will continue to go up to the upside. Now, it works after a clear downtrend. When it fails, it's going to be kind of the same point as the other candlestick patterns, it fails in choppy sideways action. If we're just consolidating, seeing an engulfing candlestick does not really mean much at all. Now, bearish engulfing is the opposite. We have a bunch of bullish candlesticks, and then we have a bearish candlestick that is big enough to eat the bullish candlestick that was before it. And this just signals that price is about to go back to the downside. Again, this works when there's a clear uptrend, meaning we're trending to the upside clearly. And then if we see a bearish engulfing, that tells us that price is about to start reversing and selling to the downside. It fails in choppy sideways action once again. Now this right here is probably my favorite candlestick pattern to see, which is a doji candlestick. Essentially what it is that the open and the close are nearly identical. We kind of hinted at this a little bit earlier, but it has a small body, a small skinny body, and long wicks on the top and long wicks on the bottom. Now it doesn't have to be exactly the same size wicks on the top and bottom, but you do want to see it have wicks on the top and wicks on the bottom that are decently long. And then you want that doji to be pretty small. It doesn't have to be a thin line like this. And I'll show you examples on the chart here, because these are all obviously just examples. On the real charts, you're never going to get these picture perfect ones, or you'll rarely get the picture perfect ones. But anyways, onto what the doji simplifies or symbolizes is that there's indecision. So if we've been trending super hard to the upside, like in this example, we're trending super hard to the upside, and then we have a doji candlestick, which shows us that there's indecision. That tells us that the market is indecisive here, so it's probably about to reverse. No matter what direction it's going in, if you get a doji candlestick, that's showing that it's probably about to reverse to go the opposite direction. So again, it works when there's a strong trend, regardless if it's a bullish trend or a bearish trend. When it fails, is inside a tight range. So if there's a lot of consolidation happening, or there's not a lot of volume, meaning the market isn't moving a lot, doji candlesticks aren't going to be very helpful at all. But just be aware of that. So here's your little cheat sheet that you can print off or tattoo on your forehead if you're into that kind of thing. You have your hammer candlesticks, your bullish engulfing, your shooting stars, your bearish engulfing, and your doji candlestick. Now, the rule is that patterns at key levels matter. In the middle of nowhere, they are just candlesticks. So don't wholeheartedly just rely on these things. When you see one, don't automatically buy or automatically sell. They are extra confluences or extra things that can give you more confidence in where the market could be going. Now let's go into the actual charts. I haven't picked out like any examples. I'm just like on the charts because this happens so frequently. I just want to show you guys realistic examples here on actual candlestick charts. So let's look right here. The market was buying up very strong, and then what did we end up getting? We got a bearish engulfing. This candlestick right here is obviously bigger than that candlestick before it. It could essentially eat that candlestick before it. And then what ended up happening after we had our bearish engulfing? Price ended up selling to the downside. Very simple example of a bearish engulfing. Now, if we zoom out here, we can see a bullish engulfing right here. And you're going to see these patterns like show themselves very, very, very frequently. So you see we're trending to the downside here. Then we had a bullish engulfing, meaning this bullish candlestick is much bigger than that candlestick before it. And what ended up happening after we had a bearish engulfing? A bullish engulfing. Price started to go up. That is simply showing us that we had that bullish engulfing come in. Markets had a lot of buyers in this area, and that pushed the market to the upside. Now, let's look here. We see we have a hammer candlestick right here. Remember, hammer candlestick is when price has a small body at the top, long wicks on the bottom. We're trending to the downside here. We had a hammer candlestick right here. Price started going up. Even though it's red, it's still showing us that we have a lot of buyers in control because sellers tried to come down here because the wicks are long to the downside, but they couldn't hold below here. Buyers ended up buying price back up. And then what ended up happening? Price started going back to the upside after having this hammer candlestick. Now let's see if we can find a shooting star. Here's a perfect example of a doji actually, since we're here. Price is going to the upside right here. We have a doji candlestick right here. We have long wicks on the top and long wicks on the bottom with a skinny body. As I mentioned, it's not going to be picture perfect, meaning you're not going to always see the same size wick on the top and the bottom. But generally, you just want to see long wicks on the top and the bottom with a small, skinny body. And that is what this is showing right here. Then what ended up happening after the doji candlestick? Price started selling to the downside. Now you're going to see this on multiple different time frames. Like right now I'm on the 15-minute time frame. I can go to like the hourly time frame if I wanted to. Again, we see price selling to the downside. We got a doji candlestick, price started going up. I'm trying to find a shooting star candlestick here. If I can find one. Another doji up here, price is buying to the upside. We got a doji, price started selling to the downside. Now here is a shooting star candlestick right here. We have a long wick on the top and then a small body to the downside. Now this isn't really a good example, even though price did end up selling to the downside. Reason being is because we were just chopping around in this area. Like we weren't trending. Remember, these don't work very well when you're just chopping around or there's no clear winner. In this example right here, there's really no clear winner. Yes, we did get a shooting star and it ended up selling off right after that, but that's not going to happen all the time. You just need to be aware of that. Let me see if I can find a nice example of a shooting star candlestick here, right at a pivotal point. Market's been pretty bullish if I'm being honest, so shooting stars are not really going to happen. So we see here's an example where price bought up here. We have a gap here. That just means that price bought up really, really fast. And then we got the shooting star candlestick right here, small body at the bottom, long wick at the top, and price sold back down. And honestly, if you open up your charts and you just scroll through it, you're going to see so many different examples of dojis, so many different examples of bullish engulfings, bearish engulfings, shooting stars, hammer candlesticks, and you'll start to see how it makes sense and can help you predict what's going to happen next. Like price bought up here, bearish engulfing, price sold to the downside. And I want you guys to put in the time here to actually go and look for these different patterns and see how well they work, because these things should automatically stick out to you. Like I can look at this chart and see so many different examples, like sold down here, another bullish engulfing, bought up here, doji candlestick, bearish engulfing. Like these things just stick out to me because I've just spent so much time on the charts. That's how I want it to be for you guys. So put some time in and actually just run through the charts and look for the 5 different patterns that we just went over. And you'll just see how beneficial it is to have that in your arsenal, to have that in your knowledge bank, to be able to spot them efficiently to help you figure out if you want to enter for a buy or you want to enter for a sell based on the candlestick pattern that you are seeing. All right, so we understand the different types of analysis. We went over fundamental analysis already. Now let's go into kind of how to do technical analysis. So there's really 3 market types and 3 kind of playbooks. So you have to be aware of which one you're in so you can make the best decisions possible. So that's what we're gonna do right now. So the market does 3 things. If you identify the type first, then you get to pick your tool and understand what you're kind of looking for. So the market trends, the market consolidates, and the market breaks out. So trending simply means that there's clear direction, either up or down. Price is making higher highs and higher lows, or it's making lower lows and lower highs if it's trending down. Consolidation simply means it's just ranging, like it's stuck in a range, like it's just bouncing up and down. It's not really going up, it's not really going down. It's kind of just staying within like a little group. Then there's breaking out markets. So that's really escaping the range of consolidation, and a new direction is being formed before it starts getting inside a clear trending market. So most of the time how it goes is that the market will be trending, then it will go consolidate, and then it'll break out of the consolidation. It'll start breaking out, go back into trending, then consolidation, and so on and so on and so on. So let's look at trending markets and how to spot it, the best plays, and what not to do when we are in this type of market itself. So trending markets, as you see, we're just continuously making higher highs and higher lows. This is if it's trending up. This would be flipped if it was obviously trending to the downside. But how do you spot it? How do you know you're in a trending market? So the first tell is if you're seeing higher highs and higher lows be created, and we'll dive deeper into this when we hop on the charts and things like that. But higher highs and higher lows simply means that the candlesticks, they're just forming to the upside. Like they're all getting higher and higher and higher and higher. That's a clear sign of the fact that we're trending to the upside. Now, like I said, this would be flipped where price is trending to the downside. And that's how you would spot if we are trending down. Now, the best play when it comes to trading trending markets is buying on pullbacks to support zone and then selling on rallies to resistance zones. This is something called break and retest. We'll get into this strategy. It's a strategy I use very, very often. We'll get into it later on inside of this course. But it's amazing to use support or resistance and really essentially break and retest of support or resistance in trending markets. Now, don't do this. Do not try and look for sells when we're in a trending market. We always want to trade in the direction of the trend. So if we're trending up, never look for sells. If we're trending down, never look for buys. Never fight the trend. You have to follow the trend and trade the trend. Now here's consolidating markets. So how to spot it is that price keeps hitting the same highs and lows, just a lot of sideways action. So as you see here, it's just going up, down, up, down, up, down, up, down, up, down. This is consolidation market. We're not trending in any specific direction, whether buys or sells. Now, the best play is to buy when you're near support zones, and we'll get into what support zones and resistance zones are in this course as well. Support zones are down here, resistance zones are up here. So you want to buy when it gets down to support areas, and you want to sell when it gets down to when it gets up to resistance areas. Now, what you don't want to do is chase the middle. So don't try and look for breakouts if nothing has broken yet. If price is still in this range, don't try and look for breakouts. Don't try and look for price to buy even higher when it hits the resistance zone or sell even lower when it hits a support zone. Like I said, you want to follow the trend. Follow what the market is already showing you that it wants to do. Now here's breakout markets. How do you spot it? Essentially big candlestick punches through a long held support or resistance level. So you see, imagine this is our resistance zone. We'll get into support or resistance in depth later on inside the course, as I mentioned. But you see this red line, imagine this is a resistance, meaning price failed to go above here. But then we had one big candlestick that broke outside of it. That is a breakout market. And then what do you see ends up happening? When we broke out of that previous resistance zone, price went into an uptrend. It started trending to the upside. So that's what you would look for. And then obviously the opposite of this is if it broke below a support zone. So if price sold down here and broke below a support zone, you can see that it would then start trending to the downside. So the best play is to look for breakouts with entries above the resistance zone. So if we see price broke above the resistance zone, we would then be able to look for buys at that point. Or if price breaks below the support zone, we'd be able to look for sells below the support zone. Like I said, we'll get into this completely in depth inside the course. Now, what not to do? Don't chase late. So don't ignore fake outs. Don't use any type of if price is already broken out and it's all the way up here, you don't want to chase it, right? You don't want to see that market is trending to the upside and try and enter without any type of confirmation. Just because the market is breaking out, we want to look for extra confirmation, and we're going to go over the candlestick types and patterns that can give you extra confirmation inside the course as well. But you don't just want to enter as soon as you see price getting close to break a resistance zone or getting close to break a support zone. You need to have extra confirmation of it. So the market cycle always. So as I mentioned, you have consolidation, then you're going to have a break, and then it goes into a trend, and then it's going to go into consolidation, and then a break, and then a trend, and it just keeps doing that life cycle literally every single year, every single month, every single week, day after day. So if you want to have this printed out, it's your cheat sheet. Right now you have trending markets. Markets are just continuing going up. Consolidating markets, we're just chopping up and down, no clear direction. And then breakout markets is when we're breaking out of the resistance or breaking out of the support zone. One of the biggest patterns that you're going to see and notice in technical analysis is something called support and resistance. It's the foundation of almost every single strategy. We're about to hop into strategies in a second here, but it's the foundation of almost every single strategy that you see in this video, that you would have seen on every other YouTube video. It is like the backbone of technical analysis overall. And a lot of people overcomplicate it, but it's very, 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 very simple. All support or resistance is simply places where price previously got to, and either the market thought it was too expensive or they thought it was too cheap, and the market went in the opposite direction. Meaning, let's imagine this red box right here is a support zone. Support is always below where price is at. A good analogy that I use to remember it, the difference between resistance and support is a floor. Support, just think of something supporting price up. And then resistance, think of resistance as a roof. Think of you trying to break through a roof, but it keeps resisting. That's the same thing. So let's imagine this yellow line is price. Price will tap into support zones and it will start going up. Same thing vice versa with resistance zones. Price will tap into resistance zones and start going down. Now, why does this happen?
Let's use the analogy of right now, because I'm on Ethereum chart. It doesn't matter what chart you're on, support or resistance is essentially the foundation of it and can be used for it. It is literally the strategy that I have used from the start of my trading that has made me the millions of dollars that I've been able to make with trading across all different industries. But the reason being is, like I said, with the analogy or the example that we're going to use for now is Ethereum. Imagine the price of Ethereum down here at this red box is $1,000, right? And imagine the price of Ethereum up here at this red box is $2,000. I told you guys before when we talked about trading sessions that we don't move the markets. The big banks do, the big private equity and hedge funds do, right? So when they find something is too expensive or too cheap, they will buy it up. For example, this is Ethereum. The yellow line, the price of this is Ethereum. Every single time Ethereum gets to $1,000, it's super, super cheap. So everybody buys it. And when everybody buys it, it makes the price go up. You can think on a regular scale. Imagine right now iPhones are what, $1,000? I don't know how much they are. Let's say they're $1,000. If you went to Walmart tomorrow or Target tomorrow and an Apple iPhone was $200 instead of $1,000, you would buy it up because you know the actual fair value for that is $1,000. And then same thing when it comes to, let's say in this same exact example, if a phone was $2,000 or it was selling for $2,000 and you had an iPhone and you only bought it for $1,000, when everybody else was buying for $2,000, you will probably sell it at $2,000, and so would everybody else, and that would cause the price of it to go down. So bringing this back to our Ethereum trade here, every single time price gets to like $1,000, and this is all example numbers, but every time Ethereum gets to $1,000, everybody thinks it's super cheap, so they buy it. When everybody buys it, it makes price go up. When Ethereum gets to $2,000, everybody thinks, dang, that's mad expensive. I'm just gonna sell all my Ethereum. When everybody sells all their Ethereum, that causes price to go down. And it just keeps doing this, right? Now, it'll be times when, okay, really like $1,000 is not that cheap anymore. So everybody won't sell it at $1,000 and it'll break through that. That is called a breakout, and that's a breakout of a support zone or a breakout of a resistance zone. But right now, let's go back just for a second. So the way we're able to use these support or resistance zones, we're able to see, okay, at $1,000, right? Most of the time when it gets to this price, it starts going up. So me as a trader, as soon as it gets to $1,000, I can look for certain patterns, whether it's candlestick patterns or different market structure patterns that tell me, okay, it's at $1,000, and then I saw this candlestick pattern, I should probably enter a buy because it looks like it might reverse. For example, if it touches $1,000, which is a support zone, and I see a doji candlestick, and I know it's been trending down to the $1,000, and I see a doji candlestick, which means indecision, and that price is about to reverse, I can enter for a buy, and then that buy would allow me to make money as it goes up. Same thing vice versa with sells. That's how we as traders trade support or resistance. We're able to identify the areas where price has previously reacted to or previously sold off of or bought up off of. And then we're able to position ourselves to wait for extra confirmation to enter into a trade. What I don't want you to do though, and I find a lot of new traders doing this, is they'll have their support and their resistance zones drawn up. And as soon as it taps into, let's say, a support zone, they'll enter for a buy because they just assume it's going to go up. I mentioned to you guys before with candlestick patterns, the same thing with support or resistance. It's not 100%. It doesn't mean just because it's bounced off of here the past 20 times, it doesn't mean that this time it's going to bounce off of there still. It could break through and have a breakout. That's another type of strategy that we'll talk about a little bit later on. But nonetheless, that's why we wait for extra confirmation. And that's why later on in this video, I'm going to go over what confirmation I look for my support and resistance strategy. But that essentially is support and resistance. Now, I mentioned we do have breakouts, right? We'll have breakouts where price will break above, let's say, a previous resistance zone. Let's say in this analogy, it buys up, breaks out of it. Now, you could either take a breakout, but you also have to realize that support or resistance zones, when they're broken out of, they'll always or almost always get retested, meaning it broke out of this resistance zone, price will come back down to retest that previous resistance zone in this analogy, and it'll treat that previous resistance zone as now a support zone, and it'll buy off of it. Same thing with the support zone. When it breaks out of it, It'll break out of it, it'll break that support zone, and then it'll come back up to retest that previous support zone, and it'll treat that support zone as a resistance zone and sell off of it. This is called a break and retest. This is another one of the strategies that has printed me money. This is one of my favorite strategies to trade, which is that break and retest off of a support and resistance zone. So once you understand that concept of what support or resistance is, and then understanding and realizing that when it breaks out of it, there's also a play that you could take after it comes and retests it and it flips it. That's a very valuable skill to know. Now, obviously, this is all drawings and this is all not fake, but this is just drawings. But we can see it here live on the charts. I don't have anything currently drawn up on the charts, but if we just zoom out and look, right, what I'm going to do, I'm just going to draw boxes around certain areas, and we're just going to see how price reacted to it when it got to that same price point. Because remember, candlesticks is simply telling us where price has been and the story of it. So we see here, price got to this area, right? Let's zoom in and look at this. Price bought up here, and then it sold down very heavily. What we're looking for with support or resistance zones is we're looking for price to buy up to an area and then sell off very hard, or sell down into an area and buy off very hard. In this example, we see price bought up to an area, then it sold off very hard. What happens if we drag this across? This is that same area. We're just using this box tool to mark off the area. If we drag this across, what happens when it taps into that same area? Price is all the way down here. It bought up back into that same area. And what did it do? It sold off. We can look on the bottom right here. Price was selling down heavy. As you see, price was selling down very heavy. It got here, then it started buying up very heavy. This is the lowest point it went. If we drag this across, what happens? Price respected this support zone here. It respected it here. It respected it here as well. And then you'll see here, what happened? Price broke through it, came back up into that previous support zone as the break and retest. And then what did it do? It sold off. This is what you're going to see. You're going to see this pattern happen time and time again. We have this zone right here. Price bought up very quickly, sold off very quickly. If we drag this across, what happened when price tapped back into it? It sold off again. We can see up here. Price bought up into this area right here. It sold off heavily. What happened when price got back into the same general area? It sold off again. There's something you have to understand though. This is a perfect example. Price doesn't always stop exactly at where it stopped at before. That's why when I'm drawing my support or resistance zones, and I'm going to show you in a second how I draw them, I use boxes. You'll see a lot of traders come on here and they'll use lines, like they'll draw their lines like this and use that. But a lot of times price, well, every single time, price never just stops exactly at the same point that it stopped at before. Sometimes it'll stop a little bit before it. Sometimes it'll go a little bit above it, and then it'll react. For this analogy right here, or this example right here, if I had just used a line and drew off right here, right, instead of having this box, we would have seen price bought up here, sold down, and then what happened? It never tapped that line again. So we would have never even known that we could have entered a sell at this point. So that's why I use boxes when I'm drawing off my zones. Now, how do I actually mark off my zones personally? So this is how I mark off my zones and how I kind of know what a zone is versus just using a line or just drawing a box any type of way like this or something. There has to be consistency with it. So how I like to do it is, okay, I see price sold down into an area and then it started going up. What I'll do is the lowest wick in that drop to the downside, I'll start my box there and then I'll drag it to the highest body before it started going up, the highest body of the candlestick. So in this analogy, you see it sold all the way down here. So that's the highest wick. And then the lowest body is on this candlestick. So I drag it until it gets to that candlestick. And then what I do is I just drag it across and I just wait for price to react to it at that point. And as you see, it reacted to it here, here, here. And then what happened? Broke through it, came back to retest it, and sold through it. That is essentially how I draw my zones. And I can draw this multiple times here. You see price bought up into this area. We'll take my box out here. I'll draw it from the highest wick to the lowest body, since I'm drawing a resistance zone right now. And then all I'm doing is dragging it across. And I'm simply just waiting for price to tap back into that area. What happened? Price came, tapped back into that area, and sold off. This could have been a nice selling opportunity off this resistance area. Now you're going to see multiple different examples of this. You're going to see it all over. You're going to see these break and retests happen. You just need to get good at seeing and spotting these actual resistance in these support zones. And like I mentioned to you, the main thing we're looking for is big rejections away from areas. You don't want to get distracted with things like this, right? Where price got up here, it bought up into this area, it got here and then sold off a little bit. That's not a good support or resistance zone for me. I want to see big rejections. So for example, this is a big rejection. Price got down here, then it rejected heavily off of here. So then I would drag my zone across and I'd wait to see if price tapped into here again. I'm not sure if it did. Oh, it didn't. See, perfect example. It just broke through it. I mean, it bought off of here just a little bit right here for a little bit. You could have made some money here or right here when it bought off of it again. But the main setup I probably would have taken is when price sold and broke through my previous support zone. And then what did it come do? Broke through it, came back up to retest it, and then sold off. I would have taken that break and retest. But as I mentioned, you're going to see this example happen so many different times. You just need to get good at spotting these support and these resistance zones. So what I would do as good practice is I would zoom out my charts, and keep in mind, I like to draw my support or resistance zones on higher time frames, like a 4-hour time frame or a 1-hour time frame. I don't really draw it on like 1-minute time frames or 5-minute time frames. Reason being, and this is something you have to understand, the lower the time frame, the more price lies. Because, and you remember my analogy where I showed you we have a daily candlestick, but that has 24 hourly candlesticks in it. It has however many 1-minute candlesticks inside of it. That can show you a lot of noise, right? But a 4-hour time frame support or resistance zone is really going to show you the real zones. It's going to show you the strong zones. That's not saying that a 1-minute support or resistance zone would not work or it won't be respected. It's just I would always trust a 4-hour time frame support or resistance zone, or support or resistance zone drawn on the 4-hour time frame. I would trust that over one that was drawn on the 1-minute time frame or the 5-minute time frame or the 15-minute time frame. I'll always lean towards the hourly or the 4-hour time frame when I'm drawing my support or resistance zones that I'm looking for trades off of. So I'd recommend the same for you as new traders. So like I was saying, a simple way of getting good at drawing support and resistance zones is just to zoom out on your chart here on the 4-hour time frame and just look to see where price pivoted at, right? Take out your drawing tool if you want to and just look where price pivoted at. Okay, price pivoted here, it pivoted here, it pivoted here, pivoted here. We have all these different big pivot points, right? And then once you mark them all off very simply like this, then you can zoom in a little bit, right? Zoom in a little bit and then get good at drawing your zones. So you draw it from the highest wick to the lowest body, right? Just like this. And you'll see this example, price sold down, came back up, retested it, right? So you would zoom in, get good at drawing your boxes, the highest wick to the highest body, drag it across. As you see, that would have tapped into it. We could have sold on this trade to the downside, could mark off this one as well. I think we marked off this one as well. But this is essentially how I suggest for people to get good at finding support or resistance zones. Now you can get a lot more intricate and a lot more detailed once you become a little bit more comfortable with finding these zones, where you don't have to look for the complete obvious ones like the ones that I marked off. You can start paying attention to, okay, we had this zone right here where price bought up to and sold off very heavily. I could have taken this trade, or I could have taken the trade right here where it got back into that same area, right? But as a new trader, I do suggest for you to get good at marking off the obvious support or resistance zones before you start trying to go and find every single support or resistance zone. Because what I don't want you to do, and this is something that I fell victim to in the beginning, is I had 300 billion support and resistance zones on my chart. I was marking off literally everything. And when I marked off everything, I did not know what action to take because I literally would have zones at every single part of my chart. And that was a complete mess. So you don't want to do that. You want to just focus on the obvious support or resistance zones, and then focus on getting the support or resistance zones that you're looking for on that specific day. Well, we'll get into what that looks like in a little bit from now when we start going over my different strategies. But as I mentioned, support or resistance is literally the foundation of trading. It's the foundation of technical analysis. It's something that you really need to master, regardless of what strategy you're going to trade. All right, now it's time to talk about our little sidekicks, right? There we have these sidekicks that we have in trading, and they're called indicators. I know I've mentioned it a few times when we went over how to use TraderVate, how to use TradingView, but now we're going to dive into what they are, how they help us, and I'm also going to give you guys my top indicators that I personally like, and then also like the main ones that a lot of people use. So here in the indicators tab, you can actually see a bunch of different indicators on TradingView. It's going to look very similar on TraderVate. It won't have as many indicators on TraderVate, but on TradingView, there's a bunch. If we go to technicals, you can see like it just keeps going. Like there's so many different indicators that you can find. There's indicators that other people have created and things like that that you can put onto your chart. But nonetheless, indicators essentially just compile data on the charts that we can actually see, but they formulate it into different ways. So there's like hundreds, if not thousands and thousands of indicators, but a lot of them can be foolishness. Like you'll see a lot of new traders come on here, and I want you guys to avoid that. A lot of new traders will come here and you'll look at their charts and they have 13 million indicators, thinking that the indicators are some magic weapon that will help them become profitable and make money. That's not the case. Indicators will not save you. They're simply, like I said, sidekicks. Batman does not need Robin, but sometimes Robin helps. But Robin ain't stopping Bane by himself. That's all I can say. So same thing when it comes to indicators. They're just there to help us give us more confidence in a trade that we're trying to take, or help us see other sides of what the market is doing, right? So there's a few indicators that a lot of people use. A lot of people use one called the moving average, right? So if you come on here, you'll press it on indicators and you'll see this blue line pop onto your charts, right? This blue line right here is that indicator that we just had added, and you'll see in the top left corner that it populated over here, the EMA. You see 9 close. You can press this button right here to hide it if you want. You can go to settings here. You can look at the source code if you want, or you can press remove here and delete it off your chart. But any indicator that you add will be here in the top left corner. So if I add, let's say this, or if I add any indicator, really, it'll all pop up over here. But let's go back to the indicator that we were just talking about, the EMA. This is actually one of the indicators that we'll be using for the strategies that we're about to go over. But let's just press it. Here you can go over the settings. I'm going to show you guys the main settings that a lot of people use. So if you go in settings, you'll see this pop up. Under length, essentially what the EMA is, first of all, before we get into this, what the EMA is, this blue line is simply just telling you the average price of where price has been throughout whatever period we're on. So this blue line right here, you'll see it is at 195329. That's the price of where this indicator is. That's simply saying that over the last 9 candlesticks, this is where the average of where price has been. And you'll see it changes and things like that. And if we go to different time frames, because it's going based off of the last 9 candlesticks, right here on the 4-hour time frame, it'll show this price. But if I go to the 1-hour time frame, it shows a different price. If I go to the 5-minute time frame, it'll show a different price, because it's always going based off of the last 9 candlesticks on whatever time frame you're on. It's always going based off of the average of the last 9 candlesticks. But what you can do inside the settings is you can change that. So if you don't want it based off the last 9 candlesticks, then you can put it to like the last 50, which is what a lot of people will do, or they'll do the last 100 candlesticks. And simply the main purpose of the EMA is to tell us and show us simply what direction the market is going. Because if overall our candlesticks are below the EMA, that's telling us clearly that we're in a downtrend. So we should really be looking for sales. Now, same thing vice versa. If on average the EMA, because remember that's telling us the average of where price has been, if our candlesticks are above the EMA, meaning it's above the average of where price has been, we're in a uptrend. So we should be looking for buys. Now, like I said, a lot of people play around with the length as far as 100, 50, 30, but the main 3 ones that people use is those 3. The 30 EMA, which is showing you the average of the last 30 candlesticks, the 50 EMA, or the 100 EMA. So that's just something to keep in mind. That's what the EMA does. Now there's a whole bunch of other indicators here. We have a volume indicator. So if we just go to volume right here, we type in volume, press volume, you'll see it'll pop up on your charts below here. a bunch of different graphs. Some are red, some are green. Simply what that is telling you is it's showing you how much volume, how many people are actually buying versus how many people are actually selling at that time. So when we see big green bars, it's always aligned with the candlestick above it. So any of these graphs is always aligned with the candlestick above it. So this big green one is aligned with this candlestick. But you'll notice here we see big green bars. We're also going to see most of the time big green candlesticks. Same thing vice versa. If we see big red bars, we're also going to see big red candlesticks right here. So this just helps us see the volume of what is actually happening as far as how many buyers or how many sellers are actually working in that candlestick and who's actually winning in that, because you have to remember every single candlestick is buyers and sellers going against each other, or bulls and bears going against each other. That's why you hear us say like bullish market or bearish market. A bullish market just means that the bulls are winning. The bearish market simply just means the bears are winning. But that's essentially what the volume indicator does. I don't really use the volume indicator much at all. The main indicator that I really use is kill zones. This indicator is absolutely amazing, and it's so simple. All it does is show us the trading sessions, and it's great for a strategy that we're about to go over in a second. I know I keep saying that. Trust me, we're about to go over in a second. But trading sessions are arguably one of the most important things that you need to understand, so you know when volume is actually happening. You know when you're going to see big moves or when you should be trading. And what kill zones does, you see it populated like this yellow line in this white line. This shows me clearly that this is when London session started. The yellow line for me, because based off my settings, it shows me exactly when London session started. The white line shows me exactly when New York session started. Now, by default, this looks a lot different. So like if I reset my settings here on all of this, you'll see that it looks completely different when you first turn the indicator on. But if you want it to look like mine, because it shows the red graph over here as well, which is Tokyo session, which we went over. But I don't really trade Tokyo session, so I don't care to see it on my chart. You'll notice by the end of this video that I don't like having too many things on my chart. I like a clean chart and not being distracted by too much stuff. So if you want to kind of copy my settings here, when you put kill zones on your account, just copy my settings that you see here under style and under input, and that will allow it to populate and look the exact same as it looks right here on the chart. So this is an indicator that I actually keep on my chart 24/7. So it just allows me to easily see when London session started and when New York session started. Now, like I said, there's a bunch of other indicators that a lot of people use. So there's the VWAP indicator, which is very similar to the EMA. It's essentially just showing you when you should be looking for buys or sells. How most people use it is if price is below the VWAP. I'll show you guys my settings for that as well. Usually I'll go to settings under style, and I'll turn off all of these and only keep the VWAP on. But if price is below the VWAP, I'll be looking for sales, or if price is above the VWAP, I'll only be looking for buys. That's how most people trade it. So that's just another indicator for you to keep in mind. But I want you guys to truly understand this. We've went over a couple indicators. I've showed you which ones I really use a lot, and which ones I don't. But you have to understand that indicators is not going to tell you the whole picture. And also, it's not something that you should just fully rely on. It has to be combined with the other things that we talk about inside of this video and the other things that we're going to talk about inside this video. Oh, another indicator that a lot of people love as well is this relative strength index. How people use this is you see it populates down here. At the top of this, when price goes outside of this, that most of the time means it's overbought, meaning that it's too expensive and it's probably going to reverse. And when price goes below it, that usually means it's too cheap and price is going to reverse. So as I mentioned, it's completely aligned. As I mentioned with the other type of indicator, the volume indicator, the candlesticks above it are completely aligned. So if we zoom in here and we look at price was selling down right here, and then it got to this point right here, started getting it in this area right here, and it started consolidating or chopping around. If we look on the RSI at the same exact time, we were outside of it, meaning it was oversold, meaning it's probably going to reverse. And as we see, it got outside of here. That's when it started consolidating, and then it started reversing. We can see another example right here, right? Price was selling down. We see on the RSI, it came outside the RSI, and then it started buying up because it had to go back into the RSI where it wasn't oversold. Now, as I mentioned, it's not foolproof, but it is something that you can add as a confluence. You see price sold down here. It's outside the RSI, and then it started going up. So this is another cool indicator. I use this a lot when I'm trading stocks. If a stock is super oversold, I'll look to buy it. But most of the time I'm looking to buy it and hold it for like months and stuff like that. I'm not looking to day trade it. But this is another indicator that a lot of people use, day traders as well as people who hold trades a little bit longer. But indicators, as I keep trying to mention, they're not foolproof. They're not something you should 100% rely on. They should just be something to add on top of what you're already doing or the strategy that you're already trading. And please don't fall into the hype of having 300 indicators on your charts thinking that it's going to help you. I promise you it's going to hurt you more than it will help you. It'll confuse you way more than it will provide clarity. So just be aware of that.
Now keep in mind, these are the same indicators that I have all of my inner circle traders use every single morning when we're trading live in the morning. It's nothing fancy. There's nothing complicated about them. It's literally the exact same setup that we just went over that's helping us inside of my inner circle print every single week. If you want more information about the inner circle, click the link inside the description of this video. Okay, so now that we understand indicators, we understand how to use trading view, volume, all that things, we're gonna start hopping into my top 3 strategies for beginners or even advanced traders. These are the same strategies that I use every day to literally print money inside the market. But before we do that, we have to figure out, well, you have to figure out what type of trader you are. Now, there's no better type of trader. There's no worse type of trader. It's all depending on your goals. It's all depending on your risk tolerance as far as how risky of a person you are overall, and also more so the amount of time you have to give to the markets. So there's 3 different types of traders. There's scalpers, there's intraday traders, and then there's swing traders. Let's hop into exactly what each and every one of them are so you can figure out for yourself what type of trader you are and just based off of your personality. So scalpers is a trading style that specializes in profiting off of small price changes and making a fast profits. They're usually in trades for a few seconds all the way to about 10 minutes max. Now, scalping is really fast paced. So what I mean by that is that you have to be able to catch these small, quick moves using whatever you want to trade. You can literally trade anything. If you want to trade NQ, you want to trade ES, you want to trade YM, it doesn't matter. You're just trying to find perfect entries and hopping out very fast. Like I said, a lot of times scalpers are in trades for a few seconds, maybe up to 10 minutes, but most of the time scalpers are in there. They're just in and out. I'm not gonna lie. In the beginning, I used to scalp. Right now, I still do scalp sometimes. We're actually gonna go through one of my favorite scalping strategies in a second from now. But these are for people who are more so fast paced and kind of just want to be in and out the market. This is perfect for someone who doesn't have much time to dedicate to being on the charts. But then this is also for somebody that just wants to be able to be done with their trading day within 30 minutes throughout the day, and they don't have to check back or worry about it for the rest of the day. That's what scalping is. Now, the next thing or the next type of trader is intraday trading. That's what I am considered. Intraday trading is another word basically for day trading. Usually, a intraday trader will hold their trades for anywhere between like 1 to 24 hours, not usually going over a day or two. Now, that's what us intraday traders plan on doing. Sometimes we can hop in a trade and we can actually get out of trades within 15 minutes, 20 minutes. Sometimes I've gotten out of trades, intraday trades, where I planned on holding it for an hour, 2 hours, but the trade ended up going in my direction within 20 minutes. And that just all goes back to the volume that was in the market at that time. And I ended up making the money that I wanted to make within a shorter amount of time. But we plan to be in trades roughly for about 30 minutes to like 4 hours each and every day. It's technically considered an intraday trader if you, even if you hold it up to 24 hours. But other than that, after it gets to that, then you become a swing trader, which is the next thing that we're going to go over. Swing trader is simply a trader that likes to hold their trades for a long period of time. These traders tend to hold trades for days, weeks, or even months. Now, going back to intraday trading, it's really for people who kind of want a little bit more hands-off approach to trading, but they also want to check the charts every day. You'll learn as you start trading that trading it can get very fun. And swing traders, most of the time, will enter a trade and not check on it for days or months. Me, as an intraday trader, I enter my trade, I walk away, I'll check on it every 20, 30 minutes, and I'm just going about my day. But I still like to be aware of what my trades are doing, and I don't want to go to sleep with my trades just based off of my, I guess, personality. I feel like I sleep better if all my trades are closed and I'm not holding or in profit a couple hundred or a couple $1,000s, depending on the trade, obviously. But intraday trading is great for people who, let's say, work a job, who go to school, people who can't really sit on their charts. They're just people who just want to be able to wait for their setup, enter their trade, and be able to walk away, check back every couple minutes or so. Swing trading is really for people who just want like completely hands off. They want to look at the charts, get in a trade, and that trade is going to hit in 5 days or a couple weeks or a couple months. Now, I will swing trade stocks or crypto, and basically I'm just buying it and I'm planning on holding it for a long period of time. It's the same thing when it comes to swing traders. They can plan on holding it for a couple days, but if there's a lot of volume in the market, they can actually end up getting in and out their trade within a couple of hours. But it's just depending on the volume of the market at that time when they're actually entering their trade. But like I said, swing traders are planning to hold their trade for a couple of days, a couple of weeks, or sometimes even a couple of months. Now, like I said, swing trading is really, really good for more of a super passive approach when it comes to trading. So you just want to be aware of that. If you are that type of person that doesn't want to sit here and be on the charts every day or checking their trades every single day, you kind of just want to set your trade, let it play out. Check on it every couple of days or so, see if it's going in your direction, manage it that way. It's for people who don't want to have to stress too much while they're in trades, because with scalping, it can be a little bit more stressful because you are looking for such small price movements that the price can move in an opposite direction from you very, very fast. So you have to be able to react very fast. So as a new trader, when I was scalping as a new trader, it was a little bit challenging to scalp because I'm still kind of new to trading, but then I'm also trying to do the fastest version of trading, which I feel like a lot of new traders gravitate towards. I personally suggest and recommend for new traders to start as intraday traders. Once you get more confident in your trading, then you can get into scalping and consider scalping, but you have to be aware and understand how to use the different platforms, how to be able to read the chart and see what the language of each candlestick is telling you each and every time at a very, very fast pace. So if you're still kind of in the learning phase, I'd suggest you stick to around the intraday part of trading versus trying to scalp. But like I said, it's all depending on your personality. If you want more hands-off approach, swing trading is absolutely amazing. It's the most least stressful type of trading, with scalping being the most stressful type and the intraday kind of being in the middle. But like I said, it's completely up to you and your personality. All right, so you understand the types of traders, you understand indicators, you understand support or resistance. This is where we get into the fun part of things, which is my strategies. We're going to dive into a bunch of my favorite strategies, and we're going to go over exactly which strategies are good for which people, because I do have so many different strategies. You guys have heard so many times throughout this video that you shouldn't go strategy to strategy to strategy, but I have built over the last 9 years so many different strategies, and I've perfected so many different strategies. And the reason being is because everybody's different. Everybody has different personalities. Everybody has different goals. Everybody has different time amounts to be able to trade. So I have created and put together multiple different strategies that fit multiple different people. So the first one we're about to go over is actually my favorite one. It's my bread and butter. It is the one that I trade majority of the times when I'm trading live inside my inner circle. This is the one that we go over first every single time. And these setups are the ones that I look for every single day, majority of the day, because it fits my schedule. It is called my ultimate support and resistance strategy. The reason I love it is because it's extremely passive. We talked about inside of the beginning of this video and throughout this video that I don't spend hours sitting at my charts. I don't spend hours just looking at the screens all day. I have a life and I enjoy living it. I have a family, I have a wife, I have 2 kids. I don't want to be sitting behind a screen for the entirety of the day. And that's why I love this strategy, because I can set up my zones, and we're going to go over it and go over examples and things like that. But I can set up my zones. I can set my alerts. I can walk away, wait for my alerts to go off. I'll get notified when it's time to enter. I get a notification to my phone. I go look at my charts for another 3-4 minutes. I enter the trade. I set my alerts again, and I leave. That's it. It's super passive. It's great for somebody who doesn't have a lot of time throughout the day, someone who doesn't want to sit at their charts all the time, but it might not be for someone who wants to have 300 million trades in one day. Like, you're really going to get maybe 1 to 2 setups per day with this strategy. But with that being said, let's get into it. So if you don't know what support or resistance is, it is like the foundation of trading. If you want to be a trader, you need to understand support or resistance. And good thing, it's not that complicated. And even better thing, I'm the best person to teach it because I don't overcomplicate the things that don't need to be overcomplicated. Think of resistance as a roof and think of support as a floor. Pretend this yellow line is price or the candlesticks or whatever you want to call them. Every time it gets to this resistance zone, which as I mentioned is a roof, it bounces off it. It fails to go above it. It's a roof. It can't break above it, right? Same thing vice versa with the support zone. Every time price gets to a support zone, it just fails to break below it. It just continues to respect this support zone and respect this resistance zone. And that's simply what support or resistance zones is. It is areas where price has previously rejected off of. So I know that, let's imagine that this is Bitcoin when it's $1,000, right? And then let's also imagine that this is when Bitcoin is $500. Using support or resistance, I can know that at $1,000, most of the time, everybody sells their Bitcoin and it makes Bitcoin go down. And then I also know on the flip side, every time Bitcoin is at $500, everybody thinks it's super cheap. So they buy it and that causes price to go up. So me as a trader, I can look to understand and wait and see for price to come down to the 500 area, wait for a specific entry criteria, which we'll go into a little bit later on inside of this video, that tells me I should enter the trade, and then enter it and catch the move as it's bouncing off of either the support zone or this resistance zone. Now, I mentioned that these roofs and floors are most of the time always respected, but there are times when price breaks above these resistance zones or below these support zones. And what that is we call a breakout. Now, a cool thing about a breakout is most of the time when price breaks out of, let's say, a resistance zone right here, it breaks above it. Most of the time it'll come back down and test that previous roof or a previous resistance zone and actually treat it as if it's a support zone and it'll bounce off of it. Same thing vice versa with support zones. If price breaks below a support zone, most of the time it'll come back up to that previous support zone and treat it as if it's a resistance zone or a roof, and it will sell off of it. So no matter what happens, no matter if price continues to respect a support zone or a resistance zone, or if it breaks out of those, I know that with my strategy, I'm able to capitalize on this. Now, this is the foundation of the strategy, and it's really the reason why this strategy to me is pretty boring and it's my laziest strategy, but it's printed me, honestly, the most amount of money out of every strategy that I trade. But it's just a lot of waiting because we know in this area, we're not doing anything. The only time we're taking action is when price touches our either resistance zone or touches our support zone. And then once it touches that area, we're waiting for a specific pattern to form, and then we're entering into the trade. Now in this video, I'm going to show you guys not just how I draw my support or my resistance zones, because a lot of times people draw it completely wrong and it ends up giving them false signals, and that's why they keep hopping into trades and keep losing. But I'm going to show you how to draw them correctly, how to know and be patient enough to wait for entries using the exact way that I wait for entries. That's allowed me to be able to consistently make profits with trading. And then also when to exit the trade, because the same way you don't just want to enter a trade, let's say for a buy, as soon as it touches your support zone, you also need to have an exit plan to know when you're getting out of a trade, because that's the only way that you're going to actually end up making money is when you actually exit the trade. I'm also going to give you guys a couple tips and tricks that allow me to trade this strategy, even if I only have 15, 20, 30 minutes a day. So I explained what support or resistance is with obviously these drawings. Now let's go into the chart and see exactly what this looks like and how I spot valid support or resistance zones and ignore the ones that are fake, the ones that won't actually help me profit. All right, so here we are on the chart. We're gonna go over this example really quickly. This is one of the trades that I actually took live inside of my inner circle and sent it out to my inner circle. We're gonna go over this in a second, but I wanna go over how I actually draw my support and my resistance zones. So it's very simple. We come here on the 4-hour time frame and we're looking for areas where price has strongly moved away from at least one time, or we want to see where price has moved away from multiple times in the same period. So for example, if we could just zoom out here and look at a couple areas, right? And I use a box tool to draw my areas or my support or resistance. You'll see I draw it like this, right? You'll see some traders draw it with lines. The problem for me is that price never stops directly at a support or resistance zone. So let's say for this instance where we see price sold off heavily right here. Some people would draw a line right here where price sold off and then look for price to tap that line to then look for an entry. But I've noticed and I realized that price never stops exactly at the same area that it stopped at before. So I like to draw a general area. So when I see a zone like this where price gets to an area and it sells down very heavily, I take out my rectangle drawing tool and I draw it from the top of the wick, the highest wick that I see. This is if I'm drawing a resistance zone, and I'll show you guys an example of a support zone in a second. But I'll draw it from the highest wick all the way to the highest body. So in this instance, we're drawing it from the highest wick, which is up here, to the highest body, which is on this candlestick. And I'm just dragging it across. And honestly, this entire time when this happens, all I'm waiting for is price to tap back into this resistance area. And then I'm waiting for my entry criteria. And we'll get into what my entry criteria looks like in a second here. But as you see, as soon as price tapped back into this same area, this same 4-hour resistance area, it sold off very heavily. This could have been a trade that we could have entered and made a decent amount of money. I don't remember taking this trade. I'm pretty sure I would remember it because this is a pretty strong drop to the downside, but that's just how I draw my zones. Another example would be right here where we see price sold down very heavily, got to this area and then bought up very strongly. So what I would do is the same thing. I draw my box from the lowest wick, since we're drawing a support zone, to the lowest body, which is right here. Then I would drag it across and wait for price to get back in that area. And as you see, when price got back in this area, it ended up buying off of it. And we could have made money when price was buying off of this support zone right here as well. Now, as I mentioned, price isn't always going to respect your support or resistance zone to the T. It's never going to go exactly where it went before. Sometimes it'll go a little bit outside of it, and sometimes it'll only go into it just a little bit and then reverse off of it. That's why it's important, and that's why I personally like using these rectangle tools instead of just drawing lines on my chart as support or resistance zones. Now, we can see this example multiple times. This is where price had one strong move away. This is where price had another strong move away. But I mentioned support or resistance zones are also valid when they have multiple rejections at the same area. For instance, right here, where we see when price got in this general area, we can see it happen multiple times. The first time being right here, it sold off. It got here again, 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 sold off, so on and so on and so on. So to me, this is also a valid resistance zone. Even though there's no just one huge sell-off, you see multiple times where price tried to get in this area and it sold off. Now, this is also a perfect example of what we talked about before, where I told you guys when price breaks outside of a previous support zone or a resistance zone, it actually ends up treating that previous support or resistance zone as the inverse, or the flip of it. Because if we drag this same zone that we just drew, if we drag it across here, you'll see what happened. This was previously a support zone. So I would have drawn my support zone literally just like this. We can delete this now. I would have drawn my support zone just like this because we see multiple times prices bounced off of it, came back down into it, bounced off of it, came back down into it. And as we see, we broke below it. And what did price do? It came back up to retest that previous support zone. And what did it do? It treated it as a resistance zone and sold off. Again, it got into that same area that was previously a support zone, and then it sold off, treating it like a resistance zone. Drag it across again. As you see, it got in the general area and sold off. Now you can see many of these examples and realize that here, like you see, another example, price got in this general area, bounced off of it, came into it again, bounced off of it, again, bounced off of it, bounced off of it. And you can see just how powerful this strategy can be as long as you're being patient enough and allowing yourself to be bored enough to not trade in any of this noise, knowing that you're simply waiting for price to tap into your support zones or tap into your resistance zones, and that's when you're taking action. Now, you understand exactly how I draw my zones, you understand what support or resistance zones are, but what does it mean to take action? When am I actually gonna make money from this? Because as I mentioned, we don't just enter trades as soon as price taps into our support zone or taps into our resistance zone. That's not a profitable way of trading. If you do that, you're going to end up losing money. You need to wait for confirmation that price is still respecting your support or your resistance zone. Because if we had just, let's say, for example, entered a buy right here because price tapped into our support zone, we would be losing this trade because we didn't wait for our entry criteria that confirmed that price was actually still respecting this support zone. It was going to bounce off of it. So with that being said, let's hop into exactly when do I enter these trades? How do I actually make money? Not just draw these support or resistance zones on my charts just for fun. All right, so let's get into what I actually look for in order for me to take action, in order for me to actually enter a trade. And we'll use this example here, which is one of the setups that we talked about inside of my inner circle. So I mentioned that I draw all of my zones on the 4-hour time frame. And there's a reason for that. Main reason is because the higher the time frame, the less price lies. If you draw a support or resistance zone on the 5-minute time frame, sure, you can find a bunch of support or resistance zones, but will they be respected as much as a 4-hour support or resistance zone? Heck no. The higher the time frame, if you draw daily time frame support or resistance zones or weekly time frame support or resistance zones, they're going to be respected a lot more than lower time frame zones. And that's why I really like to draw my zones on either the 4-hour time frame or the 1-hour time frame. But most of the time, I gravitate towards the 4-hour time frame. But for my entries, I'm not entering on the 4-hour time frame because if I wait for the 4-hour time frame, it's going to be too late. And honestly, most of the time, the move will already have happened. So when I'm looking for entries, meaning as soon as price taps into my 4-hour zone, and I know I'm looking for a buy if it's in a support zone, or if I'm looking for a sell if it's tapping into a resistance zone, I'm going down to the 1-minute time frame to see if price gives me a reason to enter the trade and shows me that it's still respecting this zone. Now, what does that look like? So let's go down to the 1-minute time frame. Let's go to when price first tapped into this purple box. Let's delete this drawing. This is the purple box that we drew on the 4-hour time frame. Here, we're on the 1-hour time frame. I want you guys to understand something. You all know that price never just goes straight down and price never just goes straight up. Price goes down, up a little bit, down, up a little bit, down, up a little bit. It makes all these highs and lows, and then lower highs, lower lows, lower highs, lower lows. It continues to make that, and this symbolizes a downtrend, right? So when we see price making a downtrend into our support zone, all we're looking for is price to tap into our support zone, and instead of making lower highs and lower lows, we want to see price start making higher highs and higher lows. Now, what does that look like? Let's actually map this out for you guys. So you see price is up here, price sells down. Price gets up here, price sells down, price gets up here, sells down, up, sells down again, goes up here, sells down, goes up here, sells down. Now, during this period, we're making all these lower lows and lower highs, but we're not taking any action. Remember, we're being extremely patient because we haven't actually tapped our 4-hour zone yet. The only time we're looking to take action is when price taps into our 4-hour zone, whether it's a support zone or a resistance zone. And all we're looking for is for price to show us that it's changing the direction that it's going in after it taps into our zone. So like I said, we keep making these highs, these lower highs and these lower lows. Price taps our zone right here, makes a new high right here, sells down, and then we see price break above that most recent high, signifying that it's potentially going in an uptrend now, and that would be a good opportunity to enter. So if we map this out very, very plainly, just on a high level map out, we can see price sold down right here, bought up, sold down, bought up right here, sold down, bought up, sold down, bought up right here, and then sold down, right? So we have a high being made here, 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 a high being made here. We tapped into our 4-hour zone literally right here. And all I'm looking for is price to break a most recent high, and then I'm entering into the trade. So this is the most recent high. We tapped into our 4-hour zone. I'm entering as soon as price breaks that most recent high right here. And once I enter, I'm putting my stop loss below structure, which simply means I'm putting it below the most recent low. And we'll go over a sell setup as well so you guys can see that. But this is what I'm looking for. Price to break above the most recent high after it taps into my zone. I'm entering as soon as it does that. I'm putting my stop loss below the most recent low that price made before I had an entry. And then most of the time I'm targeting any of these high points. So I could target this high. I could target this high as well. I could target this high up here. Let's just say we targeted this high right up here. I believe that is where we targeted, or somewhere a little bit lower, like right here. And if you drag it across, as you can see, this trade ended up hitting absolutely beautifully. This ended up hitting for a 2-to-6 risk to reward ratio. Now, the reason this strategy is so boring is because this entire time here, I'm doing nothing. I'm seeing price make all these moves. I'm seeing all these people on Instagram and Twitter making $50 million, and I'm just sitting on my hands because I know that I'm being patient enough to wait for my strategy. The only time I'm not sitting on my hands is once it taps into these support or resistance zones. Now, I know what you might be thinking, because I did mention earlier that I can trade this strategy with 15, 20, 30 minutes of time in the day, and I don't have to sit at my charts every single day. All day, every day, I should say. And then you see all these candlesticks right here over the course of this entire period is like an hour and 40 minutes. So because I know that no matter what happens in this area, no matter what the candlesticks are doing all in this area, I know I'm not taking any action until price taps my 4-hour zone or my purple zone, whatever color your zone is. I can use these things on TradingView called alerts. You can right click on your chart and press add alert. You'll right click right above, or I like to right click right above my support or my resistance zone. That way I can actually get alerted. It'll send an alert to either my phone, an email, and it'll tell me, okay, price tapped into your 4-hour zone. And I know when I get that alert that now I can go and look at my charts and look for this entry, because as I mentioned, I know I'm not doing anything until it taps into my zone. So what I'll do inside my mornings is I'll go to my 4-hour time frame. I'll draw out my zones. That takes maybe 5 minutes for me to do. And then I'm setting my alerts. I'm walking away, doing everything else that I have to do. And then once my alert goes off, I look at my computer, I look at my phone, I see if it gives me an entry. If it gives me an entry, I enter into the trade. I place my stop loss and my take profit, and I walk away, because I don't have to sit here and watch this trade go. I know it's either going to win, it's either going to lose. I know me gluing my eyes to the screen right now is not going to help the trade win even more or help the trade lose even less. So that is one of the tips and tricks that allows me to trade this strategy in less than 30 minutes a day, honestly. So definitely, if you're somebody who's like works a job or is in school, or if you're a parent and you have kids and things like that, you don't have a bunch of time to sit at the charts, this strategy is absolutely amazing, because you can use these alerts knowing when you're actually going to enter into these trades and when you're not. Now, we went over this example. As I mentioned, very, very simple entry model we're looking for. Let's say we're looking at a support zone. We know price is making these lower lows and lower highs into our zone. We're simply waiting for price to break above a most recent high after it tapped into our support zone. As soon as it breaks above it, we're entering into the trade. Stops is below the most recent low, and we're targeting one of the most recent highs that we had. As I mentioned, same thing vice versa. If we're looking at a resistance zone, we know price will make higher lows and higher highs going into a resistance area. We're simply waiting for price to break below a most recent low zone, which is right here. As soon as it breaks this area right here, we are entering into the trade. We're putting our stop loss above the most recent area that it went before we enter into our trade. And then we're targeting a most recent low area. Simple as that. Now, let's go into an example of a break and retest, because honestly, you trade the same exact way, the same way we just went over this trade, the same way we drew out this break and retest example that we just went over. It's the same thing, except we're waiting for price to break below it, retest it, and then we're going down to our 1 minute time frame and looking for that same entry criteria that we just went over on this example right here. All right, so here we are. Keep in mind, this is on YM, which is a futures pair. This strategy, I've used it when I traded Forex, trading any pair on Forex. I've used it trading futures, NQ, ES, YM. I don't really trade it trading gold. If I'm being honest, me and gold have bad blood. I do not trade gold anymore. But I've traded using basically every single pair that you can think of. I trade it with crypto. I trade it with stocks. But in this example, we're going to go over a futures pair called YM, and we're going to show you a break and retest. All right, so we're going to draw this the same exact way that we talked about from the bottom of the body to the wick of the lowest body right here. We're just going to drag it across. And all we're doing now is waiting for price to tap into our zone. So let's fast forward, wait to see if we can get price to actually tap into our zone here. Boom. We now see price tapped into our zone right here. And if we look, we're creating these higher highs and higher lows that we talked about. So price bought up here, sold down right here, bought up here again, sold down right here, bought up right here, sold down again right here. So we created all these lows. We have a low created right here. We have a low created right here, a low created here, and a low created here. But right now, as I mentioned, we're looking for the break of the most recent low. The most recent low is right here. Because as I mentioned, we're looking for an entry now because it already tapped into our 4-hour zone. So as soon as price breaks below this, let's see if we get a break below here. All right, here we go. We got a break below it. So we would have entered as soon as it broke below it. We put our stop loss above the most recent high. As we mentioned, this is the most recent high. And then we're targeting any of the lows. As I mentioned, we have a low here. We could target here. We have a low here we can target. Or we can just target this low right down here. We'll just target this low for the sake of this video. And let's fast forward to see how this plays out. Boom, perfect. Price literally just rejected exactly off of here, as I mentioned. And the reason it did it is because we followed the same exact plan that we talked about. We had the break and retest, meaning we had a previous support zone that price broke below. We simply waited for price to come back up to retest this area and treat this previous support zone as now a resistance zone. As soon as it tapped our previous support zone, which is now a resistance zone, as you see it tapped it here, that's when we had our eyes open, ready for our entry criteria, which is a break of a most recent low. This was the most recent low. We entered as soon as price broke below the most recent low, which is right here. And then we put our stop loss above the most recent high, and we targeted either one of the lows depending on how long you want to hold your trade. This trade actually ended up hitting within a matter of 15 minutes. So you could have had a 15-minute workday and been completely done. All right, so we see prices already bounced off this zone. I have it drawn up over here where it was marked off from the price action from yesterday. We already tapped into it again earlier, but what I'm looking for right now is for price to tap back into that zone a little bit closer to market open. Market open is in about 3 minutes from now. So I'd love it to tap into this zone again and then break a recent low. Right now, the most recent low is right here. So at market open, if it breaks this low without tapping into my resistance zone again, I will still take the trade because we have already tapped into my resistance zone, but I would just prefer it to tap into it again a little bit closer to when our entry is. We'll watch to see if we can get this entry and then hopefully ride this trade down to 49440. Let's see. This would be my TP I would look for if we're able to get an entry here at market open. If not, I think we might have a setup later on NQ, but we shall see. Hopefully we get it. Look, we might get a sell here before market open, which I hope doesn't happen. I want this to happen after stock market opens, which is in about 2 minutes from now. Let's see. All right, I just want to set this. I'm gonna set a sell stop order right here.
Order working.
Just in case market open pushes fast, because YM does that sometimes. Hopefully it doesn't tap into it before this next candlestick starts. Here's market open.
Stop filled.
All right, we just got entered into the trade here. TP1 is at 5.3. TP1 is right down here. TP1 hit. We're up 1500. This is pushing beautifully. I have my stops above the recent swing high before our entry. My TP is all the way down here. Hopefully this bullish momentum lasts. We're up a pretty decent amount here. TP2 is at 512. So TP2 is right here. If it hits TP2, I might trail my stops to break even because this is selling off very fast, which is good. But then you also have to realize when price sells off really fast, it could also buy back up really fast. So I'm hoping that this selling pressure and momentum will last all the way down to the take profit zone before it bounces back up, because price is like a freaking rubber band sometimes. The more it pulls down really fast, the harder it'll bounce up really fast. So TP2 is hit. TP3 is 476. I haven't trailed my stop loss just yet. So my stop loss is still at the high point. Full TP is right here. Come on, man. Come on. Just give me my money, man. Boom. Full TP hit. That was $5,500. Super. That was an absolutely amazing trade. Super, super smooth. So we did end up tapping back into that zone that I talked about. So this was our resistance zone that we drew on the 1 hour time frame. Price bought back up. This is a really fast trade. Price bought back up to it right here at about 7:30 this morning. And then it made this low here. Price tapped back into the zone at close to market open, which is what I wanted. And then we broke that recent low for our entry. Stops was above it. This is textbook, literally the same exact strategy that y'all see me take every single freaking day. Except this, usually these setups take like 20, 30 minutes, sometimes an hour. This was what? 1, 2, 3 1-minute candlesticks. That's a 3-minute trade and it's still selling down. I could have held this much longer, but I'm not gonna be greedy. Solid trade here, man. No complaints. All right, so now we're about to go over another one of my favorite strategies. It is absolutely amazing for beginners because it is so checklist, so structured, where it's really hard to mess up. Like I'm gonna dive through or go into the checklist that you have to follow. If you're able to follow this strategy has absolutely printed me and so many of my students money. A lot of beginners lean towards this strategy just because of how simple it is. It is a scalping strategy, meaning it's great for people who are able to be at their chart and wait for setups to happen. If you're someone who wants to be more passive, this might not work for you because you have to be at your charts waiting for it because it happens that fast. You'll enter the trade and you would have hit TP within a minute or 2 minutes, sometimes a few seconds at that. So you have to be somebody that can sit at your charts. But if you're the type of person that just wants to get in and out of trades very, very fast, this strategy is absolutely perfect. Like this thing absolutely freaking kills it for me. It is my go-to strategy whenever I have time to sit at my desk. It is my favorite scalping strategy that I've literally ever traded over the last 9 years of me trading. So yeah, let's get into it. All right, so here we are on the 6-step checklist. I'm gonna run through the checklist really quickly. If none of this makes sense to you, don't worry about it. I'm gonna show you guys everything that you have to do. I'm gonna walk you guys through all of it and a bunch of examples and the live trade and the backtested data. You're gonna have everything you need to be able to start using this strategy. So first of all, the first step is setting up our charts correctly. It's 2 things we need to do. We need to go on whatever trading platform we use, and we need to switch from regular candlesticks to Heikin-Ashi candlesticks. Now, how you do this on TradingView is you hit this drop down. You see a bunch of different chart types. You can have line charts, columns, volume footprint. Just click this one right here that says Heikin-Ashi candlesticks. Now, if you don't know what Heikin-Ashi candlesticks are, we're gonna go over that in a second, but that's just the first step. The next step is adding the indicator. I told you guys this just requires 1 indicator and it's a super, super simple indicator. All you do is go to indicators, type in EMA. You're gonna see moving average exponential pop up. You're gonna wanna press that. You're gonna see the indicator actually pop up on your chart here. It's gonna look like this, EMA 9 close. We need to turn this into a 100 EMA. Right now, as you see, it's a 9 EMA. I already have the 100 EMA on here, but let's just redo it. So like I said, as soon as you add the indicator, it's gonna pop up right here, and you wanna just press this gear icon that will take you to the settings. Once you've opened up the settings, go to inputs, and next to length, change it from 9 to 100. This would then change your indicator to a 100 EMA versus a 9 EMA. Now, something I just personally do, this has nothing to do with the strategy, just a preference under style. I changed the color of it from blue to white just because my chart background is black. So I'd rather have a white line or a white indicator. And I just press OK. So now I have my indicator and I have my chart set up correctly on Heikin-Ashi candlesticks. Now let's get into exactly how to do this strategy. But first you have to understand what this strategy is. And in order to do that, you have to understand basic price action. Price action simply tells us that the market just never goes straight up or straight down. Price will go up, down a little bit, up, down a little bit, up, down a little bit. And then obviously vice versa, when price is going down, it goes down, up a little bit, down, up a little bit, down, up a little bit. Now, these areas where price has these small pullbacks, those are called pullbacks or retracements. You see here, we have another retracement. Here we have a retracement. A retracement simply means that it's retracing and going in the opposite direction than the overall trend. Here, the overall trend is up, but when price is going down, we're having a retracement. Same thing here, the overall trend is down. So when price is going up, we're having a retracement. This strategy is catching these retracements at their ending point before they start going back in the overall direction. And that's very important because as traders, we always want to trade in the direction that the market is going. So we're catching it at the perfect time when it had a small little break. We're catching it before it starts going back in this overall direction. And then we're riding the trend right back up to therefore profit on the overall direction. So now that that is understood, market structure, which is step 2. And this is what we're using our EMA for. The way we tell if price is in an uptrend or a downtrend is by using the EMA. If the candlesticks are above our EMA, we're only looking for buys. If candlesticks are below our EMA, we're only looking for sells. So for example, let's imagine that this green line is our EMA, right? This is our EMA. And let's imagine this yellow line is price. These are candlesticks. If we're above our EMA, we know we're only looking for buys because the overall trend is up. If we're below our EMA, we know we're only looking for sells because our overall trend is down. So that's how we're using it. Only buys if price is above the EMA and sells if it's below it. Now, next, what we're doing is we're waiting for that clean pullback. We're waiting for that retracement to happen. Now, what does a clean pullback look like? And don't worry, we're going to go over a bunch of examples of it on the charts here. But a clean pullback in words is simply at least 2 clean opposite color candlesticks in the pullback direction. And what I mean by clean is that there are candlesticks that have no wicks on the top if we're looking for a buy pullback. And if we're looking for a sell pullback, meaning price is pulling up, we want candlesticks that have no wicks on the bottom. And I'll show you guys what that looks like, because if you've never used Heikin-Ashi candlesticks, you might be confused on what the heck, there's no candlesticks that don't have wicks on the bottom or the top. We're gonna go over that in a second. But on to the entry signal. So once we've had at least 2 opposite color candlesticks, or we've had our pullback, we're then waiting for our entry. And our entry is a high volume doji candlestick. If you don't know what a doji candlestick is, it's simply a candlestick that has a small body. Imagine this is the body, and has long wicks on the top and long wicks on the bottom. This is a doji candlestick, and this signifies indecisiveness. Meaning, usually when you see a doji candlestick, that means that whatever direction it was going in, it's about to reverse because it went down into an area, had a doji candlestick, showed us that it's uncertain in this area and it's probably about to start reversing. That's the entry we're looking for. And remember, it says a high volume doji candlestick. Let's say this is the candlestick before it. This is the size of the candlestick before it. As long as the doji candlestick for our entry is bigger than the candlestick before it or the candlestick before that one, that is signified as a high volume doji candlestick. And as soon as that candlestick closes, that's when we're entering the trade. Now, once we've entered the trade, we have to put our stop loss in and we have to put our take profit in. So for step 5, our stop loss is always going to be below the doji that we entered on if we entered for buys, or above the doji that we entered on if we entered for sells. Again, we're going to go over a bunch of examples of this in a second. And then as far as the take profit, we're always going for a 1-to-1 risk to reward ratio minimum. I do have students of mine that will trade this strategy and will hold it for a 2-to-1 or a 3-to-1 risk to reward ratio. But just be aware that the win rate will go down if you do hold it longer. That's honestly with any strategy. And we're going to go over the stats of this later on inside this video so you see exactly what win rate we have on average with this strategy. But now that we've went through this checklist and you understand it, let's go through it on a chart so you can actually see it happen. So I have a few examples here to go over with you guys so you guys can see it live in action. Keep in mind, these are trades that we took live inside of my inner circle. But as I was saying, here is an example that we had taken. And I'm going to break this down for you guys so you guys can go through all the steps with me. So we're on Heikin-Ashi candlesticks. Now I know you might be saying, I've never seen these candlesticks before. The only 2 main differences between Heikin-Ashi candlesticks and regular candlesticks is, for one, each candlestick, the body starts in the middle of the candlestick before it. If you look at this candlestick, the body of it starts in the middle of this one. That's one. Now, the other part that's different is that the body on a bearish candlestick, which is the bottom of it, is the average of where price has been throughout the candlestick. That isn't where price closes. If you guys know the bottom of a body on a bearish candlestick on regular candlesticks, that's where price closed at. It's different on Heikin-Ashi. That's the average of where price was at. Meaning price could have been up here, price could have been over here, price could have even closed right here. But this is the average of where price has been throughout this entire candlestick. And I've made so many videos about Heikin-Ashi candlesticks and the benefit of them, why they're an amazing tool to use. But I just want to break down that so you guys understand that. But now you're seeing here all these candlesticks that have no wicks on the top, or you're seeing candlesticks right here, like this one, that have no wicks on the bottom. So when we're referring back to our checklist and we're looking for those pullbacks, those two clean opposite color candlesticks, this is what I'm referring to. Now, we're on Heikin-Ashi candlesticks. We're on the 1 minute time frame. This is all done on the 1 minute time frame. We're not switching time frames at all. We're not doing any type of higher time frame analysis and then going down to the 1 minute time frame. We're staying on the 1 minute time frame. This white line that you see right here, that is the EMA that we just put on. Remember, it was blue, but I changed it to white. And then what are we seeing here? We see price is actually below the EMA. The EMA is up here. We see price is below the EMA. So we're only looking for sells. Now, what is the next step on our checklist? Because we know we're only looking for sells, we're waiting for a clean pullback. A clean pullback is at least two of these candlesticks that have no wicks on the bottom. Now we can see that we've actually been below this EMA for a long time, but we never had our clean pullbacks. If we look at this pullback right here, we had some green candlesticks that's going up, but both of these have wicks on the bottom, meaning we didn't get our two clean candlesticks, our minimum of two clean candlesticks. But when we fast forward a little bit, we still see we're having little pullbacks. Here we see we had two clean candlesticks, but we had a small doji. When we fast forward here, we say we had our pullback where we have 1, 2, 3 clean candlesticks. And then what did we end up getting? We ended up getting a high volume doji candlestick. As I mentioned to you guys just want the size of the doji candlestick. So if we draw a box around this doji candlestick and put it over the candlestick before it, it's bigger than this candlestick. And it's also bigger than the candlestick before that one. We just need it to be bigger than at least one of the two last candlesticks that were printed. And we see here, it is. So I mentioned as soon as this candlestick closes, we are entering into the trade. So for sells, we would come over here to our short position tool, and our entry would be as soon as this candlestick closes, but I always draw it as if price closed right here. So we'd click right here. That's our entry. And our stop loss, as I mentioned, is going above the candlestick that we entered on since we're looking for sells. And we're dragging our take profit until this risk to reward ratio says at least a 1-to-1 risk to reward ratio right here. And as you see, this trade ended up winning within 2 minutes. As I mentioned, this is a scalping strategy. This is a super simple example of how well this plays out when you wait for everything to align. If we had rushed it and tried to enter into, let's say, a trade right here where we didn't wait for a high volume doji candlestick, this trade would have lost because we would have entered as soon as it got here, stop loss would have been right here, and price would have instantly taken us out. That's why it's important that when you're using this strategy, you have to follow the checklist. Now, let's fast forward and look at a buy opportunity because the same buy opportunity happened on the same exact day. So if we look here, we see we're now above the EMA. We've created market structure above the EMA. Now at this point, we're simply waiting for our pullback to the downside, at least two of these candlesticks that have no wicks on the top now, since we're looking for buys. And then we're waiting for our high volume doji. So if you see here, we had our pullback right here, and then we had a doji. But this doji is small, meaning it's not high volume. And again, if we had taken this trade, put our stop loss below the doji candlestick, we would have lost the trade. That's why we have to wait for the high volume doji candlestick. Now, what do we end up getting here? We had two clean candlesticks on the pullback, and then we got our doji candlestick. Keep in mind, a doji candlestick is not going to be perfect every time. It's not always going to be a perfect candlestick that has a super small body and equal size wicks on the top or the bottom. We just want to see an indecisive candlestick that has a small body with wicks on the top and the bottom. So this is a doji candlestick as well. We'd enter as soon as this doji candlestick closes. So we'd enter right here for a buy. Our stop loss goes right below the doji candlestick that we entered on. And we're dragging this until, again, the risk to reward ratio says a 1-to-1. And as you see, this trade, it ended up taking a little bit longer to hit. It ended up winning in 6 minutes. But still, this is a scalping strategy. Extremely fast, in and out on this trade, and was able to make a good amount of money with this super simple trade by following the same exact 6-step checklist that we just went over. All right, so we've went over the checklist. I've showed you guys multiple examples, but now let's hop into an actual live example so you see how this looks like in real time, how I'm actually managing my trade once I'm in it.
All right, we might actually be able to get another setup here. We just need to wait for our doji candlestick now. We need this doji to get bigger so it can be high volume. Here it goes. This is looking solid. All right. Let's wait for this candlestick to close. All right, I'm getting in this.
Order filled.
I'm in it. Put my stop loss above the high of the candlestick. And a 1-to-1 falls at 4683. Having a nice push out of here. We're up $100. Beautiful. Up $200. Up $300. Beautiful. I have my stop loss right above the candlestick I entered on, and my TP is right down here. It's at about a 2-to-1. Sorry, it's about a 1-to-1 risk to reward ratio right now. Hopefully we continue to have volume to the downside. We're up 400, 500. Boom. We're right here by our TP. Come on.
Order filled.
Perfect. All right, so as you can see, that is an extremely repeatable process. It's extremely simple. We're simply just waiting for all the checklist things to happen, then we're executing on it. Now, with that being said, let's hop into the back tested data so you guys can kind of see the type of stats that I've been able to achieve with this strategy. All right, so here we are on the back tested data. This is actually a month's worth. I just chose a random month and I just started back testing it to give you guys as much data as possible. So in this random month that I chosen, we had a win rate of about a 75%. As you can see, we took 32 trades total. We had 24 wins, 8 losses. So this comes out to roughly around a trade or 2 trades per day. But keep in mind, I only traded 1 pair with this strategy. Now, having used this strategy for over 2 years now, the win rate generally is around a 68%. The highest I've ever seen it is about a 78%. So it roughly chills around that area. But in this specific month, it was about a 75% win rate. If you scroll down here, our average risk to reward ratio was a 1.4-to-1 risk to reward ratio. Now, you might be asking me, how the heck does that happen? It's because, as I mentioned to you guys, when we're entering the trade, we're putting our entry as if price closed right here. But we know with Heikin-Ashi candlesticks, where price body is at is not where price actually closed. So we have our entry as if it's here, and we're entering with a market order as soon as price closes, but price could have closed right here, right? So essentially, that would make our actual entry right here. So we'd actually have a 1.6-to-1 risk to reward ratio. Well, we're planning each and every one of our trades as if price, as soon as we entered, was at the tip of the doji, giving us that 1-to-1 risk to reward ratio that we talked about. So that's why you see it's actually always going to be a higher risk to reward ratio, because every single time we're always getting more than a 1-to-1 risk to reward ratio. Throughout this entire session, I did not hold this trade longer than a 1-to-1 risk to reward ratio on paper, meaning my drawing that I had was never above a 1-to-1 risk to reward ratio. But as you can see, these stats are absolutely fantastic. I want you guys to go and back test this for yourself. Don't just take my word for it. Go back test this until you understand it, until you can recite that 6-step checklist off with your eyes closed and you know exactly what you're looking for every single time. Try it out for yourself. Come back here, put in the comments, oh, this strategy sucks, or this strategy is absolutely freaking amazing. I don't know. Go back test it for yourself so you learn it for yourself. All right, now this next strategy is one of, I know I've said this for all the strategies, but this is one of my favorite ones. It's super, super simple. If you're still kind of struggling with support or resistance, this simplifies it. It is my London support and resistance strategy. It goes based off the London zones, and I'll dive into it inside the video when we go deep into the this strategy, which we're about to do right now. But it uses the price action that happened during London session to help us see what will happen during New York session. What that means is I don't have to worry about finding regular or random support or resistance zones. I can simply rely on the London session to show me which support or resistance zones I should be looking for. It's, again, not a scalping strategy. You will be in and out these trades fairly quickly because it happens close to market open, stock market open. So there is a lot of volume, but it also is something where you're only going to get one setup a day specifically. And you'll see inside the detailed walkthrough when I walk you guys through how to do this strategy. But it's amazing for people who also don't have a lot of time. You can utilize alerts with this one as well. So you don't have to be sitting here looking at your charts. Like I said, I'm probably going to say this for every strategy, but it's one of my favorite strategies. Now, I'm gonna be honest with you guys. There was a point where my charts literally looked like this, and it was the most confusing thing ever. I had 100 million indicators thinking that it was actually helping my trading, but in reality, it was just making my charts look like a freaking kid's coloring book. It was only when I actually ended up removing all of these indicators that I found consistency and clarity with my trading. But after testing hundreds of indicators, there's only been really one that has been super beneficial to me, and that's the one we're gonna talk about in this video. So first things first, what is the indicator? Type in indicators right here, or press indicators and type in this indicator called kill zones. It's by this person named Oscar VS. It's 2.9 thousand people using this indicator. And I'm going to be honest with you, all 2.9 thousand people are probably the people that I've put onto it, because I've told all my students about it. I've told all my inner circle members. I've told people on YouTube about it a long time ago when I first started off using it. I've been using this indicator for, I want to say, 5 or 6 years now. And as I mentioned, my entire journey of trading the past 8 years, this has been the most beneficial one to use. But nonetheless, let's add it to our chart here. Make sure it's the one by Oscar VS, because there's a couple other ones. I don't know any of these people. I don't trust any of these people. I don't know what any of those indicators do. So the one by Oscar VS. We'll exit it out and you'll see it'll pop up onto your charts here. Now, what this indicator does, it shows you what price has done during certain trading sessions. If you're new to trading, or if you don't know, there are multiple different sessions. We have the New York session, we have the London session, we have the Asia session. And simply what those means is those are certain periods where the market is open in certain parts of the world. And the reason why that's so important is because the big banks and the big hedge funds that actually move the markets, if you did not know, us, no matter if you're trading 10 contracts, 30 contracts, if you have a $10 million account, your trades that you're putting in, they're not moving the markets. It's the banks, it's the hedge funds, it's the big ballers that are putting out billions of dollars. But anyways, what this indicator is showing us, it's showing us what these big banks and these big hedge funds did during these different sessions. And it shows us the important points or the important price areas where these big banks or hedge funds actually found fair value, or where they found price was overbought or oversold, hence creating these support and these resistance zones. Now, it's important to know that these different sessions don't necessarily work together, because like a bank in London isn't necessarily working together with a bank in New York. So certain things that happen during London session do affect what happens during New York session, and these New York traders will trade a different way depending on what happened during London session. Same thing, Asia session gets affected by what happened during New York session, and then London session gets affected by what happened with Asia session, so on and so on and so on. So this indicator actually breaks it down clearly for us, showing us exactly what's happened during these sessions, and that gives us a much clearer read on the charts. Now, when you first put this indicator on, you're going to see it does not look like this. So what I would suggest you guys do, if you guys like clean charts, because honestly, if it's not clean, you're going to see a bunch of different things here. I'll show you guys an example of it. It'll really just look like this. It still looks kind of crazy. It's a bunch of things on my chart. I don't personally like that. So if you're the type of person that likes their charts to be clean, but still wants to get the value from this indicator, you can copy the settings that I have here under style, under inputs as well. I only care about the New York session and the London session. I'll show you guys exactly why later on this video when we go over how I use this indicator to actually trade and find high probability setups. But these are my settings that I have for kill zone. I don't really change anything else except for the tabs in the input and the tabs under style here. But once you have this indicator on your chart, now you're able to clearly see what happens during these London session and these New York session times. So for me, The yellow line is when London session starts. So from the yellow line all the way up into the white line is London session. Now keep in mind there is an overlap. So London session doesn't actually end when this white line starts. The white line just simply tells me that New York session started. And if you didn't know, London session and New York session overlap for about 3 hours. So really right over here is where London session usually actually ends. But this is when New York session starts. But as I mentioned, it's important that we understand exactly what happened during these specific trading sessions that would allow us to have a better game plan moving forward into the next trading sessions. As you see here, we have a couple examples pointing out of setups that I actually take, things that I actually look for in the markets and how it is affected and how I'm able to use this indicator to easily find it. Because as I mentioned earlier, these pivotal points that these banks make during these specific trading sessions, meaning the highs and the lows of these different sessions, can be used as extremely valuable support and resistance zones, meaning a support zone that was created during London session is oftentimes touched again during New York session and respected. You'll see that example right here. This yellow line starts London session, right? And as you see, this is the low of London session. So I drew a box right around the low of London session. If we drag that across, the white line is when New York session started. And what happened after New York session started? Price tapped into that London session and bought off of it. This is how I'm trading this using this indicator. I'm looking for the lows and the highs of London session or New York session and using that to trade the next session. As I mentioned, you can see Tokyo session here as well. If I put this on my chart, it starts right here. I don't really trade Tokyo session too much, and I don't trade London session. So there's no need for me to care about what happened during Tokyo session or Asia session. I really more so care about London session because I mostly trade the New York session. So I want to know what happens during London session, which is right here. That way I can plan for New York session. So as you see in this example, we marked off the low of London. Price obviously ended up buying off the low of London, creating a high for London session. New York session started right here at this white line. Price sold down into the London low and bought off of it. This is an easy buying opportunity because we know that London session support or resistance zones are very valuable in the New York session. We can see another example of right here. This is the London session high right here. As you see, London session high, New York session started, we sold off. But what ended up happening? Price ended up buying back into the same London high area right here, same London high area right here, and then ended up selling off of it after it tapped into it again. This is a clear example of the fact that London session support and resistance zones are extremely valuable and respected during New York session. We can go back and see multiple examples of this. We can see this is the low that was created during London session. We can see we have a high point created here as well. We can mark this off as the high point of London session right here. And what happened when New York session started? It sold down into London session and then it ended up buying off of London session and respecting London session. Using this indicator to mark off the London highs and the London lows is an extremely simple way for me to find my key support and my resistance levels for the day when I'm looking at the New York market. We can see multiple examples of this. Again, we had the low created during London session right here. What happened? Price ended up selling down into that London session and buying off of it. Extremely simple setup, and we didn't have to do any guesswork trying to find, okay, what's the right support zone? What's the right resistance zone that we should draw, right? We're simply looking at the low that was created during a specific trading session and then waiting for the next session to tap into that zone and respect it and look for entries. Now, it's not just the London low that I'm looking for. It just so happened that those few examples that we went over are good examples of the London low being tapped into during New York session and buying off of it. But if we look at the London high area right here on this example, and I know we have this marked up, but if we drag it across, we can see price. We know price doesn't just break above these support or resistance zones, right? It breaks above a resistance zone, for example. Imagine the resistance zone is right here. It breaks above a resistance zone and it'll come down to retest that same zone and then it'll buy off of it. What do we see happen here? We had the London high resistance zone created. Price broke above it, came down to retest it right here and bought above it. We could have entered for a buy here. Same thing, you see it respects that same key area again right here. And we can see this multiple different times when it comes to trading the London session high and the low. We see the high that was created here What happened when New York session started? It bought back up into this zone and sold off of it. And simply all I'm looking for once price taps into the London high or London low zones is price to tap into it, show some consolidation, and then break out of that consolidation. So it tapped into it right here, for example. We see price created consolidation right here, meaning price just chopped around right here. We could have just simply waited for a sell to the downside after it tapped into it. It broke the consolidation to the downside. Could have entered for sells right here. Stop loss wherever we put it, take profit wherever we put it. And as you see, it would have absolutely ripped to the downside. Now, this example we just went over is using ES, right? We can also look on NQ. There are so many different examples across different instruments. I use this indicator along with the support or resistance zones that I get from using this indicator across multiple different instruments. NQ, ES, YM. You can use it with Forex. You can use it for gold. Just the examples we're going over right now is ES and NQ. Now, here on NQ, you see we have another example right here. We have a low created during London session. What happened during New York session? It started, sold down into it, and then bought off of it. Sold down into it again right here and bought off of it because this is a strong zone. If we go to the side, we can see another example of price having this low during London session. It sold down and broke through that London low without respecting it, which is fine because we already talked about when price breaks below an area, it'll come back up to retest it and sell off of it. And what ended up happening when price broke below it, came back up to retest that same London low area. What did it do? It sold right off of it. And you can see this time and time again happening. It's why I only use this indicator to actually find my high probability setups when I'm going into the day. Right here, you see we have a high created during London session right here. What happened during New York session? It broke above it, came back down to retest it, and it bought off of it. You're going to see this happen day in and day out. And this is the reason why this indicator right here is all I need to trade with.
All right, I'll be looking for buys off of the London low here. Let me mark it up on this chart here. Rectangle. So this essentially is the London low right over here. This area that we're currently in right now. So I'm looking for price to bounce off of here. We've already started to bounce off of it earlier this morning, but I want to wait till after market open. Right now we have a decent amount of zones to look for breaks above. Sorry, decent amounts of areas for price to go above. So I'm looking for price to break above here for an entry, or break above here for an entry, or break above here or here for an entry. But I want this to happen after the stock market opens, which the stock market opens in a little bit less than 3 minutes from now. So we'll look to see if we get a break of this high here or this high. Potentially, honestly, I'd probably wait for this high. This one just looks a little bit more clean to me. Then I'll look for an entry here off this London low area. That's if we're able to hold here. If price creates a new low and breaks below here, because remember, this green box is my support zone that was made during London session. So if price comes down and breaks this low, I won't be looking for this setup anymore. But yeah, we shall see. About 2 minutes left until market open. We'll see what the price action does. And if at market open, it actually ends up selling down. Sorry, everybody, I'm repeating this. I'm saying it to I'm recording this video as well. I know we just went over it, but yeah. So I am looking for this, and all the people that's watching this on a recording, I'm talking to my inner circle because we just went over it. But now I decided to record the trade because it looks like it could be a pretty solid setup here. Anyways, I don't know why I'm explaining everything to everybody. Just know we're looking for buys off of here for a London support or resistance setup, or really a London support zone. We're buying up to here now. I hope we don't break this high before New York session starts, which is in a minute and 10 seconds from now. If we do get an entry, I'd be targeting this recent high up here. So probably somewhere right here, if I'm being honest. I wouldn't target the entire thing. And this should be about a 2-to-1 risk to reward ratio, maybe a little bit less. Sorry, maybe a little bit more. I'm actually gonna put my stop order here. So I'm gonna put a buy stop order at the break of here. I'll drag my take profit up here. My stop loss will be below the most recent low. The most recent low right now is right here. So we'll see. If we break this low though, I'm not gonna lie, I might just close this entry out. I'm not in it yet. I'll get entered into it as soon as it breaks my stop order, which is at this green line up here at the break of this high.
Let's see though. We shall see. We do have a zone higher up at 49396. 49396, which is up here, but we'll have to see. All right. Looks like it's trying to inch towards my entry here. Oh, boom. All right, I'm in the trade right now. It messed up my stop loss. So stop loss below the most recent swing low, which is right here. My stop loss is at 29278, sorry. Oh, it literally got right by our stop loss. I don't like the fact that it wicked off of here. I like to see good volume bouncing off of here. Oh, now we're getting pretty solid volume to the upside. But I don't ever like seeing price wick my entry and then reverse down. That's usually a sign that there's not strength of the breakout of that change of direction, or sorry, break of structure. But right now this is looking solid. But you see how it instantly sold down? I usually don't like that. Usually that leads to a loss, but right now it's pushing up nicely. We just actually hit TP1 here. TP2 is at 365. Which we're about to hit right now. We hit it. TP2 hit. This is actually pushing very nicely. We're up 7K right now. I'm thinking about moving my take profit higher because we have that additional zone, but I'm just scared that, oh, come on, just hit it. Hold on. Just hit the, come on, man. What ends up happening is when price buys up really fast, it's also going to sell down really fast. Boom. Full TP hit. About 8K on that one. A little bit over a 2-to-1 risk to reward ratio right there. Hope you guys ate with me. This is exactly what I wanted to see. The only thing that kind of threw me off a little bit is because we did sell down right after it tapped me into the trade. But that's fine because it still didn't even hit our stops. That's why I always put my stop loss a little bit below the most recent low. So this is the most recent low right here. And you'll notice, here if we draw a line, you'll notice that price literally just went like one tick below the most recent low. That's why I always put my stop loss just a little bit below it, like 3-4 ticks below the most recent low. This is still pushing up nicely, actually. But this is exactly what I wanted, as I was telling you guys. I wanted price to not create a new low and break this new high close to market open. I think it did it right on the market open candlestick. Yeah, it did it right on the market open candlestick to the upside. Beautiful. And this is pushing up nicely. And remember, this entire zone, for everybody watching this video, the playback, is based off the London low. The London low was created right here. This is the zone I have on my charts. Price bounced off of it during London session here, bought up. Bounced off it again right here, bought up. And then now that the stock market is open, that's how we're having this big move off of here. This is when it's actually respecting that London zone. So that's why when I'm telling you guys about this strategy, I don't like taking the setup before the stock market opens, because the stock market is what pushes the actual move to happen. So yeah, pretty beautiful freaking trade. And I don't want you guys to think that this happens all the time. Like, this setup is not going to happen. This fast of a setup is not going to happen all the time. Like, this hit full take profit in 2 minutes, which is beautiful. But most of the time it'll take like 15 minutes or 30 minutes or so to hit take profit. But this is beautiful. No complaints at all. All right, so we talked about the London support and resistance strategy. We just went over it. Now we're going to go over another one of my elite strategies, which is the London breakout strategy. This strategy is a little bit more fast paced, meaning it's not going to be as passive. So you kind of have to be at your charts. You can still utilize alerts, but these setups happen fast. Like, you'll get into a trade and you can be out the trade in freaking a minute, 2 minutes, 5 minutes sometimes. I wouldn't necessarily say it is a scalping strategy. It just so happens that these setups tend to like move really, really fast. So that's just something to keep in mind. But again, you're only going to get 1 to 2 setups max of this. If you're the type of person who just wants to like get 30 trades a day and like scalp all day long, this strategy might not be for you. But if you're someone who wants to be a little bit more passive, not as passive as like regular support or resistance, but still have a little bit of speed, this strategy is amazing. It utilizes, again, the London session to let us know where we should look for breakouts at. And honestly, like I said, I said it multiple times. I'm going to say it again. This strategy absolutely freaking kills it. Let's get into it. All right, so here we are on TradingView. I call this strategy the 5-minute NQ London session breakout strategy. Specifically for the reason that it's based off the 5-minute time frame. You're not going to any other time frame. You do not need any other time frame. We're only trading one pair, which is NQ, and you're doing all of this based off of the London session price action. I'm going to show you exactly what that means. I'm going to show you how to find that if you don't know what to do. I'm going to walk you through every single step here, but it's a simple 7-step checklist that if you follow this checklist will print you money. This is a proven strategy that has been proven to work month after month as long as you follow the checklist and you don't skip anything. So let's dive into this checklist. So the first step is we need to identify what London session is. I'm going to show you guys an example of a quick way to do it, but in simple, we're looking at the price action from when London starts, which is at 3 a.m. Eastern Standard Time, all the way up to 9 a.m. Eastern Standard Time. And we're basically going to draw a box around that whole price action, or a box around all those candlesticks. Now, the next thing after that is we're going to wait for a 5-minute candle body, meaning the body of the candlestick, to close above or below that high or that low. Basically, we want a candlestick to close outside of the box that we're going to draw. The next step is we're going to take an entry as soon as that candlestick closes. We're doing this on the 5-minute time frame, so we're waiting for a 5-minute candlestick to close outside of that area. Once we have that close, we're entering the trade. Now for our stop loss, it's very important that you use a stop loss, and the stop loss placement is extremely simple. We're placing the stop loss just below / above the candle that we triggered on. So if we entered for a buy and we had a candlestick that closed outside of our zone on the upside, we're putting our stop loss below the candlestick that we entered on. And then vice versa when it comes to sells, if we had a candlestick that closed on the bottom of our zone, then we're putting our stop loss above that candlestick since we entered for a sell. Step 5, our take profit is always going to be a 2-to-1. As I mentioned in the beginning of this video, this strategy ensures that every time you win a trade, you're winning twice as much as you were risking, or twice as much as you lost, which means that you don't need to have a high win rate at all. You don't need to win every single trade. You can lose 2 trades in a row, win 1 trade, and you're back in profit. Now, there's 2 more rules to this that you need to follow to make sure that this strategy works for you over a long period of time. You're only taking 1 entry per day, whichever breaks high or the low first. Meaning, if it goes and closes above our zone that we're going to draw out, and then we enter for a buy, but then it sells down, we lose that trade, and then it goes and closes on the bottom of our zone, we do not take that second trade. This is a one and done strategy based off the London session breakout. And then the last rule that you need to make sure that you do focus on is that you don't take any entries after 11 a.m. EST. The reason for that is because after 11 a.m. EST, there's not a lot of volume. And since this is a breakout strategy, we're relying on volume. And we need a lot of volume for this strategy to work. And after 11 o'clock, the volume dies out. So that's why we don't take any entries after 11 o'clock. Now let's hop into some actual examples so you guys see exactly how to do this. All right, so here we are on the charts. As you see, I already have this area marked up. I told you guys you have to draw a box around the price action that happened during London session, basically from 3 a.m. as you see on the bottom of my screen here, from 3 a.m. all the way up into 8 a.m., which is right here. Now there's a simpler way to do that. If you go to indicators up here on TradingView and type in kill zones and press on the one made by Oscar VS, this one right here, you'll see on your chart, you'll have some lines pop up. Now my settings have been changed. If you come over here to the drop down and I go to settings, you can actually turn off certain things. This is what my settings look like. It really doesn't matter much. I just have my New York kill zone on and I have my London kill zone on because that's the time frame that I want to see it. And obviously you can change the style as far as changing the colors if you want of the lines and things like that. That's all personal preference. But what this does is it shows you exactly where London session starts and it shows you exactly where New York session starts. So if you look here on the bottom of my cursor where you see it says Monday, the 14th July or July 14th, 2025, this is at 3 a.m. right? Now, if I come over here to when this white line is, that's at 8 a.m. And remember, in the rules, we're looking for the price action that's happened between 3 a.m. and 8 a.m. Eastern Standard Time. Sorry. So when we have this drawn out, we have now our zone of interest. Now, the next step in our trading is to wait for a 5-minute candle close. As you see, we're already on the 5-minute time frame. We're waiting for a 5-minute candle close above the high or below the low of that London session time. So, as you see, this is 8 o'clock. We have 8:05, 8:10, 8:15. Then this 8:20 candlestick we see closes outside of our box here, outside of our zone. That's when we're taking our breakout entry. So we take an entry right at the close of this candlestick. Since we entered for a buy, we're putting our stop loss below the body of the candlestick that we entered on. And then we're dragging our take profit. As you see, we're dragging our take profit until risk/reward ratio says at least a 2. And as you see, this trade ended up hitting very, very fast. It ended up hitting, and we ended up winning this trade by 8:30, making and capturing over 190 ticks on NQ with a very, very simple systematic strategy. Now let's go over another example for you. So here we are on another example. Now what we're going to do, we're going to mark up. You can either use the drawing tool to draw a box around the price action from the high and the low of the London session, or what you could also do is you can draw lines on the top of it. So this is the top of the London session, the highest point that price went during London session during this period. And then we have right here, the lowest point that price went during this London session. So you can draw it just like that, or we can draw it as a box. It's really a personal preference. It's going to show you the same exact thing. Now I want you to notice something. As you see right here on this candlestick, we went above the high of London session, but the reason we didn't enter this trade for buys is because we did not get a candlestick body to close outside of this London high. It wicked outside of it, but the body did not close outside of it. The only time it closed outside of it was right here on this candlestick here at 8:45. We would have entered the trade right here for a sell. Since we're going for a sell, we put our stop loss above the candlestick that we entered in. And then we're dragging this take profit until we reach a 2-to-1 risk to reward ratio. As you see, risk/reward ratio is a 2-to-1. And this trade won within a couple of minutes as well. And that profited us 325 ticks, which you could use one contract, depending on the broker, with just $500 inside of your account. This one trade would have made you over $1,600 within a couple of minutes, just following this super simple systematic strategy. Now here's another example of this strategy, but as you see, this ended up going extremely high up. It didn't just stop at that 2-to-1. And it's crazy that one of my inner circle students actually caught a majority of this move. I'm pretty sure he closed it right up here. So he was able to make a ridiculous amount of money. Now, as I mentioned, one of my inner circle students actually took this setup and actually sent it to me and showed me how long they held the trade. If I remember right, it was somewhere up here, but it's the same exact setup that we just went over. I can delete all this and draw it up for you guys once again. We have our London high, which the London high is right here. We can drag this across. Then we have our London low, which is right down here. Drag it across. You can draw the box around it if you want to. It's really up to you. Then next was just waiting for a close outside of it on the 5-minute time frame. And as you see on this 8:10 candlestick, we actually got a close outside of it. Entry right as soon as the candlestick closes. We're putting our stop loss right below the candlestick that we entered on. And we're going for a simple 2-to-1. This trade was hit in less than 10 minutes. But as you see, this trade absolutely skyrocketed to the upside, but taking your 2-to-1 is perfectly fine. And you'll see as you trade this strategy that the results are absolutely amazing as long as you stay consistent with following the rules. Speaking of results, we're going to dive into the exact results that you would have had last month, which is July, if you took this setup every single day when it presented itself, went for your 2-to-1, took your one trade a day, and how much money you would have made with this one strategy, trading one pair. Let's get into the results. Now, before we hop into these results, I have to give you guys a disclaimer that past results does not guarantee future profits, but these results are absolutely incredible. As you see here with this strategy, our total P&L in July was $18,600. Now, let me give you guys a little bit of context. These results that you're seeing here is based off of using 5 contracts per trade. That's it, just 5 contracts. And you can open up 5 NQ contracts with just $2,500 inside of your account, depending on the broker. As you see, we started with $2,500. By the end of the month, we at a total profit of $18,600. As you see, our win rate is 44%, which, if you guys remember, I told you guys every single trade that you take, you're winning 2 times as much as you lose every time you lose. So having a 44% win rate with a set 2-to-1 risk to reward ratio is absolutely amazing. And it shows you just how profitable this strategy can be over a long period of time. And you see, during this entire period, we ended up taking 18 trades total, where we had 8 wins and we had 10 losses. We can scroll down here and actually see the average risk to reward is a 2.02 to 1. The average ideal risk to reward, which basically just shows us how much we could have made if we held our trades a little bit longer. But remember, we're not greedy. We're not here to get greedy. We're going for our 2 to 1. We don't need to hit an 11 to 1 risk to reward ratio every single time. Now, if you come down here, you can see a lot more data as far as the total winners, our best win, our average win percentage, our average duration, meaning each win on average, we were in the trade for about 32 minutes. Then you see the losing data here, but ultimately this is a absolute killer result using just one strategy. Keep in mind, this is one strategy done one time a day, trading one simple pair, which is NQ. And this profit that we made here, the $18,600, this was done with just $2,500. Now, if you leverage funded accounts or prop firms, which is a whole nother beast, this number could be drastically higher. But $18,600 is pretty good money for one trade that maybe takes you 30 minutes a day. You're not staring at the screen all day. You're not guessing if this is the right place to put your entry or this the right place to put your stop loss. It's a complete system that's proven that as long as you follow it, you'll be able to see consistent results, which to me just takes the emotions out of trading and makes trading so much easier. All right, if we close above here, we actually have a perfect London breakout setup that would happen. So price closes, or the candlestick closes in 30 seconds or so. Let's see if we get price to close up here. It's kind of going back and forth on the line here. This is the London high that we have right here. So I'm just looking for the body of this candlestick to close above it, but it's going back and forth. Oh, it's actually looking pretty strong now. So we're about to get a setup here. All right. It's pushing beautifully. I'm just waiting for this candlestick to close and I'll enter in. Boom. I'm in it. Stop loss right below the 5-minute candlestick that we entered on right here. Take profit is a 2 to 1, which comes out to 991 right here. And we are in this. This is actually looking pretty solid. We're up 2K right now. I was actually expecting a little bit higher volume breaking out of here, but I mean, we're in profit. That's all that matters. Because this is like a double top as well, because we had the high that was broken right here. There's another high right here that was broken. So I thought it would be a much stronger push, but it's okay. We can be patient. Patience is a virtue, as the old people say. This bad boy is pushing. This bad boy is pushing. We're up 5K right now. Excuse me. This is looking very, very, very nice. We still have not had a red 5-minute candlestick yet. Let's go to the 1 minute. Man, the 1 minute is looking pretty nice too. We made market structure above our entry. This blue line right here is our entry. 26924. So we made market structure above it, which is nice. I could move my stop loss to break even here, but I don't think I'm going to. I'll just let it rock out. It's just pushing beautifully though. This is finally getting that volume that I thought we'd get. What is it looking like on a 15-minute? Gorgeous. Absolutely freaking beautiful. Come on, man. Hit my take profit. Oh, wait. My TP is up here. I don't know why I thought my TP was this green line. No, TP is the red line, so still a little ways off. But we're floating in profit. Fairly nice right now. Cannot complain at all. Oh, we're getting close to TP here. We're up 7K right now. We still haven't not had a red 5-minute candlestick yet.
This is absolutely gorgeous. I'm not going to move my stops. I don't think it's necessary. We're basically right at TP. If this reverses now and goes back to entry, I deserve to freaking lose. But they're not going to do that to me because they love me. Right? Right, NQ? The fact that I know NQ just wants to play with me right now and just reverse just because I said something is crazy. That is actually insanity. Come on, just give me my money. It literally stopped like 2 ticks off of my full. Boom. I'm sorry. I'm sorry. I'm sorry. I'm sorry. I didn't mean to talk crazy about your NQ. I appreciate it. Beautiful setup here. Super easy. All we did was wait for the break of the London high here. Simple London breakout strategy. The setup was absolutely gorgeous. We had an entry at the close of the body above London high right here. As soon as we got that, stop loss below the low and went for a 2-to-1, and now it's reversing. See, that's fine, NQ. You can do that. I appreciate you giving me my money and then reversing. That's perfectly fine with me. Absolutely beautiful setup, man. Absolutely gorgeous. All right, the next strategy we're about to go over is called my squeeze strategy. It is a strategy that I have been trading since, 2018? 2019, somewhere around there. I trade this strategy not just in futures. I trade it in Forex. I trade it in stocks heavily, like heavily in stocks and heavily in crypto. Even when I'm trying to swing trade, or let's say I want to hold a stock or a crypto and hold it for like a year or something like that, I'm using the squeeze strategy to find my entry. And at the same time, I'm also using it when I'm day trading futures. This strategy is not a scalping strategy. You can be in and out the trade pretty fast. I would say on average, you're going to be in and out the trade in like 5 minutes to like an hour, somewhere around there. It is fairly passive as well, meaning you can set alerts and not have to be sitting looking at your charts. But just know when it happens, it happens. So you just need to be, I guess, efficient at using your alerts. That way you don't have to sit here at your charts and wait for the setup to happen. It's an amazing strategy. I'm going to dive super in depth in it inside of this video. It was one of my favorite strategies when I was first getting started trading. Now I do trade it, like I said, very frequently as well. And I use it as extra confirmation when I want to hop into trades. And then this is solely the reason why my stock in my crypto portfolio is doing so well. It's because I literally just use this strategy when I am trading those things. So super excited to share it with you all. Let's get into it. I'm giving y'all all the sauce, man. I'm giving you guys all the gems. Smash the like button. I haven't asked for that in like freaking years, but I'm just realizing I'm giving you guys all the game and I'm happy to do it. So yeah, use the strategy, absolutely kill it. Let's walk through how to do it. All right, so here we are on the charts. Now this strategy is called the squeeze breakout strategy. It is a breakout strategy that relies on momentum, volume, and following the overall trend. Now it's a simple 6-step checklist that I use to personally trade this strategy, and it has allowed me to print money. And it doesn't matter what markets I'm trading in. I could be trading Forex, crypto, stocks, futures, really anything. This strategy absolutely kills it for me. And I'm going to go over a bunch of examples of them on a bunch of different markets just to prove that to you guys. And these are actual trades that I have taken. We're going to go over those examples a little bit later on inside of this video. But I'm going to run through this checklist really quickly. We're going to go through it. Then I'm going to show you exactly what all this looks like and means on the actual chart. Then I'm going to go through all the examples to make sure that you guys fully understand exactly what it is that I do to catch these squeeze breakout strategy setups. So the first step is I start on the 1 hour time frame. Now I can personally use regular candlesticks or Heikin-Ashi candlesticks. Now, if I'm being honest with you, it's a lot easier to find these trends using Heikin-Ashi candlesticks. But if you're not familiar with Heikin-Ashi candlesticks, then using regular candlesticks is fine as well. But we're going to be on the 1 hour time frame. And basically all we're looking for is we're looking for price to form lower highs and higher lows at the same exact time. And what that ends up doing is forming a squeeze or a triangle type pattern. So what we're looking for, as I just mentioned, is we're looking for price to create lower highs. So imagine this is price. Price comes up here. We're creating lower highs, right? So this high right here is going to be lower than this previous high. We're also looking for it to be creating higher lows. So this is the first low. Price could create a higher low here, then another lower high,
then another higher low here. And then ultimately this keeps happening and price ends up breaking to the upside. This is what we're looking for. This right here is a high. This is another high. This high right here is lower than this high, which means we are making lower highs. Same thing right here. This is a low right here. This is another low. So this low right here is creating a higher low than this low. That's what we want to see. And if you look right here, you can easily see if we draw trend lines and connect the dots, basically, that when we connect the dots on the top and when we connect the dots on the bottom, we're forming a triangle. That's what I want to see. That is that squeeze, because what ends up happening is price gets closer and closer inside of this triangle or inside of this squeeze. And when it breaks out of here, it usually has very, very strong breakouts. And that's the moves that I am catching. And that's what's allowing me to print money with this strategy. So that's step one. Step two is to draw your trend lines. Remember, step one is just to go on the 1 hour time frame and look for those lower highs and those higher lows to be formed. Next, you're going to want to draw those trend lines, basically connecting the higher highs with one line and also connecting the higher lows with another, which is the same exact thing that I did here. I connected the lower highs with this upper trend line, and I connected the higher lows with this lower trend line right here, this white trend line. That is step two, basically just connecting the dots at that point. Now, the next thing, and this is one of the most important things that allows me to be able to trade this strategy with less than 30 minutes a day, is we set alerts. Here on TradingView, if you use TradingView, you have the option, which is one of my favorite things to do and use on TradingView. That is to set alerts. Now, what I usually do is on the trend line, once you've connected dots, you can actually right click on this trend line and press add alert. And what that'll do is you can actually set this up if you go to notifications to notify you an app and to play a sound. So play a sound on my computer, it just makes a noise and I know, okay, price is at my trend line. So I should probably start looking at my charts. You can also check this here to notify you're an app. So if you have the TradingView app on your phone, it'll actually send you a post notification straight to your phone. And that's what I use. That way, if I'm out and about, if I'm hanging with my family, if I'm swimming in the pool, if I'm doing anything, I can get notified to my phone to be like, okay, now price is getting close to my trend line. Now it's going to be close to the time to start taking action and actually start taking trades. This is what allows me to be able to trade this strategy in less than 30 minutes a day. So that's step three. Step four is we have to wait for at least 2 rejections on both the top and the bottom trend lines. And basically all that means is that we see candles moving away with force. And we'll go over some real examples of what that looks like so you guys know exactly what that is and what you're looking for. But in simple, you see how we drew this trend line to the downside where we had multiple touch points. So this is a touch point on this trend line. This is another touch point. This is another touch point. This is another touch point. Same thing on the bottom one. We have a touch point here, a touch point here, and a touch point here. Now, basically, these are all touch points. We need to see at least 2 of these touch points on the top and then 2 on the bottom trend line. That's what gives us a valid squeeze. If we can have 3 touches on the upper trend line, but if we only have 1 touch on the bottom trend line, that's not a squeeze and that's not a setup that I would personally take. So we need to see at least 2 strong rejections on both the top and the bottom trend lines that we drew. Now, step 5 is we're actually going down to the 1 minute time frame to look for our entries. Remember, this whole time we're drawing our trend lines, looking for our touch points, and adding our alerts on the hourly time frame. When we're entering on the 1 minute time frame. So entry setup, we're waiting for a trend line break and a break of the most recent swing high / swing low that touched the line. And we're entering immediately when both conditions are met. Now, simply all that means is, remember, we're waiting for price to break out of our trend line, but we're also waiting for it to break above a recent swing high, which would be right here, or a recent swing low, which would be right here. We're not entering the trade just when price breaks the trend line. Let's say we're looking for buys here. We wouldn't enter a trade as soon as price breaks above this trend line. It would have to break outside this trend line, and it would have to break above the most recent high that touched the trend line. So our entry would be above here, and we'll get into where we place our stop loss in a second, but you can place your take profit at recent highs and recent lows, but that's where we're looking for entries, and then vice versa for sells. We don't enter just because price broke below our trend line, right? We wouldn't enter right here. We have to wait for it to break below our trend line and below the most recent point that touched the trend line. So that would be right here. So then once it breaks outside the trend line and below the most recent low that touched the trend line, we can enter for a sell opportunity here and target wherever we want to target and put our stop loss wherever we want to put our stop loss. But that is the entry criteria. Remember, we're going down to the 1 minute time frame for that. Now, step 6 is for our stop losses and our take profits or our targets. We're placing our stop loss just beyond the most recent swing high / swing low before entry. And we're placing our take profit at the most recent 1 hour swing high or low. That's usually what I do when it comes to this strategy. Now, I'll show you guys exactly what that looks like as far as where to place your stop loss. Remember, we're doing all that on the 1 minute time frame. And then for our entries, we're looking at the 1 hour time frame. So that's in simple my 6-step strategy that has allowed me to print money in any market conditions, in any markets, no matter if I'm trading crypto, Forex, stocks, options, no matter what it is. This strategy absolutely kills it for me. Now let's hop into some real examples so you guys can see what this looks like in motion and in the real world. All right, so here we are on NQ, which is a futures pair. We're just gonna do this example on NQ. We're gonna have examples on ES as well, on Ethereum, and we're also gonna have examples on a stock called Palantir. So as you see, we're already on the 1 hour time frame. I mentioned to you guys that you can do this on the regular candlesticks, or you can do this on Heikin-Ashi candlesticks. Right now, I'm on regular candlesticks. I'll show you guys an example on Heikin-Ashi candlesticks in the next example. But what I want you guys to see here is you see we have price trending to the downside. We're creating lower highs. We have multiple touch points. First high was here, lower high right here, lower high right here, lower high right here, another one, and another one. So this is 1, 2, 3, 4, 5, 6, 7 touches on this upper trend line here, right? That's one step that we want. We need to see price creating lower highs on the hourly time frame. But then we also need price to be creating higher lows at the same exact time. And if you see here, we have one touch point right here, another touch point right here, another touch point right here, and another touch point right here. We have 4 touch points on this lower trend line right here. That is showing us that price is also at the same time creating higher lows. So we have our lower highs being created here. And then on the bottom trend line, we have our higher lows being created. And as you see, I already drew this trend line. Now, I told you guys that this strategy takes about 30 minutes for me to do. And that's because in the mornings, all I'm doing is looking for these trend lines to be formed. I'll draw out my trend lines. I'll connect the dots. I'll right click on my trend line, set my alerts, and I'm walking away. All I'm waiting for price to do at that point is to touch either of these trend lines, because I know that no matter what price does inside of my trend lines, I'm not taking any trades. I'm not looking for anything. I don't care about any of the price action that price is making in between these, inside of my triangle basically that I made, or inside of these trend lines that I made. I only care because I'm only looking for entries when price breaks outside of my trend lines and breaks the most recent swing low or most recent swing high if I'm looking for buys. So I'll set my alerts, I'll walk away. Now, let's say I get my alert to go off. So let's say we fast forward just a little bit, right? Let's say we skip forward. Price is still inside of my triangle, so I'm not looking for anything. Right here, my alert would have went off. I would have got notified that price touched my trend line, so now I can come back to my computer, or I can check on my phone and be like, okay, we now potentially might have an entry. But as you see here, price broke out of my trend line here, but I didn't enter because we have to wait for price to break below a most recent swing low as well as outside of my trend line. In this instance, it would have to break below this most recent swing low because it's the most recent swing low that tapped our trend line. So this most recent swing low tapped our trend line. I usually put another line right here that lets me know that I'd be looking for sells as soon as price breaks below this area. And then once I have that, now it's a waiting game. I go down to my 1 minute time frame. I'm waiting for price to then come break below this white line. I'm setting my entry point right below that white line. Let's see as price moves forward. We still haven't got a break of that white line yet. And then price finally breaks that white line right here at 8:31 in the morning. Now for my entry, I told you guys this is where I entered at. Now the stop loss, if you guys remember from the checklist, is always above, if I'm in sales, it's always above the most recent swing high before I entered my trade. Now it's vice versa if I'm looking for buys. My stop loss is going to be below the most recent swing low if I'm looking for buys. But in this instance, we're looking for sells. So the most recent swing low is right up here. Sorry, the most recent swing high is right up there. So what I'm going to do is I'd have my entry here. I'd have my stop loss above this recent swing high up here. And then I'm targeting recent swing lows on the hourly time frame. So if I go to my hourly time frame, I could be targeting the swing lows that are right down here. I could be targeting this swing low, this one right here, or this one right here. Let's just say that I target the swing low that's right here, which is the most recent one on the hourly time frame. Let's go back to my 1 minute time frame. As you see, this is about a 3.27 risk to reward ratio, which simply means that for every dollar I risk, I'm going to make $3.27 on that trade. So let's say I risked $1,000 on this trade. If this trade hits my full take profit, I would make $3,027. And if I risk $10,000, I'd make $30,027. If I risk $100, I'd make $327. That's simply all risk to reward ratio means. But let's see how this plays out. Price sold down, continued to sell down, bought up a little bit. We can fast forward this. And we see price ultimately ended up hitting our full take profit here. And this is a winning trade. And that's all by following the simple 6-step checklist that I just pointed out for you guys and just went over for you guys. But let me give you guys a couple more examples of trades that I have taken so you guys can be sure to understand exactly what I did and how it's been able to generate me consistent profits. All right, so here we are on ES. We see the exact same thing. We're on the 1 hour time frame. We have a rejection right here, a rejection right here, and another rejection right here, actually, where you see we're creating lower highs. And then on the bottom, you see we're creating higher lows. So we have a low here, we have a higher low right here, we have a higher low right here, and we actually have a higher low right here. So we met the criteria of creating lower highs and higher lows at the same time. We have at least 2 rejections on both the upper trend line and the bottom trend line. As you see, our next step is to go down to the 1 minute time frame. And let's just hit this replay feature so we can go back and see exactly what it is that I was looking at. So we see price had rejected off of here. So now we have our entry point. So we know we're not just entering when price breaks below a trend line, but it also needs to break the most recent swing low that touched the trend line first, and then we'll get an entry. And that most recent swing low is right here, right? So once it breaks below the trend line and this most recent swing low, we'd enter ourselves into the trade. So let's see. Here, we just got an entry right on this candlestick. You see this one that wicked down. Our stop loss is always going to go above the most recent swing high if we're going for sells. In this instance, we are going for sells. So this stop loss goes above here, as that's the most recent swing high on the 1 hour time frame, on the 1 minute time frame. But then we're going to go to the 1 hour time frame and look for a most recent swing low, which is right down here. That's what we're targeting. As you see, that's where my take profit is. This is a 2.6 to 1 risk to reward ratio. Now we can see how this plays out. Price continued to drop down, sell down, and you'll see that price ultimately ended up hitting our full take profit right here on ES, following the same exact 6-step checklist that we just went over. And this is on a completely different pair. Now let's go over another example. So here we are on Ethereum, which is crypto. I told you guys that I use this regardless of what market I'm trading, stocks, crypto, futures, anything, right? And here on Ethereum, we're on the 1 hour time frame, and we can see that price is trending to the downside, and it's also trading to the upside. So we're creating lower highs, and we're also creating higher lows at the same exact time. Now, next, what we're looking for is an entry. We're looking for price to break above the trend line to the upside or below the trend line to the downside. Now, I want you guys to notice here, if we go to the 1 minute time frame, price already broke out of the trend line here. But the reason that we did not enter this specific trade is because price never broke the most recent swing low that tapped our trend line. If we look right here, I'll use a horizontal line. This is the most recent swing low right here. Price never broke that. Even though we broke out of the trend line, we still didn't take sales simply for the reason that price did not break below the trend line. So if you are trading this strategy, you cannot skip any of the rules. You can't just enter as soon as price breaks outside of the trend line. That does not work. We have to wait for it to break outside of the trend line as well as below the most recent swing low. So let's just fast forward just a little bit, because right now we're still waiting for price to break below this trend line to the downside. I was waiting for price to break towards this trend line to the downside so I can enter for sells. But then price actually ended up starting to buy up. So then I was looking for buys at this point. And remember, I have to wait for not only price to break above the most recent trend line, but also above the most recent swing high. So this is the most recent swing high at this point. So I'm looking for buy opportunities when it breaks above this white line right here. So let's see what price ends up doing. So here, as you see on this candlestick, price broke above both of these lines, the trend line and the most recent swing high, which is that upper white trend line for me. So I would have entered right here. Stop loss, well, I did enter right there. Stop loss is below this swing low right down here. And then we're going to the hourly time frame, and we're targeting some recent swing highs. So recent swing high is right up here. This is a 2.6 to 1 risk reward ratio. And as you see, this trade ended up hitting full take profit very, very simply. Now, I mentioned to you guys in the beginning of this video that the reason why this strategy works so great for me is because when price is squeezing inside of this triangle or making this squeeze pattern, the closer it gets inside of the squeeze pattern, the further out it's going to break. As you see, we were in this triangle, we're in this squeeze pattern, and when it broke out of here, look how strongly it broke out of here. Look how big these candlesticks are to the upside in comparison to the candlesticks that were inside of this trend line. That just goes to show you that trading in the direction of the trend and using momentum and volume combined with breakouts is absolutely overpowered. And that's why this strategy has been able to print me money consistently. And this is trading crypto. Now let's go into another example just to truly solidify that you guys fully understand exactly what you're looking for, when to enter it and when not to enter it. All right, now here we are on Palantir, which is a stock. Now, this is the exact same setup that we just took on NQ, ES, and Ethereum. This is a trade that I had taken in July here on Palantir. Exact same 6-step checklist, right? So we have multiple taps on our upper trend line. We're creating lower highs on our upper trend line, right here, right here, right here. We're also creating higher lows on our lower trend line. Well, a tap right here. Actually, the trend line starts right here. So we have a tap here, tap right here, and a tap right here. Now, next thing is I put my alerts. So I put my alerts on the trend line just so I can get notified when price is getting close to my trend line so I can start looking for entries. Now, as price goes on, as you see right here at this 8 o'clock candlestick, we had this huge bullish candlestick, but we were on the 1 minute time frame. Well, I was on the 1 minute time frame looking for entries here. Now, basically, we didn't just enter as soon as price broke above this trend line, but we entered as soon as it broke above the trend line and the most recent swing high, which was right here. So our entry was right here. Our stop loss was below the most recent swing low, which is right here. And at this point, this is a little different example because we were kind of at all-time highs with Palantir, and it was targeting the most recent swing high was all the way up here. This is the most recent swing high. But I figured that this stock specifically, that I didn't mind holding it longer, and I thought that it would kind of go much past its all-time highs. So I kind of ended up trailing my take profit. But in this instance, according to the checklist, we would target this high up here, and that's perfectly fine. We can go with this example. We were on our 1 minute time frame, entered the trade here, was holding this trade. We can see exactly how this played out. Now, as you can see, price ultimately ended up hitting full take profit here, and it actually ended up going up much further. And I held it. I forget exactly where I gotten out for this specific setup that I had, but I held it a little bit longer. But this strategy hit TP fairly quickly and fairly smoothly using the exact same squeeze strategy that we just went over on all the other pairs. All right, we might get our entry here on this squeeze now. And put a buy stop here. I got a buy order right above the breakout side of this squeeze here. Let's see if we can get this entry. Come on.
Stop.
All right. I am now in the trade. My stop loss is below the candlestick. Going for 2 to 1 right now, which comes out to about a 49700 right here. All right, let's see if we can hold this bullish momentum. We've been going fairly nicely here. This is the setup that we're seeing here. So obviously we have multiple rejections on the lower trend line. So 1, 2, 3, 4 rejections on this lower trend line. If we zoom out, we can see that on the micro, as far as the last few days or so, we have been trending to the downside, but we did break this major high right here. You see we broke it. There was a major high right here. we broke it, and now we're having a squeeze to the upside. So I'm hoping that we continue on this bullish momentum after having bottomed out here. Hopefully, if we look on a higher time frame, you can actually see it a little bit better. So that's what I was saying. On the micro, we've been in a downtrend, but overall, as we are zooming out, we can see we are in a obvious uptrend here, and then price bounce off this low, which lines up with where this low bounced off last time, and this candlestick wicked off as well. So I'm looking to just catch this and keep this squeeze to the upside here. So yeah, multiple rejections on the lower trend line, 2 rejections on the upper trend line, 1 rejection here, 1 rejection here. Now we just need some strong price action to the upside here so that we can hopefully ride this bad boy up and not have to sit here for 3 hours just for it to go back to our frickin' stop loss. All right, we are having a nice push out of here. We're up 1800 right now. Looking pretty solid. I'm just going to hold this pretty strong here. I'm not going to trim my stop loss, I don't think, at all. On this trade, we have a few different take profit levels. We've already hit TP1, which is right at this level right here. Next TP would be in this general area, so around the 651s area, 49651 area. Then full TP is obviously at 49700. I think if it hits TP2 up here, I would look to potentially move my stop loss to break even. Only reason is because we sold off last time we were up here. We sold off very heavily, as you see these 3 big red candlesticks. But we shall see. I might just hold this though. I really don't like messing with my trades. A lot of people always ask me, "Oh, do I like trail my stop loss? Do I scale out of my positions?" No, not really. I just let my trades rock. So either it's my stop loss or it's my take profit. That's just how I like to trade, simplest way possible. It's just what's worked for me over the last 9 years that I've been doing this. There was a period where I used to scale out of contracts, but it just, for me, it's not worth it. The mental stress of it, because you get, excuse me, dang, it's been a long night, but you get hesitant to the point where when you're scaling out of trades, you're like, dang, it hit my full take profit. If I held my entire position, you start doing math in your head like, oh, I made $4,000, but if I didn't scale out, I would have made $10,000. And for me personally, it's not worth the back and forth. I'd rather just let it hit my stop loss, let it hit my TP. Now, sometimes I will move my stop loss to break even, but most of the time, like I said, I just let it kind of rock. Right now, it's looking pretty solid. We're up 2K right now. It's almost halfway to full TP. All right, we're still looking nice here. We're up 3,800. We saw 4K at one time. We still have not had a pullback to the downside on the 5-minute time frame, which does make me a little bit hesitant because markets like to rip up and then rip down. So I'm hoping we don't have that rip down part, at least not until we hit our TP. We are not too far off from it. What, 33 ticks away from our full TP here. So I'm just going to continue to hold this. It's looking pretty solid so far. Really nice breakout out of here. If we look on the 30-minute time frame, it's looking very strong. We can look on the 15-minute as well. It's looking very, very strong. We got to close outside of our squeeze area right here, which is really nice. And then we are still pushing to the upside, which is a very, very strong sign here. So yeah, hopefully we get paid today. So we're getting pretty close to our take profit here. Our take profit's up here. We had a big sell-off right here, but price still didn't even come back down to our entry. I still haven't moved my stop loss. When I see something like this does give me more confidence though to move my stop loss to break even. So that's what I'm gonna do. That way this is risk-free trade now. But again, you don't really have to move your stop loss. It's just we created a new low above my entry point. So that's a good sign. Because if price breaks this low, it's most likely going to go all the way down either way. So I might as well get out at break even. But we're getting pretty close to our take profit here. Hopefully we can hit it soon because I do have to leave my house in a bit. And I want to be able to record this video so I can have it. But if I have to leave, then that will not happen. I got about 20 minutes left. If this doesn't hit in 20 minutes, then YM hates me and we will forever have beef. but it's okay. YM will not do that to me. We are right there. Just give me my munyan. Give me my munyan. Here we go. Boom. Boom. Beautiful. Beautiful. $5,355 trade here on Mr. YM. Super simple squeeze strategy here. As I was telling you guys in the beginning, when I first took this trade, hold on. Yeah, when I first took this trade, 1, 2, 3, 4 rejections on this bottom line right here. Then we had our upper trend line. So 1, 2 rejections at our upper trend line. We simply just waited for price to not just break outside of the trend line, but also break that most recent high, which is right here. As soon as it did that, we entered ourselves into the trade. Stop loss was right below the candlestick that we entered on the 5-minute time frame. And I went for a simple 2-to-1, and that was a beautiful TP because now you see it's reversing. But yeah, squeeze strategy has killed it once again. And now I got to go get ready to leave my house. I appreciate you, YM. We live to trade another day. All right, now I want to be real with you for a second. The strategies that we just went over, the strategies I just walked you through, they aren't theory strategies. These aren't some made up strategies that I read about in some book. These are the exact strategies that I personally use every single month to make 6 figures. They're the same exact strategies that I'm executing on with my inner circle traders live every single morning, and that they're using to help us all change our lives. Now, if you don't know what my inner circle is, let me break it down for you really quickly. So my inner circle is something that I built that honestly, I wish I had when I first started off trading. It's something that would have saved me over 3 years of losses, years of frustration, years of trial and error, and probably tens of thousands of dollars from figuring it all out on my own. Inside the inner circle, I basically take you step by step to learn how to trade exactly how I trade. You get to not just learn how I trade, but you get to take every single trade that I take right when I take it. We trade live every single Monday through Friday. I'm sending out real-time alerts. The second that I take a trade, I send it out to you so you'd be able to hop into it with me. You also get access to all of our other coaches in there to help you in literally whatever way possible. You also get full access to my educational content library that goes way deeper than this 10-hour video could ever go. You also get access to our dedicated trading psychologists inside of my inner circle, because if you did not know, trading is 80, if not 90% mental. It's a mental game, and that's why it was important that in my inner circle I had a trading psychologist that helps us all master our trading psychology. I'll be honest, that was one of the hardest parts for me when I was trading, not having somebody to talk about it with that understood the mental game of trading or trading at all. And that's why having a trading psychologist is a huge benefit for anybody trying to get successful in trading. But in my inner circle, you also get one-on-one trade reviews where me personally, I will look at your trades and tell you exactly what I think you did wrong, exactly what I think you need to fix. In the inner circle, you also get access to our private Discord community. This community is full of complete beginners who might be exactly where you are, more, I guess, experienced traders who might not be extremely profitable, but they're on their way. There's people who are in there making tens of thousands of dollars a month. I can't even talk. Some are making 6 figures a month with trading, and it's all inside of the community. We're all in there learning. We're all in there helping each other out. It's honestly just a place for serious people who want to make multiple 5 figures or sometimes even 6 figures with trading. It's very exclusive. It is very limited. Honestly, if you go through any of my YouTube videos, you're going to see people complaining inside of the comments about the fact that spots are literally always full when it comes to my inner circle. And that's because of literally all the value that I've poured into it. I told you guys, I literally made it the exact thing that I wish I had, that would have saved me years of trial and error, that would have saved me years of sadness by trading by myself, years of losing money. I put my entire heart into the inner circle to make it as valuable of an asset as possible. And that's why it's really only for people who are genuinely serious about trading. I'll be honest, it's not really for someone who just wants to make a few extra $100 a week with trading. It's more so for people who want to take this into something that could replace their career and give them all types of financial freedom if they put in the time to achieve it. So if you're done guessing, you're done losing money, and you're ready to actually build this like a true consistent business, click the link in the description of this video to have the opportunity to join my inner circle. But with that being said, let's get back into all the value that I'm dropping. Now, these strategies are great, but you have to understand how to use them. And as new traders, it's important that you test them. Now, the best way to test any strategy or get used to trading is with back testing. We're going to talk about what back testing is, how to actually do it. I'm going to show you guys how to do it the most efficient way. So first of all, what is back testing? Back testing allows us as traders to basically test our strategies, get good at drawing support or resistance without having to wait each and every day to do it. Get good at entering trades, get good at looking for those dojis, looking for those trend line breaks, looking for all these things without actually having to wait in the markets to do it. Because realistically, as a day trader, you're with whatever strategy you're using, let's say with the ultimate support or resistance strategy, maybe you'll get three setups a day. That means you get 3 practice attempts a day. It's going to take a while for you to get comfortable with the markets if you're just looking at 3 setups every single day. Versus if there's a way to look at 100 setups in one day, that's how you're able to beat that learning curve and get much more comfortable inside the markets as traders. Now, how do we actually do that? There's this replay feature. I believe it's for the paid version of TradingView, but there is another website that you can go to, which you do have to pay for. It's called FX Replay right here, fxreplay.com. It's a good website for back testing as well. It basically does the same exact thing. I'm not sponsored by them or anything like that. Just putting this out there. But it does the same thing as this replay feature. But what this replay feature does on TradingView, when you press it, it allows you to go back in time. So let's say I press right here. It deletes everything that was before then. That way I can't see it. Because yeah, you can scroll back and be like, yeah, this is an easy support zone, right? Or easy resistance zone. I would have just sold right here as soon as I saw this candlestick, and it would have just dropped all the way down and I would have made $100 million. But this goes back to the saying that I said a little while ago, that hindsight is always 20/20. It's very easy to know what the market's going to do when you can see what the market's going to do. Versus if you use this replay feature and you're back here, then you're really testing to see, okay, I'm actually going to try and see what's going to happen when it taps into my zone here. Would I really have sold here? Would I really have done anything at this area? And things like that. So how do we actually do this and use this replay feature? Let me run through that really quickly, and then I'll show you guys how I back test it. And you can do this on any pair, any strategy, but you'll hit this replay feature. You'll see this blue line will be your cursor now. It's like a snippet tool. You'll press anywhere on the chart. And what I like to do, honestly, I like to close my eyes or scroll up where I can't see any of the candlesticks and just go back to a random spot. So I'm clicking on my wheel, I'm clicking on my mouse and dragging. So it's dragging the screen over. So it's something I can't see. Then I'm just going to click somewhere random, right? Once I click that place random, what I'll do, I'll hover over here and press this reset chart view, or I'll right click and press reset chart view. And that'll bring me to where the candlesticks are, or show me where the candlesticks are. Now here, what I do is I go to my indicators and I'll throw on that kill zones, because I only want to back test during the time frame that I'm actually going to trade. And you guys remember the indicator that we went over, the kill zones indicator tells us exactly what time we're at, what session we're in. So let's make my kill zone red here. Let me just edit these settings because it's a little bit off. Actually, let me go to my usual template that I use. This one. Boom. All right. So this is usually how my charts look. I like my candlesticks. You can edit all this if you right click on your TradingView screen and go to settings. Under symbol, you can change the color of your candlesticks to whatever you want them to be. For me, I have my bullish candlesticks, as in what would usually be my green candlesticks. I have them as white, and I have my bearish candlesticks red, which is how they usually are. That's just the color preference I like. I like red, and I like a black background, so I had to make my my other candlesticks white. But anyways, so let me scroll back here and press this replay feature again. If it's already blued out and you don't have that blue cursor over, if you look on the bottom of your screen right here and press select bar, it'll bring it back up. So then you could just drag and scroll anywhere. I know for me, using my kill zone indicator, that this red line is when New York session starts. And I know that I trade New York session. So what I'll do is I'll go a little bit before that red line starts and I'll click. I don't know what there is on the chart right here. It's just a bunch of candlesticks right now. And then at this point, I'm going to start practicing drawing my support or my resistance zones. So what do we do first? We'll go to our 1 hour time frame. This just gets you practice at marking up your charts. So let's say this is really not a good spot to be. This is a previous support zone that we see price broke below. We could wait for it to tap back into that. We see we have a support zone right here where we have 2 rejections off of, right here and right here. We see that we don't really have a squeeze or anything going on. This is really the main 2 zones that's in front of us. And this is how I'm backtesting. I'm just going back in time and doing this. So then I'll go down to my 15-minute time frame or my 5-minute time frame and just see what the candlesticks are looking like. Back here on my hourly, we have this little station under here, same where we press select bar. We can actually press play right here, and you'll see it'll play the candlesticks automatically. Or what I like to do, I'll press this little skip forward button, and it'll just print 1 candlestick. It'll just put 1 candlestick. This moves a little bit too fast for me when I press play, so I don't really do that. You can adjust it over here where it moves a little bit slower, so I can actually make it go 1x, which if I press play, it'll then do 1 candlestick a second, and things like that. But I'd rather just press this the skip forward button. And over here on the replay interval, right now we're obviously on the 1 hour time frame. So right now, if I press this skip button, it's going to load the next 1 hour candlestick. But if I wanted to, let's say, load the next 5 minutes or go forward another 5 minutes instead of a whole hour, I can press that and you'll see these candlesticks start changing. So you see this one, then I'll press it again. This is the same hourly candlestick, but we're just moving forward 5 minutes instead of by a whole hour. So we're not seeing a whole new candlestick. We're just seeing the movements on the candlestick as I click and click. Now, if we go to the 15-minute time frame, we can do the same thing. We can change this so it goes up 15 minutes, 3 minutes, 1 minute, or we could just press same as chart. That way, whenever we switch, it's like the 5 minute, the 30 minute, the 1 hour. Every single time we press this skip button, it'll skip forward whatever time frame we're on. So let's say this is the we're waiting for price. Let's go back to where we were on the hourly time frame. Let's go back here. Let's say I'm waiting for price to tap into my zone right here or my zone up here, and I'm going to make an action based off of that. We know we're going to enter on the 1 minute time frame, and this is assuming I'm backtesting my ultimate support and resistance strategy that we just went over. We have our zones drawn out, we have our supports, we have our resistance. So then we know we go down to the 1 minute time frame and we wait for entries. So let's fast forward here a little bit. See if we get price to tap into either one of our zones here. Let me just skip forward a bit. I believe it's going to tap into this low point right here, probably close to market open, which is at 8:30 Central Standard Time. All right, so it tapped into my zone here, so I could be like, okay, according to this strategy, I'm supposed to enter on a recent swing high, on a break of a recent swing high or a recent swing low. So these right now are our recent swing highs. So this is the candlestick. Technically, I would have entered into the trade right here. So this is me practicing it. I would practice drawing my support zone right under here. My stop loss right under here. And let's say I want to target a recent high. There's a recent high up here. There's a recent high right here. Let's say I target this one right here. And let's see what happens. We skip forward. Skip forward. We can skip forward faster. And this trade would have hit. This is how we backtest. We didn't know that this was going to happen. We didn't know that price was going to bounce off of here. So we can't say we knew that was going to happen. This is how you correctly backtest because you don't know what's going to happen beforehand. Now I can do this again and we'll scroll back again to a random time right before market open. We'll go to the hourly time frame. And let me mark up my charts again. So I see a resistance zone up here, obviously. I see we actually have a trend line down here. Multiple touches at this trend line, actually. If we were here a little bit earlier, we could have seen this squeeze play out because you see we have 1 rejection here, 2 rejections, 3 rejections. On the bottom trend line, we have 1 rejection here, 2 rejections here, 3 rejections here. At the top upper trend line, and according to the strategy, we would have waited for a break of the swing high, which is up here. But I don't trade. This is at 2 o'clock in the morning. I'm sleeping at 2 o'clock in the morning. So I know I wouldn't trade that. And that's why I use the kill zones because I don't want to back test my strategy during the London session when I know I don't trade. So now that we have all this on our chart, now we'd wait for a market open to happen. So this is market open happening right here. Let's go down to our 5-minute time frame. So we have this as our resistance zone right now. Now we can actually wait for price to tap back into this area to see if it does. Fast forward. It tapped back into this area. Now we can see if we can break any of our recent swing highs. So right now we don't really have any recent swing highs. Let's see if it creates some. Nope, it's just selling down below it. So I just wouldn't have traded this because according to my strategy, I needed to break a recent swing high. And right now it broke out of my zone, which means it's not respecting my zone anymore, which means I just have to wait for another setup to happen later on. Let's see. Right now it's breaking to the bottom of this trend line. Let's say I was practicing to take a break out of the trend line. I could have been like, okay, when it comes to break below this recent swing low, which was right here, and backtesting is going to work the same no matter what strategy you're backtesting. I'm just showing you guys examples of any strategy. So let's say I'm waiting for it to break below here. Let's see if it comes down here. All right, it broke below it. This would have entered me into the trade. Let's say I put my stop loss above the recent swing high. Recent swing high is right here. I'm now in the trade because it broke below here. And let's see if it goes to my stop loss or it goes further down. Now it's just consolidating. And this would have lost. So what I'll do is I have to journal my trades. I have to journal what time I took them. We're going to actually dive in depth exactly what you want to journal, but I want to get it out the way so you guys, or get this part out the way, so you guys understand how to actually do the action itself, as far as using the replay, as far as knowing you're coming into this, trading at the time that you would actually trade, marking up your charts, practicing drawing out your support and your resistance zones and things like that. And then what happens is, let's say you have a rule where every single day you only take one trade. No matter if you win or lose, you only have one trade. That's perfectly fine, because then you'll come over here to the hourly time frame, and what you're going to do, let's say after you took this trade here, let's say we lost this trade right here, I'm just going to skip forward. I'm going to skip forward until I see my yellow line, or until I see the candlestick that we're on is getting close to market open, or sorry, getting close to New York session, which is the session I trade. And then we restart. So then we draw our support zone, or sorry, we draw our resistance zone right here. We draw that we have a support zone right down here. We go forward. Let's see, this is 7 o'clock candlestick. So let's fast forward just a little bit. All right, now we're at 8 o'clock. So now we have these two zones. We'll watch and see. Go to the 1 minute time frame. So we're making these higher highs in here, never made a new high. Now we had price come back into our zone after breaking out of it. We made a high right here. Let's say we're trading the ultimate support or resistance strategy, or we're back testing it. We would have entered right here. We would put our stop loss below here. Let's say we targeted here. I personally probably wouldn't have taken this trade just because this is close to it breaking out of this zone at market open. But that's fine. Let's say we did take this trade and price is going up, 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 down, 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 up. Let's see if it hits the full take profit area. This is taking 100 years. And it's reversing back down. But let's say that this was our take profit up here, or let's say we targeted this recent swing high. I don't even know why I targeted up here. I should have targeted a recent swing high, which was here. That trade would have hit. That trade would have won. We would have written that down and all the different things. We're going to hop in exactly. We're going to hop in. I'm going to show you exactly what you guys need to track every single time or write down every time. But this is how I backtest. I start off with, like I said, closing my eyes, clicking a random time. I'm only trading during my session. If I know I'm only going to take 1 or 2 trades a day, after I take those 1 or 2 trades a day, I'm just going to fast forward until I get to London session again, or I start getting close to my red line, which is my red line starts at 8 o'clock. But let's say when I get to 7:30, because I know that's usually the time when I wake up and start marking up my charts. That's what I will do. Now, if you want to backtest Heikinashis, TradingView actually doesn't let you do this. It will block you. Like if you press it, it says bar replay isn't available for this chart type. Do you want to exit bar replay? So it won't actually let you backtest Heikinashi candlesticks. But there is a workaround for it, because if you wanted to backtest any of the strategies with Heikin-Ashi, like let's say the scalping strategy that we just went over, or any of the other strategies that's inside my strategies course that I told you guys about before, a lot of them use Heikin-Ashi candlesticks just because they work so well with Heikin-Ashi candlesticks. But if you want to backtest it, TradingView really doesn't let you do it. So you have to do the workaround. And this is the workaround. It's very, very easy actually. So on regular candlesticks here, go to indicators and type in Heikin-Ashi candle overlay. Just like this. It's by this person named B. Jorgum. You'll press it right here and you'll see, look at the candlesticks. You'll see their change because it put an indicator that looks and acts just like Heikin-Ashi candlesticks. It put that over your regular candlesticks. Now, as you see, this looks a little bit weird. It's kind of messed up a little bit. You'll see different colors. So what we do to fix that, we'll right click on our charts right here. We'll go to settings. We want to basically hide the regular candlesticks so that we only see the Heikin-Ashi candle overlay indicator that we just put on. So how do we hide the regular candlesticks? When we're on the symbol tab, make sure the body, the borders, and the wick are unchecked. And that'll hide them. So then as you see, now all we see is Heikin-Ashi candlesticks. But to TradingView, we are on regular candlesticks. So we can use the bar replay and we can backtest with it. So that's the workaround to be able to use Heikin-Ashi candlesticks on TradingView. On FX replay, you don't really need to do that workaround. They let you backtest with Heikin-Ashi candlesticks. But if you wanted to use TradingView to backtest, that's simply how you do it. You put on that indicator. You don't have to change any of the settings in the indicator unless you want to change the color of the candles or anything like that. Then you could do that, but you really don't have to. And then obviously just to turn back on your regular candlesticks, you'll right click, press settings under a symbol, just turn back on your body, your border, and your wick. And then if you don't want this indicator on anymore, you can either press the eye thing so it's hidden, or you can just press the trash can and delete it and re-add it back on later if you want to. Now let's hop into the things to track when it comes to backtesting, because yeah, doing all this is cool. Practicing drawing your support, your resistance zones is all cool, but you need to be able to track it. Trading is all about data. We need to see the data. We need to know what's the likelihood of us winning this trade every single time we enter a trade? What's the likelihood of us losing this trade? When's the best time to trade this strategy? What's the best day to trade this strategy? How long should I hold this strategy? Should I always hold it to a 1-to-1? Should I always hold it to a 2-to-2? So we need the data to be able to do that. Let's hop into the data that we track and how we actually track that. How to find, test, and optimize a profitable strategy. Obviously, I've given you guys proven profitable strategies, but if you're testing your own strategy or if you're using any of the other strategies that's inside my strategies course that I mentioned to you guys, this is how you would do it, right? So the first thing to finding a profitable strategy, almost any strategy can be profitable with the right risk management. So find your favorite type of strategy, whether it comes to support and resistance, supply and demand, which we'll get into a little bit later on, or breakouts, etc. Look for patterns on the chart that you notice from backtesting or using someone else's strategy. If you found your own strategy from doing your backtesting, you've noticed patterns that seem to play out a lot, you can use that and start backtesting it, or somebody else's strategies. If you found a strategy on YouTube, if you found one of my strategies and wanted to use one of my strategies, things like that. And then once you do that, you need to set clear rules for your strategy as far as what are your risk to reward ratio. Are you always going to go for a 1-to-1? Because you want to track all this. Are you always going to go for a 1-to-1? What do you need to see to enter a trade? What do you need to see to exit a trade, etc.? Things like that. So once you have that down packed, how you test the strategy. The first step is to backtest, 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 and keep backtesting. Picture this. Imagine a basketball player where the only time they played basketball is when they had a basketball game. They never went to practice. They never practiced shooting except when they were in a game. They are going to suck compared to someone who plays basketball and practices basketball every single day, regardless if they have a game or not. It's the same when it comes to trading. If you're not backtesting, if you're not putting the time into backtesting, you're only relying on getting those reps in when you're actually trading in the live markets, you're not getting enough reps in. You're getting, like I mentioned before, 3, 4, maybe 5 trades a day. Versus with backtesting, if you spend an hour backtesting, you can go through 20, 30, even maybe 50 days worth of data. You know how many trades that is? You know how much confidence that builds in you? How much practice you get into actually trading and drawing support or resistance, practicing your entries, seeing trend lines, seeing breakouts, seeing your strategy play out, seeing your trade lose, seeing your trades win. You get so much more confidence in your trades simply by backtesting and putting the time to backtest. So you have to backtest. And when you backtest, you need to keep track of the metrics. How I like to keep track of them, you can have this on a notepad, you can create yourself a spreadsheet. There are apps that you can use to track your backtesting data. But in simplest terms, you can write it on a piece of paper. But you want to write what date you started backtesting, as far as when you close your eyes and did that bar replay, it was June 3rd, 2024, right? Write the strategy that you're also going to be backtesting that time. So you're going to be writing, okay, from June 3rd, whatever, I'm backtesting the ultimate support or resistance strategy. You have that data. That's your headline at the top of your paper or the top of your document or whatever. And you want to track every trade you take, the wins, the losses, the days where you have no setups, as far as there was no trades that happened because you just didn't see the opportunity. You also want to track small key points for each trade. So like this trade had the perfect setup. Everything aligned perfectly. It did everything. It did exactly what I wanted to do, as far as it touched my support zone. It gave me my breakout of a swing high or swing low, whatever it is. Or writing things like it was low volume, like the trade moved super, super slow. Or on this day, we had a lot of fundamental news come out. You want to write all that because that's extremely important. It's kind of like adding tags to your trades. Now, the next thing you want to do is backtest at least 50 days of trades on each strategy. Backtest at least 50 days worth of trades, not 50 trades, 50 days worth of trades. Because there'll be times when you have a trading day and 3 times your setup popped up. When I mean 50 days of trades, I'm not talking about you sitting at your computer for 50 days. I'm talking about if you started on June 1st, 2024, you'd end it on whatever 50 days of that is, whatever that date is, 50 days of that, right? And then you want to calculate the results at the end of your session. So calculate how many wins you had, how many losses you had, calculate how many trades you took total. Then you want to use that data to get your win percentage. So did you have a 60% win rate? Did you have a 3% win rate, a 30% win rate, whatever it is? You want to also calculate and track your no trade days. How many days did your setup just not show up? So you want to track that as well. You also want to track your RR profit. And basically all RR profit is your risk to reward profit. So we went over on the chart showing you guys drawing out your long or your short positions. And you saw that little thing that said risk to reward ratio. Like for instance, with the scalping strategy that we went over, you're always going for a 1-to-1. But with the ultimate support and resistance strategy or the squeeze strategy, you could be going for a 2-to-1, 3-to-1, 4-to-1, 5-to-1. So you want to track not just your wins and your losses, but track your RR profit. So, and the reason why that's important is because a lot of times if you're risking the same amount of money on every single trade, let's say out of the 50 days, you took 100 trades, right? And you know every single trade you're risking $100 on it, right? You took 100 trades and you had a 50% win rate, but every single trade was a 2-to-1 risk to reward ratio. So every loss is a -1 RR, because it's always going to be a -1 RR on a loss, because that's how much you're risking. And every win could be, let's say you went for a 1-to-1 risk to reward ratio, that's a +1, or you went for a 2-to-1 risk to reward ratio, that's a +2. So every win could be like a +2, +3, +1, +2, depending on the risk to reward ratio. So then you would take that number, you take how many losses you had, and the amount of RR as far as your risk to reward that you profited at the end of it, and you want to see that number. So in that instance where out of the 50 days you took 100 trades, and let's say you always went for a 2-to-1 risk to reward ratio, so you had out of 100 trades, you won half of them. So it's 50 times 2, because you had a 2 RR, you always went for a 2-to-1 risk to reward ratio every single time you won. So then you add 100 RR, but then you have to subtract all your losses, which is a 1 RR each loss, and you had 50 losses. So at the end of the day, you have a 50 RR positive. And the reason that number is important is because no matter what you risked, let's say during that period, starting June 1st all the way to May 20th or whatever it is, all the way up to that period, if you risked $100, you know you would have profited a 50 RR, which 100 times 50 is 5,000. Hopefully I didn't lose you guys in that. A simpler way of tracking it as well, if you don't want to track the RR profit, is if you just say every single trade I risk $100 and every single trade I'm planning on making $200, something like that. And you can just track that profit at the end of the day. But you want to have that just so you can see for yourself what is the profitability of that strategy outside of just looking at the win rate itself. Another thing you do want to track though is the amount of ticks that you won or lost on that trade. So I mentioned to you guys, showing you guys that long or that short position, you can see that middle number is going to be the amount of ticks. So if we come here and let's say this is the trade, you risked 29 ticks to make 127 ticks. This is an example, obviously. If you lost this trade, you'd write in your journal, let's say, what day is this? March 24th. I took this trade at 1 p.m. And let's say I lost. I put this all on one line, sorry. March 1st, 1 p.m., loss, right? And then I lost, so I'd be negative, on this example, I lost 29 ticks, negative 29 ticks, right? And then let's say I'm typing it out and I'm saying my my tag on it was low volume, right? Let's just say that was my tag, for example. This is a quick, simple way of how I would actually journal my trade. Now, let's say I took another trade on this day. So I say March 24th. Let's see, I took this at 2:43 p.m. I won, let's say 253 ticks. Perfect setup. This is what I write. Now, keep in mind, I wouldn't really write this on the chart itself. I really have it on a notepad or like on my phone or something like that, or some other application, because I want to be able to compile that information and see it without it being on my chart itself. That's how we're tracking it. That's how we're going to optimize our strategy. But coming over to the next thing is to actually optimize it, because I was testing it and that's getting the data to test it. But remember, I told you guys the data is important, but we need to be able to optimize that data, and having that data that we just went over and tracking that data allows us to optimize it. So once we have went through those 50 days, we're going to look over back testing written results and determine patterns from the small key points you noted. So if I noticed 50 out of my 100 losses, I had a key point that noted it was low volume because it was late in the day. That means I should probably not trade that strategy late in the day when there's no volume. So I can cut out those losses by not trading those things. And that's just small key points that you'll see. And that's why we add those little key tags to each and every one of the strategies or each and every one of the trades that we take. Next, you're going to look over your back testing trades on the chart to see similarities between winners and losers. What I mean by that is, even if we didn't write a key point for a loser or a winner, we can look back on the chart. So let's say we go back to our chart here and see, okay, this trade we took right here, we won it, but if we held it longer, it would have kept going up. Well, this instance didn't keep going up, but let's just imagine that it kept going up, right? So we could be like, okay, instead of us always going for a 1-to-1, we could probably always go for a 2-to-1, and that would make us way more money, right? Or we could be like, okay, we entered into the trade right here, our stop loss was right here, and our take profit was up here. And it's like, okay, I'm seeing and looking back on all my trades, and I'm like, okay, 10 out of my 30 losses that I had, I got taken out of the trade. It hit my stop loss, and then it instantly went to my take profit. So maybe I should try making my stop loss a little bit bigger, giving my trades room to breathe. That way I don't lose as many trades. So that's what I mean by looking over your backtesting trades on the chart, because we want to see the price action of each trade on the chart itself, not just the notes that we took. So once we do that, then we're going to look for patterns in our wins that could allow for us to capitalize on our wins more. That's what I went over, which is holding our trades longer, scaling in, which means as price is going up, let's say we're in a buy, and as price is going up, we're buying more contracts, the more we're believing in the trade. Or trailing our stop loss. Trailing our stop loss simply means, let's say we're in a trade right here, and as price is going up, we're moving our stop loss up. So let's say price is going up here, then as it's going up, we're moving our stop loss up the same amount. As price is going, I can't grab my line here. As price is going up, we're moving our stop loss up even more. That's what trailing your stop loss means. It's just trailing it as price is going up. It just helps you to minimize your risk. But then also, we're going to look for patterns in our losses that can allow for us to lower our risk amount. So patterns that we could look for is maybe moving our stop loss to break even once our trade goes halfway to our TP, or maybe closing partials or trailing our stop loss again, how I mentioned. Now, this is a tactic I use a lot as far as moving our stop loss to break even. What that looks like, and the reason why that's so good is because it then makes the trade risk free. So let's say I entered for a buy right. Let's say I entered for a buy right here, right? And originally my stop loss is right down here and my take profit is up here. Halfway to my TP is somewhere probably over here. So as soon as price hits this area, I'll move my stop loss to break even. Basically, moving my stop loss to break even just means moving my stop loss to my entry point. So if I entered here, I'm just going to move my stop loss to here. That way, if price comes back down here, I'm not going to lose money. It's just going to take me out of my trade, basically where I entered at, which in turn makes me not make any money, but I also didn't lose any money. That helps us protect our trades. So if you've noticed patterns in your backtesting over the past 50 days of you backtesting or however many days you trade, remember, it's 50 days minimum that I suggest. So you can get enough data compiled. If you've noticed patterns that's like, okay, if it hits halfway to my take profit and then it reverses, majority of the time, if it reverses after going halfway, it goes all the way down to my stop loss. And our job as traders is to protect our risk. It's not to make money. It's to protect our risk. So if we realize we can protect our risk by when price moves to take profit, or not take profit, halfway to take profit, we can move our stop loss to break even. That way we can protect us from losing any money on that trade at all. So that's just an example, obviously, of ways that you can practice or things that you can see from looking for your patterns in your losses on the charts that could help you make better decisions moving forward to optimize your strategy. Now, getting into further optimizing your strategy, backtest with the new optimized versions of your original strategy for at least 100 days. Now, what I mean by that is, let's say during that first optimization period, you said, okay, boom, instead of only holding my trade for a 1-to-1, I'm going to hold it for a 2-to-1. And then I'm going to move my stop loss to break even when it hits halfway to my take profit. Let's say that's your new rules that you have for your strategy. Now go back test that new strategy doing those same steps, not on the same days, do completely different days. You can do those same days as well, but make sure you include different days in there as well and see how it changes. See if your win percent went down versus what it was before. See if your R profit went up or down based off of what it was before. See if your overall total tick amount profit went up or went down. See that type of data. And if you're happy with the results, then start trading the new optimized version of the strategy versus the other one. Now, how I suggest for you guys to take this to the live markets, let's say you're backtesting a new strategy, one that hasn't been proven versus one that I've given you guys, is to take the strategy live in the markets with the smallest positions possible. So instead of you trading NQ, trade MNQ. Instead of you trading ES, trade MES and only do one contract. Do the smallest amount because you're just testing this. And I suggest for people to test it for at least a month before going to normal position size. And while you're in this testing phase, continue to track all the same metrics from the testing phase. We're going to get into this a little bit later on inside this video about journaling and journaling on live when you're trading live, because it's very similar to when you're journaling your back testing. But you need to track all this data and keep all this data tracked. So yeah, if you're happy with the results after you fully optimized it, you went through the first optimization and then you back tested with that optimized version and then re-optimized it, or you kept that re-optimized version, take it to the live markets with very small positions. Do that for about a month. Move over to then trading on normal position size and continue to track the data from there. Now, if you're not happy with the results of your optimized versions, then repeat the optimization process. Go back, look at what things you could have made better with the re-optimized version. Let's say instead of you jumping from a 1-to-1 risk reward ratio every time, instead of you jumping from that to a 2-to-1, maybe try going to a 1.5-to-1 risk reward ratio. Maybe not moving your stop loss to break even, things like that. Also, I forgot to mention this. If you do decide to do anything where you move your stop loss to break even, make sure you track in every single one of your trades that did go back to break even. So the same way we were tracking our trades before with the like the wins, losses, and things like that, track break evens as well. But yeah, that is how you back test. We went through exactly how to do it on charts. But the biggest part of it, I see a lot of people back test and they have no results to show for it. They make no progress with their back testing because they're not journaling and optimizing their back testing. This is the most important part of back testing. You don't just want to go in there and click random spots and draw random lines and boxes and all this stuff. You need to track the results. That way, when you're trading live, you have the data. You know every single time you click buy or sell that you have a 70% chance of winning this trade because you've back tested 200 days of this strategy, and over the course of those 200 days, 70% of the trades you took won. That way, you in your live trades, you're confident knowing that you can actually make or win 70% of these trades, or that if you follow every single thing that you did in your back testing results, you're going to win 70% of your trades most of the time. Let's get into what is journaling, right? So journaling your trades involves keeping a detailed record of each trade you make. This typically includes the date and time of the trade, the instrument traded, the entry and exit points, the size of the position / the risk that you had, and any reasons or strategies behind the trade. And we're going to get into a checklist for all the things that you should be journaling in a second here. But this is the benefits of journaling your trades. So it gives you a track record. It helps you to maintain a detailed record of your trades, including your profit and loss, your win rate, which can be very, very valuable for analyzing your performance over a certain amount of time. It also gives you a great overview analysis. By reviewing your journal, you can actually identify patterns in your trading behavior, learn from your mistakes, and refine your strategies, and really double down on the winning things about your trading. Similar to how we talked about in back testing, where you see your patterns in your losses. You see, okay, 40% of the time I lose my trades is because I entered too early. Or 50% of the time that I win my trades is because it was between the hours of 12 and 1 p.m. or whatever it is. And you start picking up on those small things, and that helps you to refine and optimize your live trading. It gives you emotional control. So journaling can help you manage emotions like fear and greed by allowing you to reflect on your decisions in a more rational way. Instead of you looking at each trade on a day-to-day basis or trade-to-trade basis, you can zoom out and see how you've been trading over the past week, the past 2 weeks, the past month, right? And that helps you put in perspective, no matter if you had a losing day today, that small losing day looks like nothing compared to the monthly chart or compared to the monthly profit and loss that you have with your trading. It also helps with accountability. So it holds you accountable for your trades, as you're more likely to stick to your trading plan if you know you have to record each trade. We're going to get into the things that you have to record in a second here, but it helps you stay very, very accountable because you're going to have to write down why you entered the trade. And if you don't know why you entered the trade, you're going to be looking at yourself like you're stupid. And you do not want to do that. So it holds you accountable knowing that you have to write down a reason or try and think of a reason if you don't have a real one when you're going over your journaling at the end of the day. Now, journaling helps with improvement because it can help you improve your decision-making process by forcing you to have reasons for entering or exiting each trade, similar to exactly what I just said. It also helps with strategy development. It can help in the development of new trading strategies by providing insights into what works and what does not work. So being able to look over your journal and see the data on it shows you the things that you should stop doing. Maybe you should stop trading on Tuesdays. Like for me, I know I should not trade natural gas on Thursdays because of me journaling. I've noticed that my win rate drops over 50% on Thursdays when I trade natural gas. So what did I do? I just cut out trading natural gas. Simple as that. It also helps with risk management. So by journaling your trades, you can assess whether you're effectively managing your risk exposure. And we'll get into this a little bit later on, but there's platforms that can journal your trades for you, and they'll put it onto a nice little calendar that will break down, okay, Tuesday, March 1st, you won $1,000. Thursday, March 7th, you lost $500,000. That's extreme, but you'll see like on your winning days, you're plus 1,000, plus 500, plus 600. On your losing days, you're down 4,000, down 6,000. It puts you into perspective to realize I'm not managing my risk properly. I'm not risking the right amount of money for the amount of money that I'm making on my winning days. So it helps you see that when you actually are journaling your trades. It's great for learning because it could be a valuable learning tool helping you understand different market conditions, how various factors influence your trading. There's also traders who have noticed from their trading that they are much better at just buying trades versus selling them. So they're good at seeing market when it's going to go up, but they're not good at seeing the market when it's going to go down. So they only really look for buy opportunities. There's people that have done that. And it's just so much that you can learn when you journal your trades and pull the curtain back. So how do we actually properly journal our trades? So you're going to want to write, and like I said, there's platforms that'll do this for you automatically. There's one that I've used for the last couple of years. I'll leave a link for it inside the description down below. It'll automatically get all this data. You'll just have to input one part in there, and that's the part, and we'll get to this a little bit later on, but that's the part where you explain why you entered into the trade. But everything else, it'll completely automate it for you, so you don't have to do it. I highly suggest for every single trader to use it. I'll put a link for it, like I said, in the description down below to use that journal. But you're going to want to track, if you're writing this yourself on a piece of paper or on a spreadsheet or something, you want to track the day and time that you took the trade. You also want to track what instrument you traded. Let's say you traded NQ or you traded ES or CL, whatever it is. You want to track the direction of the trade. Either you went long, you entered buys, or you went short, you entered sells. You also want to track the size of the position you took. So how many contracts did you open up when you bought or sold that trade? You want to write down how much money you risked on the trade, how much money you planned on risking on the trade. So say you planned on risking $500. You want to write that down. And then you want to write down the amount you expected to actually make on the trade itself. You're also going to want to write down how much you actually lost and how much you actually made on the trade, because we can plan to lose 500, but if we cut our losses short, you can write that down as well. And that's something you'll have to do manually if you do use an automatic system. But it can do it automatically based off of your trading if you just to cover the how much you planned on risking part. But if you ended up, how much you actually risked part, because it'll show you how much you actually risked, or how much you actually lost, or how much you actually won. But it won't be able to track how much you planned on risking. But you do want to track that as well. You also want to track what strategy you used when you took that trade. You want to track why you entered that trade as well. As far as, did you enter because it broke above a swing high? Did you enter because you got a bullish engulfing? Did you see a doji? Did you see this? Did you see that? Whatever it is, you want to write that down, because you'll notice patterns that, let's say your setups where you wait for a doji played out more than setups where you entered on a bullish engulfing, or where you waited for a break of a swing high or swing low played out better than when you waited for a hammer. Things like that you'll notice. You also want to obviously write whether the trade was profitable or it was a loss, and the amount of profit or loss that you actually incurred, or how much you actually lost or won. You also want to write how you managed the trade, including any changes to stop loss or take profit levels, when and why you decided to close the trade. So this is another part you'll have to put in manually if you do decide to use any automatic journals. You'd want to write down why you changed your trade at all. And I don't suggest you really, 90% of the time, I don't suggest you changing your trade once you're in it. That's why I said to make your trade plan. That way you have that and you know exactly what you're going to do. But if you do it some reason, you want to write down what you changed. Did you move your stop loss? Did you move your take profit? When and why did you decide to close the trade or move your stop loss or take profit? Just things like that. You also want to write down the overall conditions of the market. So something very short, like you could just say it was a news day, or a lot of volatility, or not a lot of volume. Things like that. You want to write that down because you'll be able to see patterns in days where there's a lot of news. You might see that you win more or you lose more. You want to write that down and see that to be able to make decisions based off of that. You also want to write the reasons for the trade. So your rationale for entering the trade, including any technical or fundamental analysis that supported your decision. That's what we went over. And then this is the most crucial one that I feel like a lot of people skip, and I always tell my students to pay attention to this, but write why you think you won or lost the trade. So if you lost the trade, but you think you lost it because you entered too early, or because you entered too close to news events, or whatever it is, write down why you think you lost the trade. And also on the flip side, write down why you think you won the trade, because you'll see patterns on why you think you won the trade. And you'll see patterns on, I think I won it because I saw 3 green candlesticks and then I saw my entry candlestick. Or I think I lost it because I didn't wait until the candle closed. I just entered in the middle of the candlestick and it wicked me out, or it faked me out, whatever it is. You want to write down why you think you won or lost the trade so you can see those patterns. Journaling is all about seeing the patterns and seeing the data. I told you guys before that trading is all about gathering data and making decisions based off the data that you gathered. You have to gather the data with journaling and then make decisions based off of that data that you did gather. So track why you think you won or lost each of those trades. If you can do that consistently and then look back on your journal at least once a week, I suggest for people to do it on like a Saturday or a Sunday when the market's closed. Look back on your journal before the next week starts, make decisions and altercations. What is the word? And make changes. We'll just use that. Make changes to your system or your strategy based off of what you journaled the past couple of weeks or so. If you do see any patterns, stop doing the things that the patterns that you saw in your losing trades, and stop doing the things and start doing more of the things that you saw on your winning trades. And that'll help you out a lot. So read back on your journal. Do not just write these things down and journal these trades and never look back on it, because that just becomes pointless at this point. You need to look at the data. It's going to be one of your most best friends. I promise you. People ask me all the time, what was my biggest stepping stone to become a profitable trader? And it's when I started consistently journaling my trades, and not just journaling them, but looking back on the data of the trades themselves and adjusting my strategies, adjusting my systems, adjusting my psychology based off those things. Now, I'll be honest, journaling is honestly one of those things that most people skip because they don't have anyone holding them accountable. But it's so important that you actually do it and you stay consistent with it. That's why I mentioned multiple times throughout this video that you should send this video to a friend right now if you haven't already. Set the time with whatever friend you send it to or group of friends that you send this to. Set a time to compare your journals every single week. Set a time to review your journals, and it just makes it so much easier to actually take action, learn from your journal results, and actually be able to improve when you have other people doing it with you. I promise you that if you have somebody else to go through this journey with you, it'll make this process so much easier, so much less stressful, and it'll just be a lot more fun. And you'd get to the results you're trying to achieve a lot faster versus you trying to hold yourself accountable. So I mentioned prop firms, but let's dive into exactly what they are and why they are literally game changers for every single trader. In simple terms, prop firms give us as traders the opportunity to pay a small amount of money, let's say $500-$600, to trade with capital as high as $200,000, $150,000, $200,000, $250,000 with certain prop firms. Now, the way that they do this is you pay a set fee to have an evaluation or a challenge most of the time, where you'll pay that $500, and you pay that $500 to have the opportunity to prove to this prop firm or prove to this company that you can actually trade. And once you prove that you can actually trade, and that's you're proving to them that you actually trade by hitting certain profit targets and not losing a certain amount of money before you hit that profit target. And then also some other small rules that they have on their websites and things like that. So that's basically the gist of it. You're paying $500-$600 to take a challenge and prove to a trader or prove to a prop firm, or a funded account is another word for them, prove to a funded account that you can actually trade. And once you prove to them that you can actually trade, they will let you trade with, let's say, $100,000 or $150,000 account. And all the profits you make on that account, you keep a majority of the profits. Some of the prop firms you keep 100% of the profits. Some prop firms, you keep 90% of the profits. Some you keep 50% of the profits. It all depends on the prop firm, and there's so many different things to go through on the prop firms to understand them in the best way possible, depending on you as a trader. But for the most part, that's it. So you're paying a set amount of money to make a ridiculous amount of money. So if you think about it, if you remember what I was just saying, 20% in a month is pretty great. 20% on a $150,000 account is $30,000 in a month. And the only thing you had to pay, the only money out of pocket for you, is that $500 or $600 fee that you have to pay to get access to take that challenge, to pass that challenge and get funded. Now, these challenges are not easy, right? They're not like you come in here and you just randomly make money, right? That's not how it works. These challenges are built to filter out people who can trade and people who cannot trade. And then once you pass the challenge, most of the time, if the prop firm does have a challenge, most of the time you pass the challenge, then you have to make more money. And then that money that you make on top of it, You can withdraw a certain amount of that. Some of them will start off with smaller withdrawals that you could take. Then when you're more consistent with your trading, you can take out bigger withdrawals and things like that. There are a bunch of different prop firms. Like I said, we'll go over a couple of them here, but I just want to go over a couple of the benefits of them. So as I told you, they give you capital. You do not have to load up your own account. If you don't have $50,000, $100,000, $150,000, you can leverage other people's money, which, like I said, is extremely beneficial. We all know, like with real estate, you're not supposed to just go buy your house cash, right? You want to leverage other people's money, use other people's money. That way you can actually buy more of the asset. So same way when it comes to trading. It's honestly, I didn't have prop firms, or I wasn't aware of prop firms when I first started off trading in the beginning. If I did, it would have been a lot easier and I wouldn't have lost that $60,000 of my own money. But yeah, so they give you capital. You can trade with their capital. The next thing is that they kind of force you to have risk management, because I mentioned to you guys that they have their own rules. You have to make this amount of money without losing this amount of money and doing this and doing this and doing this. So they give you a set amount of rules. So it forces you to have risk management, because you don't want to lose the account. If you lose the account, you then have to pay that amount again. Now, keep in mind, a lot of people ask me this when it comes to funded accounts. Let's say you have a $100,000 funded account. If you lose $3,000 on that account, you don't actually lose $3,000. You don't have to pay them $3,000. You don't have to, they're not going to come after you or nothing like that. You just lose the account. You blow the account is what we call it. When you blow the account, you can simply just buy the account again or retry it. You can actually pay a reset fee and reset it and start the challenge all over again. So as you can see, this can be a very, 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 very beneficial thing for us as traders to be able to leverage other people's money while limiting our downside. Because no matter what, if we paid $600 for that prop firm challenge, if we lose $20,000 on the account, most of them would not let you lose $20,000. But if you lose $20,000 on the account, you didn't lose $20,000. You only lost $600 out of your pocket. And that's one of the biggest benefits when it comes to prop firms. Like I said, they also force you to have risk management because you have to follow their rules to pass their challenge. It also lets you use other people's money to make money, which is what we've talked about, leveraging other people's money. You don't have to put $20,000 of your own money into an account, $100,000 of your own money inside of an account. You can pay that fee, make money, and withdraw percentage of the profits, and the prop firm keeps the other percentage of the profits. You don't have to risk your own money, and you have account resets, which, like I said, you're not losing all the money. You're not buying a $150,000 account, losing $10,000, and now they're coming after you for $10,000. That's not how it works. The only thing that you are accountable for is when you pay that challenge fee. And if you want to reset it, you can reset it. So that's some of the benefits of a prop firm. We're going to get into exactly how to pass a prop firm here in a second, but I want to show you guys my favorite prop firm to use. And there's a reason why it's my favorite prop firm to use. It's because it's my prop firm. If you guys have been seeing up here, the Edge Funder, this is my prop firm. It's built by a trader, obviously me, for other traders. And I built it because I've gotten multiple payouts, tens of thousands of dollars from payouts from prop firms. I've seen the good about it. I've seen the bad about it. And I decided to, instead of kind of just being upset more so about the prop industry or certain things I didn't like about specific prop firms, there are great prop firms out there, don't get me wrong, but there's certain things I don't like about prop firms that I really wanted to give a different option to people that benefit traders more so than just benefits the prop firms. So I built my own prop firm. I had the best team inside the world build this prop firm. The greatest thing, one of the best things about this prop firm is that I mentioned to you guys, most of the times you pay $500, $600 and you take a challenge. You take that challenge, you have to pass the challenge. Once you pass the challenge, you then have to make profits again, because when you pass the challenge, they reset the account. Let's say you start at a $150,000 account. When you pass the challenge, and let's say you get it to the profit target of a $150,000 account, profit target is usually like $159,000. So let's say you get it to that. Once you pass the challenge, they then reset you back down to a $150,000 account, and you have to do it again. And then you can start taking profits on top of that $9,000, if that makes sense. And I wasn't really a big fan of it. I wanted people to be able to purchase the challenge, start making money, pass a payment threshold as far as pass a certain amount inside of the account, and everything above that account that they make, they can keep it. That's why I built the Edge Funder, which to me is obviously the best prop firm out. I'll go over a couple other Reasons why I love this prop firm, why I truly would suggest it for every single person watching this. Once you've went through your demo phase, once you went through all the other phases, the small live account, then coming to a funded account, a prop firm account, specifically for the reason that this is the best option for to scale your trading after that. So we have no challenges on it. So not a single challenge. You don't have to pass a challenge. You don't have to hit a certain profit target and then prove to us that you can trade. We are calling all really traders that have an edge already. What I mean by edge and why this is called the edge funder is because an edge is a strategy that works. I teach on my YouTube channel strategies that work. So I attract people who have an actual edge inside of the market, people who have the ability to trade and want to be able to leverage how much money they're making with their trading without having to worry about challenges. So we have a direct funding where you come in here, you're able to purchase a $50,000 account, a $100,000 account, and a $150,000 account. And you're able to profit after you reach a certain threshold inside of your account. Once you reach that threshold, all the profits on top of it, you can start taking payouts on. You can start withdrawing that money. Same way applies to this. If you buy a $100,000 account, let's say you lose $3,000, you don't owe our prop firm $3,000. You would simply just have to reset your account and you can try again. Now, I want you guys to take this with a grain of salt. Just because you can reset your account does not mean I suggest for you to go and keep blowing accounts, trying to get lucky. That's not how this works. And that's only going to make you end up losing money. The goal of this is to get you guys to end up making money. So that's why I said for you guys to go through that step-by-step process of starting on that demo account, then going to that small live account and getting consistent with that and building your confidence in your trading, and then go the route of a prop firm or loading up your own live account to be able to make profits with. But this is the prop firm that I truly would suggest. I will leave the link for this inside the description down below. It's like I said, I built it to be the exact thing that I did not, the exact thing that I loved about prop firms and taking away the exact thing that I did not like about prop firms. So that I felt made it way too hard for traders, new traders, and experienced traders to start making money in this space. So like I said, I'll leave a link for this prop firm down in the description down below. But now I'm going to dive into how do you actually pass these prop firms? How do you actually get money? If you decide not to go with the edge funder and not go with the direct funding where you actually try and pass a challenge instead of going direct to funding, we're going to dive into how do you actually do that. But the same systems that I'm going to show you guys and the same techniques that I'm going to show you guys are the same things that you can use in here to skip the challenge phase process and just start making money without having to pass the challenge. You'll just follow the same steps that we're about to go over right now, and you can start actually withdrawing real money into your bank account. But yeah, like I said, I'll leave the link for this inside the description down below. And let's hop into how to actually make money from these prop firms. So how do we make money with these prop firms? Regardless if you go with an instant funding like the edge funder, or you go with a regular challenge account where you go through the challenges and then start making money on top of the after passing the challenge, it's important that you follow these specific steps, because as I just mentioned, I don't want you buying these prop firm challenges just to lose them and rebuy them just to lose them, to rebuy them just to lose them. That should not be your mindset. I do not want that for you guys. I want you guys to be able to actually make money with these prop firms and by leveraging their money, not just keep feeding them money. So how do we do this? The first thing and the first suggestion and first most vital tip that I have for you guys is to not trade your funded account every day. I know it can get very, you get very excited because you're like, man, I have a $100,000 account right now. If I just make $3,000 on it, I can literally pay my car note, I could pay my rent, I could do all this, right? And I understand that. But what that does is that brings emotions in. I will keep saying this, you guys will keep hearing this, that emotions and impulsiveness will make you the most unsuccessful trader in a very, very short amount of time. When you get in that mindset and that emotion of overly excitement or trying to rush the process, you're going to end up taking trades that are not there. You're going to end up saying that you're taking the ultimate support or resistance strategy, but you're just taking random trades, or saying you're taking the squeeze strategy, but you're taking random trades, saying you're taking the scalping strategy, but you're just literally taking random trades. I 100% do not suggest that you trade every single day. This should be, the funded account that you're using should be used to trade when everything aligns on your checklist. What I tell people and what I suggest is if everything does not align on your checklist, but you're just itching to trade, go on a demo account. Trust me, going on a demo account when you really, really want to trade, but you know it's not a good setup, will save you so much money and it'll get that itch out. You'll still be able to feel that dopamine hit of you actually trading. So don't trade your funded account every day. Only trade it when it's the good setups and everything checks off. Now, when it comes to risk, so risk, as I said, or prop firms, as I said, they're going to give you their own rules. So a lot of them will be like, you can't, if you have a $100,000 account, you can't lose more than $4,000, right? So what you want to do is not risk too much money, especially as a new trader. And this is the area that I would suggest for most of you guys to be in, which is the conservative approach of risking 0.5% to 1% per trade. And what that looks like is if you have a $100,000 prop firm account, you can risk $500 per trade all the way up to $1,000 per trade. And that's it, right? Now, if you're more advanced, and I have one right here, you can risk 1.5% to 2% on each trade. And that's to be more aggressive. As I explained here, that's for experienced traders only. What most of you guys should be doing right now, at least for the first couple months as traders, is risking a max of 1% per trade on your funded account. If you have a $100,000 account, you're not supposed to be risking more than $1,000 per trade. You should really be risking about $500 to $750 per trade on your prop firm account or on your funded account. It does not make sense for you to be aggressive and try and rush it, because what's going to end up happening is if you're too aggressive and you're not experienced enough, you're going to end up risking 1.5% to 2% per trade, and you're going to blow your account in one day. We don't want that to happen. We want you to have longevity in this, but we also want you to have breathing room, because no matter what strategy you're using, you're going to end up losing. And there are times when you can go on a losing streak. So having your risk lower allows you to go on that losing streak, but still not lose your account. Like every single strategy that we went over today, the ultimate support and resistance strategy, the squeeze strategy, and the scalping strategy, I've used every single one of them individually to pass prop firms and make money with them. So the strategy works completely. I've done this multiple times. I literally just passed 5 account challenges because somebody had challenged me to do one. They thought that I couldn't do one. So I passed 5 challenges in 4 days or something like that. 4 days, 3 days, I forget. But and I was using the scalping strategy for that one. So every single one of the strategies can be used to pass prop firms and make money. If you're using the instant fundings like the Edge Funder, you can pass. You don't even have to pass the challenge. You can use these strategies to start making money instantly on these prop firms. But the thing is, if you don't give yourself enough breathing room, if you go on a two lose streak, or you on a 2 losing streak, that's how you put it. If you're on a 2 losing streak and you over leveraged, you risked way more than you should have, the account's gone, and then you have to buy a new account. Now, obviously, it's not the end of the world. You don't owe them $10,000, but still, you having to keep buying accounts could add up over time, and we don't want that. So, like I said, be conservative with your trading, especially when you're first starting off. If you're new to trading or if you're new to prop firms, be conservative. And then when you're more advanced, possibly you can up that risk to about 1.5%. Now, understand you can reset your challenge, but don't abuse it. Now, I've talked about this a couple times already, but what I mean is some people will come in here and just Hail Mary it, right? They'll be like, okay, I'm going to risk $10,000 on this account, and I'm going to make 10,000, right? It's either I lose 10,000 or I'm going to make 10,000. First of all, some prop firms have rules set in place to stop you from being able to just randomly get lucky and make $100 million. But even if they don't have that set in place, still don't abuse it, because I promise you, majority of the time, you're going to lose every single time. You're going to lose the account, have to try again. Lose the account, try again. Lose the account, try again. Lose the account, try again. And you don't want to abuse the whole aspect of being able to reset an account. You want to trade this funded account as if it's your live account. Treat it as if it's like your actual funds, like if it's actually $150,000 in your account, or actually $100,000 in your account. So be very cautious of that. Next, like I said, I'm going to double down on this, is don't trade your funded account every day. Only take the A+ setups. A+ setups for me is when everything aligns. If one thing's missing, it's not an A+ setup. When it comes to trading your funded account, only take the A+ setups. If you really want to trade, but everything's not aligning, go on a demo account. I promise you, it'll save you so much money. But realistically, just be very cautious of when you're trading prop firms, because a lot of people will come into the prop firm space and buy a prop firm and treat it as if they have that demo account kind of euphoria that I talked about before. These prop firms are not demo accounts. These prop firms cost you real money. They it's not just free lying around. So don't get in that euphoria just because the number is big, just because your account size is $100,000 on a prop firm. Don't let it get to your mind where you just start randomly taking trades. Treat this more serious than you would that small live account that you have. Now, before we hop into how to actually create a trading plan, why is a trading plan so important? A trading plan allows you to have risk management. It helps you have a defined risk management strategy that will help ensuring that you don't expose yourself to extreme risk on a single trade or over time. So risk management means, in simple terms, is managing your risk, making sure that you're not losing more than you're supposed to. You're risking a consistent amount. You're risking a known amount. A lot of people will come into this and they don't know how much they're risking per trade, and somehow they're down $100 million. Having a trading plan stops that from happening. It helps with consistency. So it promotes consistency in trading decisions, which is very crucial for measuring performance and success over time. You really have to trade like a robot. That's why I make systematic approaches. That's why all my strategies in this video are all systematic. So it's not thinking. You do exactly what the strategy says, and the strategy works. It helps with logical decision making. Having a well-structured plan reduces emotional and impulsive decisions, which helps you make reasonable and logical decisions in trading. The biggest downfall a lot of traders have, is being too emotional and being impulsive. Emotional and impulsive decisions will cost you the majority of your money inside of your trading career. So you need to make logical decisions, and how you do that is with having a solid trading plan. Now, it also lets you or helps you with goal setting. So it allows traders to set clear and achievable goals and work consistently towards achieving them. Having a plan streamlines the trading process, makes it way more efficient, less time consuming, and more stress-free, because you're not thinking about what you're doing. You're following your trade plan. You're following that checklist. You're following the thing that is the system that has been proven to work. It helps with your confidence as well, because traders with a solid plan often have more confidence in their decisions, which can lead to better trading outcomes. Now, I told you guys that confidence is a huge thing to have, and you get confidence by having the data. That's why we talked about backtesting just now, because when you have the data that tells you that 70 out of the 100 trades you take, you're going to win, you have a certain level of confidence. Now, you don't know when that other 30 is going to happen. You don't know when your losses are going to happen. You just know over a long period of time, you're going to be profitable and you're going to be winning more trades than you lose. It helps with discipline. So following a plan requires discipline. A key attribute to trading is helping to avoid rash decisions based on market noise. So we need to be extremely disciplined. If you're not a disciplined person, trust me, trading will make you very, very disciplined, because you need to have discipline to succeed in trading. Now, let's get into how to actually build your trading plan. What do you need to have in your trading plan so that you personally can make your own? Because my trading plan is not going to be the same as your trading plan. My rules are not going to be the same as your rules, but we need to have rules, because another big part of having a trading plan, benefit, I should say, is, and I want you guys to think first for yourself. I don't know if you're in school. I don't know if you have a job, but if you're in school or you have a job, you have somebody holding you accountable. You have a boss saying you have to do this, this, and this. If I see you doing this, you're fired. You have a coach or you have a school teacher that's like, if you don't do this, this, and this, you're out of here, right? You have somebody holding you accountable. When it's trading, it's you and a computer. Like, if you don't have the discipline to follow your trading plan and not risk your rent money and not make stupid decisions, there's no one that holds you accountable. The only thing that's holding you accountable is you running out of money. But having a trading plan forces yourself to hold you accountable. It's like having your own personal coach. It's like having your own teacher. It's like giving yourself a boss, because you have to follow this trading plan. And I'll show you guys how you actually make sure you follow it, regardless if you're a disciplined person or you're not a disciplined person. So let's get into building your trading plan. So the first thing you need to have in your trading plan is you need to identify the kind of trader you are. So you need to identify if you're a scalper, a swing trader, or an intraday trader. We went over all three of those are. Identify for yourself, based on your personality, your trading goals, how much time you have during the day. Define what type of trader you are, because you need to be aware of that. Next, you need to give yourself a time frame. Just like with the job, you're there from 9 to 5. You're at school from, I don't even know what kids are in school, 7 to 3, maybe. I don't know what time kids are in school. But whatever. Give yourself a time frame for when you're allowed to trade. And the reason why it's so important to give yourself a time window is even when we go back to our back testing, how we just talked about back testing, we're using the kill zone indicator to stop us from trading at 4 o'clock in the morning, because we don't trade at 4 o'clock in the morning. We're using the kill zone indicator to tell us, or to show us to not trade, or to show us that it's 9 o'clock at night. We know we don't trade at 9 o'clock at night. We're usually eating dinner with our family or whatever it is, right? So we know we don't have any data tested for that period. So it doesn't make sense to trade that period. So having a rule, or in your trading plan, having a set of rules that's like, I'm only able to take trades from 8 a.m. to 1 p.m. It stops you from taking trades outside of your window that you don't know. You never tested 5 p.m. You never tested 6 p.m. It stops you from taking those trades when you're just bored playing video games and it's 7 p.m. and you just see a chart open and you just want to press buy or sell. It stops you from doing that, having that. So make sure you put the time frame that you're allowed to trade from. Now, that doesn't mean if you put 8 to 2 p.m. that you're sitting in front of your charts from 8 to 2 p.m. That just means if a trade happens between 8 and 2, you can take that trade. If you're sitting at your desk and the perfect setup happens at 4 p.m., but your rule says you stop at 2, you stop at 2. You do not take that next one. Next thing is what instruments you're allowed to trade. So as beginners, right, we can get very, very overwhelmed. And we think if we have 100 million charts open, that's what makes us successful. We have NQ, ES, YM, gold, Ethereum, Bitcoin, Tesla, NVIDIA. We have all these things open and we get super confused. I do not suggest doing that. For beginners, I suggest to focus on 2 to 3 instruments max. And the reason why is because each instrument or each pair, as we've talked about, has their own personality. And if you're trying to learn, I got analogies for days. My analogy for this, and what I tell a lot of my students and people in my inner circle, my analogy for instruments is, imagine you're a guy or you're a girl and you're trying to date 20 different people. You're going to forget the name of this person. You're going to forget the favorite color of this person. You're going to forget what you did on one night with this girl versus what you did on one night with that girl. It's going to get all confused because you don't understand. You don't remember their personalities because there's too many of them. Versus if you were a nice, loyal person and you were only with one person, you would know that person in and out. Same way when it comes to trading. You don't want to have a million things on your watch list because you'll never learn the personality of that 1 or that 2 or that 3 max that you should trade. So when creating your trading plan, decide what pair you're going to be allowed to trade, what pairs. Like I said, I'd suggest max 3, but if you can focus on just 1, you're going to be set. You do not need multiple pairs to trade. I promise you, if you can just focus on 1 and master 1, you will be rich beyond your wildest belief. But I understand people want to try out other things. So 3 max, 1 to 2 is the sweet spot though. And have that in there. You cannot trade anything else. If you say you only trade NQ and NG, don't open up an ES chart. Don't open up a YM chart. Don't open up a Forex chart. Stick with that. Next, you want to define what strategies you're allowed to trade. So there's a million different strategies that you can trade, and you'll get extremely confused if you try and trade all of those strategies. So in your trading plan, clearly define which strategies you're allowed to trade. Max 2. Do not go over 2 strategies or 2 setups. Choose which one fits your personality. You can test all of them out. Test all of them out and see which one performs best for you, the one that you understand the most, and choose 2 out of those, right? You have to define those strategies. That way, if you only trade the ultimate support or resistance strategy and the scalping strategy, I don't care if the squeeze strategy shows up perfectly. That's not your strategy. It's not in your trading plan. It's against your trading rules to trade that. So you don't trade that. Set risk management rules. So what that looks like is set a max risk per day or per trade. So you can be like, okay, I'm only going to risk $1,000 per day, or I'm only going to risk $300 per trade. You cannot go over that number. If you lose over $1,000, you have to stop for the day. If you risk, you cannot, when you're setting up your trades and choosing how many contracts you're going to trade, you have to keep in mind that you cannot risk more than whatever that amount is. Let's say your number is $300 per trade. Have that in mind because you need to have a solid risk management strategy and set of rules. You also want to define the max amount of trades you're allowed to take per day. Now, the reason that is so important is because us as traders, we think the more trades we take, the more money we make. In reality, the more trades we take, the less quality trades we take, the more money we get back to the markets. We'll get into this deeper later on inside this video, but we need to, you need to understand that you should have a small amount of trades, small pool of trades that you're allowed to take per day. And this will vary depending on if you're a scalper, swing trader, intraday trader. Scalpers, usually what I like to say is no more than 4 trades per day, 4 or 5 trades per day. Intraday traders, no more than 3 trades a day. And swing traders, honestly, I say about 3 a week. Honestly, no more than max 3 a week. Because what ends up happening is if you don't have a max amount of trades you're allowed to take per day, you can easily go on tilt, especially as a scalper, and take 30 trades in one day. And you were taking super not quality trades. You were taking trades that didn't line up with the checklist, that weren't perfect setups, and you're giving money back to the market. So have a clear, defined max amount of trades that when you hit that max amount of trades, you're done for the day and stop. Clearly set your entry criteria for entering trades. So you want to have a clear entry criteria. So we explained for the for the ultimate support and resistance strategy that we need it to break above a swing high or swing low. Clearly define that. Whatever yours is, if that is yours, good. If you have something else, clearly define that. That way that stops you from just randomly entering trades just because you felt like it, right? Clearly define what you need to see to enter a trade and stick to it. Next, you want to set rules for trading during the news / high volume event. If you know the fundamentals, we went over the website that you go to see when news is going to come out. Are you allowed to trade news? If you are you allowed to trade all throughout it? If you're not, what is the buffer that you give news to play out? Is it like there's heavy news, there's red photo news coming out at 8 a.m.? Do I have to wait until after 8:30 to start trading? Just clearly define that so you have that inside of your trading rules so you don't mess yourself up. And then also create mental rules for before, during, and after trades. So what I mean by that is, like I mentioned, impulsive decisions and emotions really mess us up as traders. So if you just got broken up by the love of your life, I promise you're not at the mental state that you should be to be able to make clear decisions in the market and make money. So give yourself rules for if you had a long day at work and you're too tired, don't trade. Give yourself rules that's like, if your girlfriend just left you, don't trade, because you're going to end up taking out your pain on the markets, and the markets are going to beat you up, steal your money, and you're still going to be sad, but you're just going to be sadder and broker. If you're angry, if you just got in a fight with your dad about something, you should not be trading. You need to be at the most neutral state of emotions possible when it comes to trading, so that your emotions do not affect how you trade or how you see the markets. So have rules for that. Next, you want to have clear, defined exit strategies. So is it whenever you get to a recent swing high or a recent swing low, you're going to exit the trade? Or whenever you make this profit, you're going to exit the trade. I don't really suggest going for profit targets like dollar amounts, because I feel like you leave so much money on the table when you do that. But if that's your thing, that's your thing. I just personally don't suggest that. But just create a clear, defined exit strategy for when you're trading. Then lastly, this is the most important part. I promise you, this is the most important part. If you don't do this, everything I said for the last freaking 13 minutes, if not the last couple hours, pointless. You need to create a consequence for breaking your trading rules and plan. Take it from me. Like I said, I've helped tens of thousands of people learn how to day trade. The biggest thing that people have or lack is the discipline to be able to trade consistently and make money. The reason being is because losing money is not enough pain for people. I don't know what you would think it would be enough. I guarantee you're saying in your mind right now, if I lost $1,000, I would stop doing the stupid mistakes that I keep making. Promise you, you're not going to. It happens to every single person. Losing money in trading is not a big enough slap in the face to stop you from breaking your rules. If you know your rule says you cannot trade more than 5 times a day, and you take 10 trades, and those 10 trades cost you $400, you're going to wake up the next day and probably still going to take another 10 trades. It's not enough. You need to create a real life consequence. And I'll say this, and this I try and say this in the softest way possible. This is how I explain it to my mentorship students. Give yourself a consequence that will give you a soft version of PTSD. Now, what I mean by that is something that you will remember when your finger, let's say your max trades is 3 per day and your finger's hovering over that button to enter your 4th trade. You get a flashback in your mind of the consequence that you have to do when you break your trading plan and it snatches your hand away. This is how you hold yourself accountable to your trading plan. This is how that trading plan becomes your boss. This is how that trading plan becomes the teacher that's holding you accountable. This is how that trading plan becomes the one thing that allows you to not just become profitable, but to stay consistently profitable. You need to have a real life consequence, something that you feel, something that you will remember. I can't give you one, but what I suggest for most people, and it seems to work well, unless you're like a crazy person, every single time you break any of your rules, I'm talking about the smallest of rules. If it says you can't trade after 2 p.m., you made the rules. You can't get mad at me. You made the rules. If it says you can't trade after 2 p.m. and you open a trade at 2:01, broke a rule, you got to do the consequence. If it says you can't risk more than $300 per trade and you close the trade out and it's $301, you broke the rule. If it says you can't do whatever and you break the rule, you have to do the consequence. Now, the consequence that I suggest for most people is to take an ice bath. I know few people that like ice baths. I've had one-on-ones with a lot of students, and some of them are like, yeah, I do that every morning. That's nothing. Kudos to you, David Goggins, but it's not for me. It's not for most people. But you know you more than I know you. You know something that you would hate. I have people that have to run 4 miles. I have people who have to give their sisters money. I have people who have to, there's someone that has to take some type of concoction where it's like some oil that has horseradish, and it's just super, super nasty. So every time he breaks the trading, any of his trading rules in his plan, he has to do that nastiness, or you have to do whatever your consequence is. If you know you're a person that absolutely hates running, every time you break one of your trading rules, tell yourself you have to run 2 miles. Instantly. I'm talking about as soon as you break the rule, you have to do the consequence. I'm not saying you build up all your rules and then you go do it on the Saturday. As soon as you break that rule, as soon as you lose more than that $300 or whatever your number is, you go do that consequence, because it needs to get ingrained in your mind. I told you guys, soft PTSD, not real PTSD, soft PTSD, where when you're hovering over that button to break that trading rule, you remember that 4-hour bike ride that you had to take, and you hate riding bikes, right? So for yourself, write that down. Write down whatever that consequence is. You hold yourself accountable with that consequence. Make it something. What I say to all my students is make it something that you won't want to do more than 2 times. I promise you're going to mess up. You're going to do it the first time. You're going to break your trading rules. It's guaranteed. Every single one of my students have done it. And like I said, I've helped tens of thousands of people, and every single one of them has had to do their consequence at least one. I can't remember the last time I've had someone had to do it more than 3 times. So if it takes you 3 times to have to do your consequence, that's bad. You didn't make your consequence bad enough. So yeah. That's how you create a trading plan and how you hold yourself accountable to that trading plan. It's very, very, very important that you go through all this, answer each and every one of these questions, and put your consequence for breaking any of these trading plans or trading rules. All right, so this is arguably the most important part of this entire course. It's the psychology. Right? It's mastering the mental game when it comes to trading. In this section, you guys really have to pay a lot of attention, and please trust me, this is important. And I know what you're thinking. You're thinking your psychology is strong, your mental game is strong, you have control of yourself, you're a very disciplined person. I was in your shoes. I thought the same exact thing. And when I was watching courses and getting taught and watching YouTube videos, I skipped over the psychology part every single time. But I promise you guys, if you skip over it, you're going to skip over it for 2 years, only to realize that when you come back and focus on your psychology, that's when you're actually going to become profitable. You will struggle for 2 years, skipping and ignoring the mental game of trading and not understanding it and not knowing how to master it. But if you guys can listen for the next few minutes or so and just let me give you guys the 7 principles that turned me unprofitable and how I help unprofitable traders turn to consistently profitable ones, I promise you guys will appreciate it. Just believe me when I tell you this. Now, first of all, as I mentioned, 5 years of failure taught me that trading is 80% psychology. It's 80% your mind and the mental game. 20% of it is the technical analysis. 20% of it is the strategies The risk management is part of psychology, but 20% of it is the strategies, drawing your support and resistance zones, trend lines. Like that's a small percentage of it. Honestly, after watching through this entire course video, you should be able to know how to draw support or resistance zones. You know how to do technical analysis. The hard part is mastering this mind. That's the hard part, mastering the psychology of it. But by the end of this section of the course, you are going to hopefully absorb all this and take it on and stop yourself from wasting years of failure. Because realistically, I had strategies, but I still lost money. And it wouldn't make sense because I'd see everybody else with the same strategy making money. I panicked in trades. I chased losses. I essentially sabotaged myself for over 5 years, struggling to trade. But the 7 principles that I'm about to share with you guys is what helped change literally everything. So principle number 1, this is important. You need to follow your strategy, not your emotions. Now, what does that look like? If your strategy has a checklist of 11 things that need to happen for you to enter the trade, all 11 things have to happen. If only 9 things happened, you have to skip it. You have to stick to the strategy. The strategy has that checklist or that set of rules for a reason. It's not there just for fun. It's not there just to look cool. If all these things happen, that gives you the highest probability of winning the trade. So wait for all those things to happen. Don't try and jump into it. Skipping criteria because the trade, quote unquote, looks good right now is just going to make you lose money. Moving your stop loss or extending your take profits or over leveraging mid trade when none of that has anything to do with the checklist that your strategy has is just going to cause you to lose money. You have to learn to trust the data. Like the checklist, as I mentioned, it exists for a reason. Honor it. Like the strategies that we went over inside this course and any strategies that you see me talk about or anybody talk about, and if they have a set of rules that you have to follow and wait for, it's there for a reason because we have tested it over years and hundreds and hundreds and hundreds of trades. I've tested every single strategy that I trade, not just that strategy with that set of rules, but I've changed and swapped out certain rules. I've removed certain rules, added certain rules, and the strategy that I share with you guys is the best version that I've found. Meaning, if you follow that exact checklist, you have the highest probability of winning based off of the hundreds and thousands of trades and thousands of days of data that I have with the strategies. Now, I'm saying all this to tell you guys that you have to trust the data and that the checklist is there for a reason. Do not bend it. Do not change it thinking that you know better or that this trade is different or this time is different. Never do that. Just follow the checklist because the checklist is proven. Now we talk about how to backtest and stuff and how you can try and make adjustments once you have enough data. Enough data is hundreds of trades. You as a beginner, you don't have enough data and you thinking too deep about it or you trying to remove stuff from the checklist is 99.9% of the time wrong and going to lead you astray. So you need to follow the strategy as it is taught, as it is shown, as the data shows. Principle number 2, detach from the money. This is super hard to see. Like you have to trade the setup and not the dollar amount that you see on the screen. Meaning there are a few things that end up happening, right? So most people will close winners early at, let's say, for example, $200 when your original target was $700. And the only reason they closed it because they started thinking in their mind, dang, $200 sounds nice. I can buy a new pair of sneakers with $200. I can buy some clothes with $200. You start thinking in terms of money versus in terms of the setup versus the strategy, the trade itself. Closing trades out, it might feel good in the moment because yes, you locked in a few $100. But if you look back over the course of 10 trades, 100 trades, and you see how much money you left on the table by not holding until your full take profit, you want to slap yourself in the face. I promise you, this is real. It not only happens to me, but all of my students go through the same exact thing. So you need to focus on not looking at the money that's causing you to actually close your winners too early. The next thing I see is that you're panicking at, let's say, for example, $300 worth of drawdown, but that's still inside your plan, meaning your plan, let's say, for example, you opened up the trade with a stop loss that has $600 stop loss, right? And you're negative $300 and you're like, oh no, I don't want to lose $300. So you close the trade out. You had that stop loss put there for a reason. Let the trade play out. If you lose the trade, you lose the trade. It's perfectly fine. Losing is part of the game. You have to understand that. You cannot win every trade. And if you close your trades out too early, like let's say in this example, if your original stop loss was $500 and you closed it out at $300, price could have instantly reversed at that point and went back into profit and ended up hitting your take profit and making you money. But you got scared because you're focusing on the money instead of focusing on the trade and the setup itself. A cool little trick that I suggest, and you can do this on TradingView and on TradeAbate, is you can actually switch your open P&L to show ticks instead of dollars. So you can see that you're up 300 ticks versus seeing you're up $50, right? I think that's super good from the mental part of it because it removes the emotional weight. Like you don't even see the dollar amount anymore. So you're not thinking in terms of dollars or anything like that. So that's principle number 2. That's been super helpful for me. Now, principle number 3 is realizing that profitable trading is boring. The example I give is that if you surf, I've surfed one time, almost died, so I don't surf anymore. But I always use this example, but it was, no, when I say I actually almost died, but I don't surf anymore. But if you are a surfer, you know that 90% of your time is spent waiting. 5% of the time is spent surfing. I don't know if you guys ever seen those videos on Instagram where those dudes are just like going through the tunnel on the surf, like they're on their surfboards, you're going through that water tunnel, whatever. Those clips last like 30, 40 seconds or whatever it is. But you don't see them laying on their board for freaking 3 hours waiting for the right wave to show up. That's what trading is. You have to be okay sitting on your hands and doing nothing. Profitable trading is extremely boring. I tell people if you're excited about trading, if you're taking 10 to 15 trades a day, you're most likely unprofitable. You're gambling at that point. If you're excited about trading, it's because it's either you're new, which is fine. I know a lot of you guys are new and you're probably excited about this journey, excited about the opportunity and things like that. But if you've been trading for a month and 2 months and you're just super excited to hop on the charts and all that stuff, like that's a sign that you're not following the system, because after a point you get bored. You get bored because if you're just following the same exact system, doing the same exact thing every single day, that's boring. But that is how you win. That's following the same checklist every day, showing up to the charts at the same time every day, taking the same trades every single day. That's boring. And that's fine. That's what you want. You should be bored when you are trading. That is a good sign that you are profitable or on your way to be profitable. Now, another thing that I see a lot of early beginners say, and this is something that I say as well, or used to say, is I have to make money today. Like, you have to realize if you go on a losing streak, if you lose money, or if you don't see a setup today, that's fine. Trading was here before majority of you guys were even born, and it'll be here tomorrow as well. So you don't have to make money today. You have other opportunities tomorrow, other opportunities next week. Just take your time and realize that sitting on your hands and doing absolutely nothing, being bored, is a great thing. Be okay waiting patiently and only executing when a setup aligns. Bored yet profitable is the goal. Now, something that I used to tell people, well, I tell people a lot, especially like my one-on-one students and stuff like that, is a lot of people get into trading for not just the financial freedom and the location freedom, but also the time freedom, meaning they could do whatever they want whenever they want to do it. But what most traders end up doing is they end up spending all their time sitting in front of the charts, using up their time, not having that time freedom because they want to trade. They're so hyped about trading. But you have to realize that sitting and doing absolutely nothing, going and playing some freaking video games or going in the pool or going for a walk with your kids or your wife, going out to eat with your wife, something like that, that is perfectly fine since you have to wait anyways. We talked about inside the course multiple times about utilizing alerts and things like that, so you don't have to be actively staring at the charts for 300 hours a day. So just be okay with waiting patiently and understanding that that is what you're going to be doing majority of the time. In my inner circle, in the live calls every single morning, majority of the time is us just talking or me answering questions or us joking around and stuff like that. 5% of the time is when we're actually executing the trade, because we have to wait for the trade to show up. When we execute the trade, we're in the trade, then we're back to answering questions, talking about our day, talking about our goals or whatever it is, right? So you just have to realize that 90% of the time or 95% of the time when it comes to trading, you're going to be doing nothing. And that's fine. You should be doing nothing. You shouldn't be trying to make up trades or make up scenarios to just trade because you're bored. Principle number 4 is you need to have a structured routine. So we kind of talked about this already, and we'll go deeper into it as far as having a trading plan and a trade plan. But you need to show up to the markets the same way every single day, meaning you need to treat it like a job. If every single day you go to the markets at different times, like some days you go at 8 a.m., some days you go at 12 p.m., some day you look at the charts at 4 p.m. in the afternoon, whatever it is, that's just going to be extremely inconsistent. You need to trade it. You need to treat trading like a career and a job. So if you're trading at 8 p.m. while you're playing video games or something like that, you have no preparation, you have no plan, you have no structure. How can you expect to have consistency in your results if you don't have consistency in the way that you trade? You cannot. So what you need to do is come to the charts at the same time. You need to warm up, do some back testing first, refresh your charts, mark up your levels, set a bias. Whatever your routine is, have the same exact routine that you do every single morning. Routine builds the systematic mindset that makes consistent profits possible. As I mentioned, you cannot expect consistency in your profits or consistency in your results if you don't have consistency in the way that you are trading. Principle number 5, we talked about it already. You need to understand that losses are part of the math. Losses are part of the game. Even if you have an 80% win rate, that does not mean 8 of your next 10 trades win. It can mean closer to 800 of your next 1,000 trades win, because win rates and probabilities show up at large scale. I'll give you guys a perfect example that I love using. Flipping a coin, you can either land on heads or tails. So you technically have a 50% chance that it's going to land on heads and a 50% chance that it is going to land on tails. But if you take a quarter right now and you flip it 10 times, I can almost guarantee you that it's not going to land on tails 5 times and heads 5 times. It'll probably land on tails 6 times and heads 4 times, or tails 3 times, head 7 times. Like, you're not going to see that 50% win rate until you flip the coin 1,000 times. Then it'll be closer. It's still not going to be 500 times heads and 500 times tails. It'll be closer to maybe like 470 times heads and 530 times tails. It's essentially what I'm getting at is that in order for a win rate to actually show up and be legit, it's not over the course of 10 trades. It's over the course of 100 or 1,000 trades that you actually can realize an 80%, or whatever the win rate states it is, that you actually can see that on your charts. So I say all to say that you cannot go on tilt after one losing trade. And when you go on tilt, that's essentially you chasing to try and make all the money back that you just lost. You need to treat losses as a business expense and understand that they're going to happen no matter what. The setup could be absolutely perfect. The strategy could be perfect. Every single thing could have checked off on the checklist, and you can still lose. That's just part of the game that's going to happen. You have to control the only thing you can. And the only thing you can control is how much you lose when you do actually lose. As I was mentioning, your job is to survive long enough for the percentages to play out, meaning you have to survive long enough to get to 100 trades. You have to survive long enough to get to 1,000 trades to be able to see that 80% win rate. If you're blowing your accounts and all that after 10 trades, you never got to realize your 80% win rate. Now, principle number 6, this is huge. Backtesting is essential. It's not optional. Backtesting is practice. Without it, every live trade is your first time playing the game. I give this example, as you guys can probably tell from this entire course. I love examples. But the example I give is, imagine you are a basketball player that only plays basketball when they have a game. You are going to absolutely suck compared to the person who practices and plays basketball every day, regardless if they have a game or not. Think of backtesting as practice. Think of entering a trade as you have in an NBA game, right? So you need to backtest. It's essential that you backtest. Only practicing the strategy when real money is on the line, that is a no-go. That is how you're going to lose money. 1 to 2 hours of backtesting daily, that helps you build reps and helps you build confidence. If you go on a losing streak, go backtest. If you're not feeling confident about the way that you're trading, go backtest. If you're not sure about something, go backtest. The answer is always to go backtest. As I mentioned, every single time I've ever went on a losing streak, I go and backtest 100 trades. and it rebuilds not just my edge, meaning my strategy, but it rebuilds my confidence in the strategy itself. So if you can allocate 30 minutes minimum, especially as a new trader, 30 minutes minimum, but ideally like an hour to 2 hours every single day back testing, you'll see how drastically not only your confidence in trading gets, but also how confident and how easy it is for you to see your strategies, to see your setups, to understand and use the platforms. It'll just grow so exponentially. Another principle is getting around like-minded people, realizing that trading is a very lonely game. We've talked about this so many times. I've told you guys so many times to send this video to like your spouse or your friends or your family members so they can learn it with you, because trading is it's a very, very lonely game. Not having anybody to talk to it about, not having anybody to bounce ideas off of. I'm not just telling you guys to send this to your friends and stuff like that so I get more views. Obviously, I will get more views, but I'm trying to speak to you guys from the person that wished that they had somebody to talk to before. And this entire course itself just allows for you to realistically share it with somebody else, or allows for you to go on this journey with somebody else so that you don't have to be alone, and you could be around like-minded people that understand what you're trying to learn, understand the goal you're going for, understand even the terminology and everything like that. As I mentioned, trading alone, that means that you're going to be dwelling on losses alone and celebrating wins alone, which is sad. You can get a mentor or join a community. So obviously, like my inner circle is a great community to be in, where you're surrounded by like-minded people and even people that are already at the point that you want to get to. So obviously it just cuts that learning curve down dramatically. And then having accountability partners, sharing your journal with people, sharing your back-tested results with people, that just lets you expedite how fast you're learning and also makes it not seem as lonely as it actually is. So here is the cheat sheet. Here's the 7 principles. Follow the strategy, detach from your money. Profitable trading is boring. Structured routine. Having a structured routine. Losses are math. That's part of the game. You have to backtest daily. Find your tribe. And then essentially realizing that trading is 80% mental, 20% technical. Take this, screenshot it, print it off, do whatever you need to. If you can understand and follow these 7 principles, it will cut down years of the learning curve for you, where you don't focus on the mental part, which, as I've reiterated 300 million times, that's the most important part. And it is the hardest part when it comes to trading. Now that you see exactly how important the mental game of trading is, you see why it was extremely important for me to have a trading psychologist inside of my inner circle. Because honestly, the strategy part is easy. The mental side is what kills 90% of people's dreams when it comes to trading. So having someone you can actually talk to, someone who actually knows trading, someone who knows what you're going through, changes literally everything. Again, if this is something that you actually want to take serious, I'll leave a link for my inner circle in the description of this video. All right, now I want to talk about something that is going to happen, and I wish I was prepared for it when it happened. It would have saved me so much stress and so much money. But we need to talk about, what do you do when you hit a losing streak? Because I promise you, the losing streak is going to happen. Losses are literally part of the game. I love this analogy. I say this analogy all the time with my students and things like that. A coin flip is 50-50. Right now, we know that if you have a penny, you can either land on heads or you can either land on tails. But if you flip a coin right now, I'm 92% sure that you're not going to land on heads 5 times and tails 5 times. Yes, you have a 50-50 chance of landing on either one of those, but you're only going to see that actual 50-50 chance over a long period of time. It's not going to be over 10 flips. It's going to be more so you'll see 50-50 over like 2,000 flips. So what that means is that you can land on tails 9 times in a row. That's completely possible, and it's completely something that does happen. Now, what do we do when that happens? What do we do when our strategy could make us lose 9 times in a row? It's not that your strategy sucks, because that's what I used to think. I would just end up switching my strategy. I would think my strategy was broken. I'd try and go on YouTube and find the latest strategy that is updated to these market conditions. And I would just think that I had to throw that one away and change strategies. But that's not the case. That majority of the time is never the case. We have to realize that losses are part of the game. And we also have to realize that losing streaks are going to happen. It's how we deal with losing streaks that is the important part. So if we're trading the same, Our red streak does not mean our strategy is broken. Now, if you ended up changing your strategy or you ended up breaking your rules and not following your trading plan and things like that, that's something else. But if you were trading the exact same way and your journal proves that you were trading the exact same way as you were before, and now you're having a losing streak, it's just a period in time where you need to do a few things. So the first thing that I like to do whenever I notice I'm on a losing streak is I size down. This sounds counterproductive because most people assume you should size up, meaning you should enter more contracts on your trade so you can make back the losses you had. But you shouldn't. You should actually size down. So if you're normally using 3 contracts, cut it down to 1 contract. Reason being is because the markets could be in a period where your strategy isn't ideal in that market condition. So you don't want to keep using that strategy and continue to lose money or lose a lot of money when you could just cut your contract size down. You can cut the risk amount that you are putting into each trade down. That way you can start realizing, okay, now my trades are starting to win. Now I'm getting back in a winning streak. So now I can bring my contracts back to what they originally were versus continuing to trade with, for the example, 3 contracts or so. It just gives you time to last longer because a lot of times what will end up happening is you'll blow your account during these losing streaks, whether it's a funded account or a live account, and you don't want to do that. You want to be able to last long enough to make your money back from the losing streak. Now, this is something important that I already talked about. I've mentioned this multiple times throughout this video, but you need to be loyal to your strategy. Think of your strategy as your wife of freaking 39 years, specifically 39 years. You cannot have a bad night with her, get in an argument because you left the toilet seat up or whatever the heck people argue about these days, and then just throw it all away, right? And say, there's somebody else out there that would appreciate me freaking keeping the toilet seat up or whatever the heck it is. You need to stick with it. Same thing when it comes to your strategy. If you have a few losses, which is going to happen, you need to stick with it. If you don't, you're going to regret it because you put so much time into learning this strategy. You put so much time into backtesting this strategy, so much time into journaling and enhancing the strategy, going over all the different improvements from your journal results. You put so much work into this strategy. And just because you had a bad week, or it could be a bad 2 weeks, or even sometimes a bad month, you throw it all away. When in reality, it's just a period. That's why it's important also that you journal your trades so you can zoom out and look at the bigger picture. You could have a really bad week, but if you zoom out and look at the month, you're still green. You're still positive on the month. And that is something that is extremely important for you to understand. So honestly, most of the time what people end up doing, they lose 3 trades in a row, then they'll start panicking, they'll blame the strategy, they'll watch a YouTube video, they'll try the new strategy tomorrow, they'll lose again, and they will just continue to repeat this. What I mean by most people is me. That's exactly how I was when I first started off trading. But what I do now is if I lose 3 trades in a row, it varies for me. Sometimes it's 3 or 4 trades in a row. I try and trust the system. I review my journal to make sure that I'm not going crazy. And then I run the same exact strategy tomorrow after I doubled down. Well, not doubled down, but I cut the amount of contracts that I'm using per trade. And I stayed disciplined, realizing that trading is a long game. Trading is not something that we're trying to use to get rich quick. It's a long game, meaning we're going to see profits over a long span of time versus seeing profits every single day. This is another huge one for me because when you have losing streaks, your confidence gets shot. Like you start thinking you're the worst trader in the entire freaking world. You start thinking that you should quit trading. That I've thought about quitting trading 732 times at this point. It might be 733. I don't know. I lost count. But this is a huge confidence booster for me. If I'm having a losing streak, the first thing or the next thing that I'll do is I'll go and actually backtest, because backtesting my strategy helps me realize, dang, this strategy is actually amazing. I'm just having a bad week, or I'm just having a bad 2 weeks, or whatever the period is. So I highly suggest, if you're on a losing streak and you feel like you suck at trading, you feel like your strategy sucks, before you do anything, follow this exact game plan that I give you guys, which is to do all 3 of these things. This is the entire playbook right here. When you notice a streak, you size down, you don't switch strategies, you step away, you don't revenge trade, you go and back test, and you come back tomorrow, same plan, new day. Now, this is obviously closing it out as far as taking a step away and being okay with the loss, being okay with the fact that you're on a losing streak, because if you're not okay with it, you're going to end up revenge trading. And when you end up revenge trading, you end up losing even more money. We've talked about this so much inside of this video already, but it's something that you really need to get hammered inside of your head so that every single time you have a loss or every single time you're on a losing streak, you know, calm down. It's just a streak. Go run this exact playbook right here. If you need to screenshot this and print this out on your wall, do whatever it takes, because losing streaks kill traders' profits. I don't want you guys to have to go through that. That's why I give you guys this playbook. Now, everybody talks about scaling their accounts or trying to figure out how to scale their account. So I wanted to do a deep dive on my plan and what I usually help people do when it comes to scaling their accounts so they can pay themselves and be able to scale to make even more money. Specifically speaking about using prop firms and kind of leveraging those, because we've talked about them inside of this video a few times. And they're honestly just one of the best ways to do it, specifically because most people don't have tens or hundreds of thousands of dollars to start with. So the first thing is, don't try to flip accounts. So the problem is that most people come into trading and they've seen somebody on YouTube flip $100 to $1 million and they think they're going to do that. First of all, that was probably 100% fake. Second of all, even if it wasn't fake, you're not going to do it. I can promise you that. That's like winning the lottery 7 times over. And I don't know, you're just not doing it. The trap that most people fall into is they will make a little bit of money, right? They'll get a little bit of a payout, and then they'll invest either all that payout that they just got into buying more accounts, or they'll invest all of it into paying themselves, let's say paying for some freaking sneakers or taking a girl out or something like that. And then it was all for nothing. There was no scaling there. The key is to scale. Another part of the trap that they fall into is they end up taking bigger risks once they have grown their account, and that causes them to just blow their accounts, and then they start from zero. Now, the best plan of action is to get a payout, pay yourself first, and use the rest of the money to buy more accounts that'll help you scale, and then stack accounts at this point, and then compound it month after month. I'm going to run you guys through kind of how I like to lay it out. So for every payout, split it down the middle, 50-50. So 50% goes to paying yourself. You should always pay yourself. We trade for a reason. There's no reason to be stressed out and broke. So pay yourself, pay for your bills, put it towards your savings. I don't know, college tuition, do whatever the heck you want to do for it. You earned it, you deserved it, you got to this point to get a payout. Now, the next part is how we're scaling. This is how we're going to end up making more money, because we're taking the other 50% and we're using that to buy more prop firm accounts. So every time you pay yourself, you're adding more capital, not just into your bank account to pay for bills, but more capital to invest into buying more accounts, which will in turn make you way more money. I'm going to break this down into a super smooth example. So imagine you had one prop firm account, a 50K account, and you got a 5K payout. Nice. Congratulations. $2,500 of that should go towards your bills or sneakers or just your fun stuff. Pay yourself, right? Well, bills isn't fun stuff, but you guys know what I mean. But then the other $2,500 can buy you 6 more prop firm accounts. You're going to start to see where this gets very fun in a second here. So by the end of month 1, you have an additional $2,500 in your bank account. Plus now you have 7 active funded accounts under your control, because you started with 1, and then half of your payout you used to buy 6 more prop firm accounts. So now you're at 7 total accounts. Now in month 2, with 7 total accounts, you're risking the same amount of money that you were risking on that one account, but you have them all linked together. We talked about inside the prop firm section that you're able to link your accounts together so that when you take a trade on one account, it'll also take it on another account. So you're risking the same amount per trade. You're just risking that amount multiple times, having 7 accounts. So with the 7 accounts in this example, now you made $15,000 total. So you can pay yourself $7,500, and then you can reinvest $7,500 and get 18 new accounts. Now, keep in mind, some prop firms have limits on how many accounts that you can have under them. For example, with the Edge Funder, you can have up to 5 accounts at one time. But what most people do, what I do, is I'll have 5 accounts on the Edge Funder, 5 accounts on another prop firm, 5 accounts on another prop firm, 5 accounts on another prop firm. And I'll just keep leveraging that and maxing that out. So at the end of month 2, you would have paid yourself $7,500 plus the $2,500 you paid yourself last month. And you have 25 active accounts now, and now you're scaling even further. So now with 25 accounts, your payout totals to $40,000. This is where it starts to get fun. You can pay yourself the same 50%, which is $20,000. Now keep in mind, nothing changed. You didn't change your strategy. You didn't risk more. You risked the same amount, and you traded the same exact strategy. The only thing that changed is you have more accounts, meaning more capital under your belt. You pay yourself the $20K, and then you reinvest the additional $20K. Now, I'll be honest. At 25 accounts, I don't think you need more than 25K accounts. You can continue to reinvest and compound, or you can end up doing what I like to do, which is to invest and take some of the money and put it into either a live account to trade with if you want to be able to trade from your live account versus trading funded accounts. It's completely up to you. But if you don't do that, invest into something else, real estate, invest into buying businesses, invest into starting businesses, invest it into other assets, because at this point you are cash flowing, you are making a good amount of money from trading. So now you can diversify it into other things. This is one of the coolest parts when it comes to trading. I feel like a lot of people get into trading and they think that that's the end game. They think that once they start trading, they're not going to want to do anything else. But the cool thing is that you can take your money, and what I've done, I honestly have not taken a salary from trading in like 4 years, no, 3 years. Every single time I make money with trading now, I just put it into an account that I use to buy real estate. I specifically purchase commercial real estate, but I use it to buy real estate for tax advantages, for cash flow, and just wealth preservation. Just holistically, I just like diversifying myself, and then also buying businesses and things like that. Trading is a tool to be able to do other things, to be able to invest into other things. So at this point, I personally would not get more than 25K accounts. That's me personally. And I would pay myself the 20K or whatever percentage at that time I want to live off of. And the rest, I'm putting it towards other investments. So I guess recapping all of this, right? You're going to stack your accounts and you're not going to change your risk. So we've talked about multiple times that you're not switching your strategy at all. You're keeping the same exact strategy. You're trading the exact same way. You're risking the same amount. The only difference is that when you're stacking up, you're having multiple accounts linked to each other or linked to one main account. And what that's doing is that's allowing you to take a trade one time. It's copied across your 25 accounts, and you're 25xing the amount of money that you would have made on just that one account while having the same exact risk amount. That's essentially what we just went over. This is the rules. This is the entire spreadsheet. If you guys want to write this down or take a screenshot of it, this is something that could drastically change the way you trade versus month after month. Every time you get a payout, you just are okay having that one account and you don't reinvest it. You don't think about scaling. You don't, or you think that you can scale in a different way by trying to turn your $100 live account into $500 million because you saw some random dude on Instagram do it that, like I said, did not do it. But yeah, take this. This is what I've done to be able to scale. This is how I help my students scale very fast. This is the exact playbook that we run. And now you guys have it. So take it, run with it, take it slow. As you remember, and if we go all the way back to our the beginning of this sheet, we started off with a $2,500 payout. Like, you don't need to go get a crazy big payout. That's not necessary. You don't need to have a 50K funded account and try and make 10K off of it the first month. If you make 5K off of it the first month, you're good. You can reinvest. Even if you make freaking $3,000 off of it in the first month, you can still take half of that, pay yourself, half of it, buy another account. I mean, buy 3 more accounts, 4 more accounts, depending how much the prop firm accounts are, and just scale. So don't try and hit home runs. Just hit consistent setups, like 5% or $5,000 profit on a 50K account is simply 10% in a month. With day trading, you can very simply hit 10% in a month. So don't try and rush it. Just follow the rules, stay consistent with the way you're trading, just scale, and you'll start seeing how drastically your trading will change, and you'll start seeing your payouts get much larger when you're still doing the same exact thing as before. All right, so we need to talk about the common beginner mistakes. All of you guys watching this video, well, not all of you, maybe like 94.723% of you guys are beginners, and you're gonna make these mistakes. But if you watch this and you listen to me, you can avoid them. It's gonna be 8 things that kill most new traders. If you avoid these, you're ahead of honestly 90% of the people that don't take action or don't succeed when it comes to trading. So the first mistake people make, and I've talked about this so many times, and it might be because it might just hit so close to home for me because this is something that I did for so long, but it's strategy hopping. Like, you'll lose 3 trades, you'll panic, you'll abandon the strategy, you'll watch a YouTube video, try the new one tomorrow, then you'll repeat that forever and never truly mastering one strategy. I've made this analogy so many times, but imagine you're a basketball player, right? You got really good at basketball. You dedicated your entire high school and college life to basketball, right? You had 3 bad games in a row, 0 points. You shot 30 shots, missed all of them. You suck. So you switch. You're like, instead of thinking, oh, this is just like a phase, I need to get my mental right, I need to get back in the gym or something like that. You're like, you know what? Basketball isn't for me. Let's go try and play golf. You spend 3 hours a day. You pay $20 million for a tutor. You dedicate the next 4 years of your life to golf. You have 4 bad games in a row. You quit. You're like, golf ain't for me, honestly. Like, it's just not for me. Instead of going back to the driving range and trying to fix it or something like that, you quit. And you're like, okay, badminton it is. And you keep doing that. You're wasting all the time, all the effort that you put into learning that previous sport, and then trying to restart and learn a completely new sport when the whole time it was just a bad period. You could have just broken up with your girlfriend and your game was off. You could have, I don't know, been sick the day before. It could be literally anything, and your game was off, but you decided to completely switch the sport you're in. Now, take that analogy when it comes to strategies. A lot of times people will just have a bad week. They'll have a semi-bad month, and they're like, the strategy is garbage. I need to switch. When in reality, you need to just stick to one strategy. Stick to it for at least 100 trades before you start judging it. Master that one before you decide to consider any other one. And if you are on a losing streak, we talked about this earlier, but if you are on a losing streak, look and make sure that you actually are, first of all, are following the strategy, but also make sure that check to see what little tweaks you can make to that strategy to help it better adapt to the current market conditions, because market conditions can change the profitability of a strategy. For instance, trending markets where the market is just continuously trending to the upside, those are going to be great for like breakout traders. When markets is consolidating, it's going to be great for like support or resistance traders. So if you're a breakout trader, when it's consolidating, you need to adjust, right? You don't need to switch your strategies, just adjust slightly, whether that be adding one extra step to the checklist to make sure that you're not getting faked out, or waiting an additional candlestick just to validate your entry a little bit further. Just look for ways to improve your strategy to work in those current market conditions versus stopping and trying to learn a whole new strategy. That's mistake 1. Mistake number 2 is over leveraging. Most people, they try and make $5,000 on a $1,000 account. We just talked about this. Trying to over leverage, trying to flip accounts, it just does not work. You end up sizing up and over leveraging to try and speed up the process, but it makes the process take way longer than it would if you were just being consistent. Like, one bad trade can wipe all of your profits out. And trust me, I've heard this so many times. People would have a great week. They made 5K on the week. Then the next week they lost 10K. You need to stop over leveraging even when you get cocky, even when you're on a winning streak. That's not an excuse to over leverage and start risking more per trade. The fix is to trade small enough that any single loss is forgettable. Your edge needs hundreds of trades to play out, not 5. You cannot assume that every single trade will hit. You also cannot assume that you won't go on a losing streak. So that's why risk management is so important and why we've talked on it so much during this entire video. So keep your losses manageable. Mistake number 3 is you have no game plan per trade. So we talked about this when creating a trading plan and having a plan for each trade. But you need to not be the person that just enters a trade haphazardly. You have no plan, you have no reason, you have no target, you have no stop loss. Because at that point, once you're in the trade, you're just going to end up making emotional decisions, and emotional decisions are the worst decisions you can make when you're trading. You need to have a set game plan before you enter every single trade, meaning know exactly where you're going to enter, know exactly where your stop loss is going to be, know exactly where your take profit and your target is going to be. Also, know exactly when you're able to walk away, meaning, okay, if it doesn't hit your full take profit, but it hit halfway towards your take profit, is that something that you're okay taking? You should have that already sorted out and already written down and thought out before you're even in the trade, because you don't want to get to the point where you're in the trade, markets go against you just a little bit, you get scared and you exit the trade only to see and realize that it was just a small pullback and you would have hit full take profit and made way more money. So make sure you have a game plan for every single trade that you take. Another mistake that a lot of traders make, new traders specifically, is sitting there and watching the charts. I don't think you realize, but I'm telling you right now, and please believe me, that no matter how hard you stare at the charts, you can't change nothing. The charts is going to do whatever the heck they want to do. The candlesticks are going to move wherever the heck they want to move, when you're there or when you're not. The only thing that sitting there and watching the chart does is give you anxiety and make you emotional, make you probably take bad decisions or probably make bad decisions. You're just staring at your chart and torturing yourself. The fix is to set alerts, use the alerts. We've talked about alerts so many times in this, and walk away. Let the trade play out exactly how you planned it, whether that's it hitting your stop loss or it hitting your take profit. We've talked about so many times that having the risk amount enough or small enough where it does not make or break you, that's the key to this. That's how you can walk away and be okay with the price hitting your stop loss or price hitting your take profit. That's the point of this. We should not be sitting here watching our charts. It only makes you worse. Mistake number 5, which is huge. I'm going to be honest. A lot of people ask me all the time, what was that turning point for me when I went from like not being able to make profits trading to then being consistent with my trading? And that turning point is when I started actually prioritizing journaling. Like, I would watch YouTube videos all the time. I had every course in the world and they all mentioned journaling, and I always just ignored them because I'm like, what the heck am I going to be writing down this stuff for? But you have to realize that trading is about data. It's about patterns, first of all. And we can only see and recognize patterns when we have the data to remember them. Like right now, when you start trading, if you haven't started trading already, you might remember all the trades you took today or yesterday or a week ago, maybe 2 weeks ago. But you're not going to remember all the trades you took a month ago, 2 months ago, 4 months ago, a year ago. And that's all important data. That's all lessons that you learned. And if you're not journaling that, you're missing out on all those lessons by just trying to rely on what you remember inside of your head. Now, journaling is one part of it. You also need to go back and read your journal. We talked about it in the whole journaling aspect. You guys remember that. If you need a refresher, go watch it back again. It is extremely important to journal and learn from your journal. That way you can become a better trader. Now, the problem here is that most people take 50 trades. They lose money. They have no idea why. They have no data on what works. They have no data on what doesn't work. They have no data on what they're doing wrong. That's a huge issue. That's a huge problem. That's why journaling is so important. You have to journal every single trade, take screenshots of the trade, take notes, write down what worked, what didn't work, and then review it weekly. Because as I mentioned, data beats memory every single time, and having proof of something will help you become or be able to make better decisions in the future. This one is huge. So I'm not going to lie. I used to trade the news. Trading the news is like gambling, right? It's assuming that price will do something or have a huge push in your direction and trying to make money quick. It kind of, I guess it tickles that get rich quick kind of feeling that a lot of people want to have when it comes to trading. But if you're going to trade the news, at least have a plan put in place, meaning have a stop loss, have some type of idea of if it isn't going in your direction, what is the plan, right? If it is going in your direction as well, what is the plan? Some people will try and hold it for the entire day, thinking that the news event is going to continue to make it go in that direction for the entire day. It's not at all. news candlesticks can go up. You can be in a whole lot of profit and then completely reverse and you could be negative. So you need to have a plan if you are trading the news. I personally don't suggest trading the news, if I'm being honest. But if you are going to, the bare minimum is at least having a plan. This is for all the overly confident traders. A lot of mistakes that I see with traders when they go on a winning streak, when they get overly confident, they start thinking they're the next freaking Warren Buffett. They get cocky and then they double the size of their contracts the next trade. And that causes them to do one of two things. It causes them to either make a lot of money, right? Because they doubled the size. And now they had a positive reinforcement on a bad action. And that will only lead to even more bad decisions being made. Or they doubled their size and they lost all the profit that they just made, plus more. It's never logical to increase your risk after a win or after a winning streak. The whole thing when it comes to trading is being consistent in the way you trade and being consistent in following your rules and your trading plan. And that means following the same risk parameters, regardless of how good you feel about that trade, how good you feel about your performance for the past few trades. All of that doesn't matter. Stay consistent with the way that you trade, because when you do end up trying to increase your risk after you get cocky, it's going to bite you in the butt. I can assure you this has happened so many times to me, and it happens to my students all the time. You have to risk the same amount every single trade. It does not matter until you've decided to change your trading plan and you've proven that you can handle more of a risk. And then you adjust how much you're risking. You can increase how much you're risking per trade. But personally, I still never really suggest for anybody to double the amount they're making in one jump. Let's say before you're risking $1,000 per trade. Don't go to $2,000 per trade. Go to maybe $1,200 or $1,300 per trade, because you've proven to yourself you can handle $1,000 per trade. So yeah, keep that in mind. Now, mistake number 8 is revenge trading after a loss. So there's a lot of people suffer from revenge trading because they'll take a loss, they'll get angry that they lost, and then they'll immediately try and jump back into the trade to make it back. In the essence of that, you're forcing a setup because you're spiraling out of control. When you force setups, you're not following your trading plan, you're not following a strategy, you're not following your risk management. That's a huge problem. I've seen so many traders, like, there was an example. I'll give you guys a story. I'm not going to name who it was. One of my students, he had a lot of money. I forgot what he did for a living, but he had a lot of money. He had 80K inside of his live account. This is live money. He was traveling. He took a trade. The Wi-Fi wasn't good. When he closed the trade out, it was much more of a larger loss than he had planned. I think maybe he wanted to lose like 2K or something like that. And he had lost 7K, right? That's his hypothetical numbers. I don't remember the amount he actually lost. And he tried to revenge trade to make back the 7K instantly. And what he ended up doing is within the next, I think, an hour or 2 hours, he blew the entirety of his account, meaning the 80K was entirely gone because he was revenge trading because he couldn't take that loss to the chin. Now, granted, obviously, it was like a Wi-Fi issue, or so he says. It was a Wi-Fi issue that caused him to lose more than he was supposed to. And that's what, I guess, tipped him over the edge to try and make his money back. But I've heard so many stories of that when it's a regular loss and people was just like, okay, let me just try and make some money back and try and crawl their way back. And that just always causes people to lose money. Revenge trading is a huge, huge, huge problem. One of the best things, if you understand and know for yourself that you have an issue with revenge trading, put in your trading plan, every time you close out a trade, whether it's for a loss or a win, you have to set a timer for 30 minutes before you hop into another trade. That's something that I've been able to help a lot of my students out in the inner circle with, kind of setting that in place to make sure that you're stopping yourself, you're forcing yourself to not be able to revenge trade. Here, like I said, I put for the fix that after a loss, walk away for at least 15 minutes, breathe, come back only if there's a real setup. The market always gives more setups. And understanding that day after day, the market is going to give opportunities. You don't have to make your money back today. Tomorrow is going to come, right? But yeah, absolutely a brutal mistake that I see a lot of new traders make, unfortunately. And it has caused so many people to lose so much more money than they're supposed to. So here's a recap of the 8 mistakes. If you want to get this freaking tatted on your forehead, I promise you it'll help you. I'm not saying actually get it tatted on your forehead, but like print it out or something, take a screenshot of it. This is 8 things that you have to avoid. If you can avoid them, you are off to a very, 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 very good start. No strategy hopping, no over leveraging. Make sure you have a game plan for every single trade. Don't sit there and watch the charts every single freaking day. Make sure you are journaling. Make sure you always have a plan if you're gonna trade the news. Never increase your risk after a win, and don't ever allow yourself to revenge trade. If you can follow those, you'll dodge majority of the issues that most new traders run into. You may think that the daily routine of a highly profitable trader involves waking up super early, checking multiple different monitors, being glued to your screen 24 hours a day. But the truth is, this isn't necessary at all. Personally, I only trade about 30 or 45 minutes a day, and then I spend the rest of my time enjoying my life with my wife and my 2 kids. And while doing that, I'm still able to make over 4 to 5 figures every single month with trading. Now look, it's very important that you understand that it took me over 3 years of trial and error to get to this point. So don't think that trading is a get rich quick thing. But over my career, I've developed a routine that sets me up for success in the markets every single day. And if I had started following this same exact routine much earlier, it would have allowed me to avoid so many losses. So in this video, I'm going to break down the exact step-by-step routine that I have from the moment I wake up to how I set up my charts, to the specific setup that I look for, how I manage my capital, and how I'm able to trade for 30 minutes a day. So get ready and let's jump into it. So it's very important how I start my days. I do have a morning routine. I'm not like Ashton Hall. I don't do a freaking ice bath in my face and all that weirdness. I literally wake up at 5:30 every single morning, and I start my day off with prayer, reading my Bible, and meditating. So from about 5:30 to about 6:20, that's all I'm doing. I don't have any phones. I actually don't even look at my phone until after I finish my time with God, because I just want to focus on that, and that's my #1 priority. But then once that's done, I go and work out. I work out usually from around 6:20 to about 7:40. I try and get an hour in, and then I have to have a little bit of time to shower as well. But that's a huge part of my success. I credit a lot of my success to working out, because the discipline that you have to consistently work out every single day is unmatched. Working out for me is a huge non-negotiable, especially if I'm just trying to have a very productive day. Because once I work out, I feel like I've already been productive, and that just follows me throughout the day. It also wakes me up. I'm not an early person at all. I wake up early because I have to, and I like having time by myself before my wife and my kids wake up. But with waking up early, I can be pretty groggy sometimes. So working out kind of refreshes me. It kind of wakes me up so that I can be in the right headspace when I'm getting ready to go to the charts. Now, speaking of getting ready to go to the charts, we're about to hop onto the charts. I'm going to show you guys exactly how I mark up my charts, how I know what I should be looking for, whether it's buys or sells, how I know what tickers to be looking at. But one important thing that I do before I actually start trading that I've never seen any other trader talk about, but I've mentioned it a lot of times, is that before I actually start trading, I backtest. Now, the reason that I backtest is I think of it like a sport. So you just wouldn't go hop into a basketball game and start playing, right? You always warm up first. If you've ever went to a basketball game, if you ever went to a football game, they are warming up before the game actually starts. I don't know why people don't think to do that before they hop into trading. That can be super fast paced, something that they can have a lot of money on the line. I don't think you should just hop on the charts and start taking trades. I go and I backtest for about 15 minutes because I usually start my backtest around 7:45 in the morning. Keep in mind, this is all Central Standard Time because I live in Texas. So I have about 15 minutes of backtesting before I actually start actively trading at around 8 o'clock. And I think it's extremely important for anybody that's trying to take trading serious to implement some sort of practice before they actually hop onto the charts. And backtesting is the best way to do it. It gets your mind ready. It gets you used to seeing those support or resistance zones. It gets you used to finding your entries. It gets you used to finding your trend lines. It just gets you used to seeing the trades happen before you actually hop onto the charts. Now, speaking of charts, let's hop into my charts right now. I'm going to walk you guys through exactly my thought process, what I look for, how I act right after I finish my back testing. Because I back test, like I said, for about 15 minutes, I start looking at my charts and start looking for trades starting from 8 a.m. Central Standard Time. Let's hop into my charts. All right, so here we are on my charts. I'm gonna walk you guys through my exact thought process. We're actually gonna go over a trade that I took this morning live inside of my inner circle as well. Let's take, for example, YM here. I told you guys I get to my charts roughly around 8 o'clock. So I replayed back to 8 o'clock today. As you see, this is the 7 o'clock candlestick that's about to change into the 8 o'clock candlestick. But the first thing I'm doing, I'm zooming out and I'm looking at the overall trend. I want to know, okay, what direction has price been going in and what direction do I think price will go in today? So overall, we can see we've been selling down. So I'm leaning more towards sells. I'd be looking for more so sell opportunities because the market has been trending to the downside. But then also I have to realize that I did see price make this huge bullish move to the upside here. Really 2 days ago. So I do have to realize that we've broken some highs. So in my mind, I'm thinking, okay, cool. We're in a downtrend. I am leaning towards sells a little bit, but because we had this huge bullish candlestick, I'm okay taking buys if a buy opportunity presents itself, but I'm still more bearish bias. That's what I think about. A lot of people have to realize that you can't just look at what price action is doing. You have to look at why price action is doing what it's doing. Now, this has been in a downtrend, but when it gets to a certain point, I could look at this and be like, okay, it's at this low right here. Is this low a major low that it's changed directions at before? Meaning, if price is selling down, right, and we're in a huge downtrend, and then we got to a point here, and then price started going up, was this just a random area that price started going up at? Because if it's just a random area, it could be caused by news, which this candlestick was caused by news. It was caused by a tweet that the president had put out. But is it caused by news, or is this the same area where price had bought off of really drastically before? If it's an area where price has bought up really drastically before, then this could actually signify that we're not going to be in a downtrend anymore. We're actually going to continue in an uptrend off the same area that prices continued off an uptrend of before. We have to understand why price is doing things. We can't just look at what price is doing. We have to understand the full story. So when I saw this huge move, obviously I'm like, okay, like I mentioned, I'm looking for sells ultimately, but I won't ignore buys because we have had this huge move to the upside. But I'm also thinking in my head, this is not a real candlestick. This is a candlestick that was caused by a news event. This is not based off of price action. But with all that being said, I look at the previous day. The previous day was chopping to the upside, but it did fail to break this high that was created by that news candlestick. So once I kind of have this thought process in my mind, and I've been doing this for over 8 years now, so all this, I kind of do this automatically, and I'm doing this every single morning. Like no matter if I did this whole thought process today, I'm still gonna do the same exact thought process tomorrow to see, okay, am I looking for buys or I'm looking for sells? Because we always wanna trade in the direction that the market is going. We don't ever wanna trade against the trend because that's how you lose money. But once I've kind of solidified all that, I'm then looking at my charts to try and find my support and my resistance zones. Most of the time, my main strategy, my foundation for every single day is based off support and resistance. And how I find those is I either go on the 4-hour time frame or I go on the 1-hour time frame, and I'm just marking off different pivotal points. So in this example, I'm going to mark off this high that was created here. I always draw my zones from the highest wick to the lowest body, and I drag it across. I'm also seeing that we have another zone right here. We have a low created right here. This is all on the 4-hour time frame. Once I have all these areas drawn out, then I'm going out to the 1-hour time frame. The 1-hour time frame is then where I start looking for other zones. So we see price sold down here as price was selling down, right? We see some highs that was created as it was going up. So these are just areas that I'd pay attention to. Maybe I'd mark off this area right here because we could potentially get a break and retest because price is broken above here. So price could sell back down here and bounce off of this zone right here. But remember, I'm still leaning bearish bias, meaning I'm leaning towards sells. I'm assuming that we're actually going to continue in sells. So I'm really only going to pay more attention to the sell opportunity. The sell opportunity for me would be, if we remove this, would be price selling off of here. So what I usually do, I have a game plan because I usually don't like taking any trades until after about 8:30. So I'd have a game plan saying, okay, I want price to continue in this zone here. Then after market open happens, which happens at 8:30 Central Standard Time, I want price to show me that it's going to sell off of here. If it shows me that, I'm going to enter into the trade. If it doesn't give me that opportunity, I'd have another plan that's like, okay, if it doesn't sell off, if price breaks above here, then comes back down to retest this same area, I'd look for buys off of this zone based off of a break and retest. If price doesn't do any of that and it just sells down without giving me any type of entry criteria where I can enter into sales, I'd look for price to tap into these lows, and then I'd look for entry criteria for buys off of this area. So I'm always planning out every single one of my trades, regardless if they happen or not. I want to know exactly what I'm looking for. I want to know, okay, I'm looking for sells here. If it gives sell opportunities, I will enter it. What happens if it buys above here? If it buys above here, I'm going to look for break and retest. What happens if it sells down here and I don't get any type of entry confirmation to enter for sells? If it sells down here, I can take buys off these areas. I'm planning all this out, and this is what allows me to have my 30-minute work days, because once I have this planned out, I use this cool feature that TradingView has called alerts. So I know that in all of this area right here, if price chills in this area, I'm not doing nothing. The only time I'm acting is if price gives me a sell opportunity here, or if price taps into this zone and gives me a buy opportunity, or if price buys above here and gives me a buying opportunity. So what I'm doing, because all of this is noise, I'm setting alerts right above my zone here. So you can click this plus button on the side, you'll see it, or you can right click on your screen and press add alert, and that will add alert on here. It's not gonna let me do it right now because I'm in the replay feature since I'm showing you guys this. You right click on here and you'll see over here add alert button. You'll press that and it would alert you as soon as price taps into here. So most of the time, this is how I set up my charts. I set my alerts, I walk away. I don't have anything to do. If I'm here chilling on my live calls that I do with the inner circle every single morning, that's one thing. But if I'm just not on my inner circle call or whatever, I'm probably doing some other work, or I'm out hanging with my family, or I'm eating breakfast until any of these alerts go off. I'd set an alert here and I'd set an alert here. Since price is already in this zone, I don't have to set an alert because I'd be watching it at market open to see if it gives an entry or not. But that's essentially how I set up my charts. And then it's just a waiting game. You have to realize that, and it took me a long time to realize that trading is majority of the time waiting. It's majority of the time sitting on your hands, waiting for price to do any of these plans that you assume price would do. I'm waiting for it to give me sell opportunities. I'm waiting for it to buy off this zone here. I'm waiting for it to buy off this zone here. But let's say, okay, cool. My alert went off. Now it's time for me to act. Let's say in this example, because this is the actual example that we took this morning in the inner circle, price gave us a sell opportunity off of here. So how am I entering my trades? Good question. I'm going down to my 1 minute time frame. Once price has tapped into my zone and it's after market open, right now this is at about 8 or 7:59. So let's fast forward here until after market open happens, which is at 8:30 Central Standard Time. This is 8:27. Let's fast forward some. Once 8:30 happens, game mode. This is when I'm looking for actual entries. I want to see what price is doing at market open to see if it's still respecting my zone, whether I'm getting price action showing me it wants to go to the downside, or if price just buys up here, breaks outside of here, and is looking to give us that break and retest that I planned for before. At this point, like I said, I'm just waiting. I'm waiting to see which opportunity the markets give me. But here, right at 8:30, we ended up buying up. If we fast forward a little bit, we see price actually ended up consolidating a little bit inside of this zone. So when I see consolidation inside of a zone, if you've watched any of my other videos, my exact entry criteria is when price is in my zone and it breaks a recent low or breaks a recent high. Now, what does that look like? Let's say this is my support zone right here and price is trending to the downside into my zone, right? I want to see price not just tap into my zone, but then break above a recent high. Let's see, for example, this is the recent high. As soon as it breaks above that recent high, it's telling me that it's no longer in this downtrend anymore. It's now creating a higher high, which gives me the confidence to enter the trade as soon as it breaks above that high. I put my stop loss below the most recent swing low, and I'm targeting just recent high points or recent low points if I entered for a sell. But this is exactly what I'm looking for. And guess what happened here? So we see price was trending into our zone, making these higher highs and these higher lows into our zone here. Price bought up. We then create a new higher low right here. Then price bought up. So we have all these different lows created, right? We have this low, we have this low, we have this low. But the most recent low is right here. I'm looking for a break of that most recent low to then signify that price is respecting this zone. So once I see that price is creating these lows, I'm getting ready for an entry because it looks like it's going to sell down to break this recent low. I'd enter as soon as price broke above it. I put my stop loss right above the most recent swing high, which is just right here. And then I'm targeting recent swing lows. So for this trade, we ended up targeting right down here in this area for about a 2.5 to 1 risk to reward ratio. So here is price about to tap me into the trade right now. You see, as soon as price broke below here, I entered myself into the trade, and automatically I already know that my take profit is down here, my stop loss is up here. So if you guys remember, when I'm setting up my zones, I use alerts to notify me what's going on the charts without me having to look. I'm doing the same exact thing when I'm in my trade. I don't sit here and watch my trades happen. I have no reason to, because my trading plan says that I don't touch my trade. If it enters me into a trade, I'm not moving my stop loss up. I'm not moving my stop loss down. I'm not moving my take profit. I don't do that. I stay very, I guess, vanilla with my trades. If it hits TP, it hits TP. If it hits stop loss, it hits stop loss. That's just how I personally trade majority of the time. I don't do trailing. I don't do closing partial positions out. I don't really do any of that most of the time. So what I do is as soon as it enters me into the trade, I'll set an alert at my stop loss and I'll set an alert on my take profit. That way I'm notified if the trade hits my stop loss or if it hits my take profit. And I most of the time just walk away. And we can fast forward this. This trade did end up hitting full take profit in a matter of, enter me into the trade right here. So I ended up hitting full take profit here in about 10 minutes. Now this routine that I've created has been consistent for years. It's what's allowed me to see consistency inside my trading. A lot of people want to be consistently profitable, but the way that they trade is extremely inconsistent. One day they're trading this strategy. One day they're showing up the charts at 9 o'clock and the other day they're showing up at 10 o'clock. Like, you need consistency in the way that you trade to see consistency in your trading results. Now, the trade hit, obviously. The trade won. I ended up making about $20,000 on this trade specifically, but that's not the end of it. There's something very important that I do after each and every trade, and that is I journal my trade. Trading is all about patterns. It's all about data. And in order for us to see the data and see the patterns and be able to learn from the data and the patterns, we have to track it. I guarantee you right now, you probably remember your trade you took yesterday or the day before that or a week before that. But I guarantee you, you don't remember the trade that you took a month ago. Meaning all that data, all those trades you took a month ago, 2 months ago, 3 months ago, a year ago, you have no data on it, meaning you cannot learn from it. That's why it's very important that you actually journal each and every trade that you take. And the things that I journal when I take a trade, I'm looking at, okay, what ticker did I trade? In this example, I traded YM. Did I enter for a sell or for a buy? I entered for a sell. What was the amount of money that I risked? On this trade, I'd risked around $7,000. So I'm writing down how much I risked on the trade. How much did I profit on the trade? I'm writing down that I profited about $20,000 on the trade. I'm also writing down what strategy I used. In this example, I use support or resistance. I'm also going to write down why I think I won or why I think I lost the trade, depending if I won or lost the trade. What I wrote down inside my journal for this is I won the trade because I waited for price to show me the actual direction it was going in. It was inside of a resistance zone. Markets have been in a really strong downtrend. It gave me the sign that it wanted to continue in a downtrend, and I was able to capitalize on it. So I'd write down something small like that. It doesn't have to be a long paragraph. Just a reasoning for why you believe you won or why you believe you lost each trade. Look, we've just went over my exact routine that allows me to be able to sit at my desk for maybe an hour a day and then completely walk away from the charts and still pocket 5 to 6 figures a month. You know how I set up my charts, you know how I use alerts, you know when I enter trades, how I know if I should enter for a buy or sell, how I manage my trades. You know absolutely everything about my routine. Now, believe me when I tell you that this routine is way easier to stick to when somebody else is doing it with you. I've reminded you guys so many times to share this video with a friend or a family member, and it's not just to get me shares. Obviously, you share the video, I get more views and things like that, but I'm actually being honest. Like, if you have somebody else to learn this with and go through this with, it's much easier to get good at trading. It's much less lonely. It's much much more fun because you guys can back test together. You guys can learn the strategies together. You guys can learn from each other. It's just way better to have somebody else to do it with you. So if you haven't yet, share this video with a friend or a family member or a group of people where you guys can all lock in on trading together, hold each other accountable so you guys can actually stay disciplined. This is something that I wish I could teleport back in time and tell myself to do, and kind of not force, but force one of my either siblings or one of my friends or family members to learn it with me. That way the journey would have been a lot less, what is the word? Lonely? Not lonely, painful, sad, depressing. Either way, it would have been a lot more fun. Anyways, send this video to somebody that will hold you accountable and somebody that you want to hold accountable to changing their life with day trading. All right, so we went over the mistakes. Now I want to give you guys the 9-point daily checklist that I share with all of my really one-on-one students. That just if you print this out, this will drastically help you out, and just kind of follow this order, turn it into more so of a routine. I gave you guys my routine that I follow, but if you can turn this into your own routine, you'll be pretty set. So the first thing is wake up at the same time every day. I found this to be super efficient because if you're waking up at random times throughout the day, your mind will be at random, will feel random every single day. Meaning, like, I know for myself, if I wake up at 5 a.m., my mind's going to be at like this level of competence. If I wake up at freaking 3 a.m., it's going to be at this level of competence. If I wake up at 9 a.m., it's going to be at this level of competence. Whatever it is for you, right? I've just noticed that having consistency in when I wake up allows my mind to, or it's not even that my mind operates at the best level when I wake up at the same time. It's just a predictable level. Like, I know how I feel when I wake up every single day at the same time versus if it's versus if I'm just waking up at random times, right? So yeah, do that. Step 2, indulge in trading content for at least 2 hours a day. This is something you can do. You don't have to do this before you actually start trading, but you should be indulging in learning each and every day. Like, you have to put time into sharpening your skills. That doesn't mean that every video you watch, you're going to take that on. That doesn't mean if you watch a new strategy video that you're going to switch strategies and go to that. It's just about seeing different perspectives and maybe taking other information to add as extra confluences for what you're currently doing. So make sure you are indulging in trading content and consuming trading content as frequently as possible. The next thing, which is something that a lot of people sleep on, and I talked about it inside of my routine, is backtest before you trade every single morning. This is something that I don't know why so many people don't understand. Like, imagine you're a basketball player and every single time you go play in a game, you just go straight from the locker room onto the court and start playing. No, you have to go practice beforehand. Same thing when it comes to trading. Backtest a few minutes every single day before you start trading, just to warm your mind up, just to get used to, I'm saying warm your mind up like it's a freaking car. But just to warm your mind up and get familiar with where the charts is at or how you're supposed to trade, going over your checklist, going over your strategy so you have no hiccups when the markets actually start. Step 4 is to refresh your charts every morning. This is great for new traders. If you're more experienced, you don't necessarily have to do this. What I mean by refresh your charts every morning is redraw your support and resistance zones, redraw your trend lines, redraw your setups every single day, because the more reps you have on drawing your support and resistance zones, the more reps you have on drawing trend lines or all these different things, the better you're going to get at it and the faster you're going to be able to spot those things. So take the opportunity every day, even if you're just deleting them on the chart, freaking refreshing your browser, spinning around in a circle, and then redrawing the charts, redrawing your zones again, or whatever it is that you're drawing on your chart. Just take the opportunity to practice each and every day. Step 5 is to have a specific game plan for every single trade before you enter. We already talked about that multiple times, but that's something you need to really focus on. Making sure you have a dialed kind of plan of action before you even press that buy button or that sell button. 6th step is to enter the trade and leave. Utilize alerts, don't watch them. I promise trading is so much less stressful when you're freaking swimming, or so much more stressful when you're in the trade and you're playing video games or something like that. Like where you're not sitting there looking at the charts. Just enter your trade, let it rock, go play with your kids, go hug your wife or your husband, whoever it is for you. Go I don't know, don't just do anything but look at the charts. The seventh step is to journal every single trade. You don't want to skip that. That's extremely important because you need the data, as we talked about so many times. And then obviously reviewing your journal at least once a week. I usually do it on either Fridays or Saturdays. That way I can recap what I did during the week and plan for what I might want to change or plan for what I'd want to look out for on the next week. Also track your psychology. Know what kind of trader you are. Know your weak points. Know if you're someone who struggles with revenge trading, with over leveraging, with being overly confident or not being confident enough. Just know who you are, track your psychology, learn that mental part of yourself and how you are as a trader so that you can combat that and you can know the red flags to look out for so you don't continue to make the same exact mistakes. If you know that you're the type of person that continues to switch strategies, like set some type of structure around it, whether it's a training plan and adding that consequence like we talked about, or something else that just forces you to only focus on that strategy, whether it's like never being able to watch any strategy videos so you don't get any new ideas. You just have to learn yourself and learn what you can do to stop those red flags that you have when you actually are trading. But that is my 9-step daily checklist to make sure that you read over. You can screenshot this, like I said, get it tatted on your, I don't know, the back of your hand so you can watch it, or you can paste it on your screen. What I used to do is I had my trading plan written down on like a sticky note and I had it taped on my monitor. So I had to read through it every single morning, similar to how we already talked about when it came to creating your trading plan. But yeah, this is another great one to add to the arsenal. Now, a lot of you guys might ask, what does your routine have to be a consistently profitable trader? I'm going to dive into what my exact routine is so that you can follow my routine, follow exactly how I go about my mornings to get ready to start milking the markets, as we just said. Because honestly, winning trades are born in the charts, but profitable traders are made in their daily routines, and I will stick by this. I promise you that. So realistically, I start every day, and I kind of mentioned this before, and this is how I personally start my day and how I've done it for the past more than I've been trading. So probably like 10, 12 years now. I start every day with praying, meditating, and reading my Bible. It just gets me in a nice, calm mind space and headspace, realizing that money, trading is not the end goal. That's not all that life is. Life is so much bigger. And that just helps me put into perspective and not be too attached to trading or too attached to the trades or the outcome of the trade, knowing that there's so much more to life. It really keeps me focused. It keeps me calm on, like I said, the things that truly matter. Once I do that, I'll go to the charts and I'll see what the market has done while I was sleeping. Once I see what the market has done while I was sleeping, I'll start drawing my major areas of interest zones, starting from my higher time frames and working myself down. How I showed you guys, I'll draw my zones on the 4-hour time frame or on the hourly time frame. I'm basically making my plan for the day. What do I want price to do? Do I want price to tap into this resistance zone up here? Do I want price to tap into the support zone right here? If it does, what am I looking for? Just things like that. And then honestly, I walk away from the charts and wait for my alerts to go off. I try and trade very passively. I don't want to sit here in front of my computer for hours out of the day. I got into trading to get not just financial freedom, but also location and time freedom. I have a wife, I have a daughter, I have a son that by the time this video comes out will be here. So I have a life. I don't want to sit here in front of the charts, and that's why I utilize my alerts. Now, it's important to understand that successful trading is a marathon. It is not a sprint. You need to have emotional regulation and stay calm under pressure, which is what I've talked about multiple times. You need to be a continuous learner. You need to study market trends, and you need to refine your strategy accordingly. And you need to have the discipline to stick to your trading plan, even when it is very tempting to deviate. Because trust me, there will be times in the market, multiple times in the market, where you truly just want to take that trade, or you truly just want to deviate from the plan that you have. But trust me, it might work out this one time, but over 10 times, it will not work out. And you do not want to get in the habit of continuously setting yourself back from being a consistently profitable trader. All right, so we went over the daily checklist. Now I want to give you guys the secrets, man, my core principles. This is like the foundation of what my trading is built off. This is like the foundation of how I trade, my mentality when it comes to trading, just overall. These are 7 principles that I think you all should implement into your trading, really into your mindset when it comes to trading. Yeah, let's get into the first one. So the first one is to follow your strategy, not your emotions. Your strategy was built when your head was clear. You've tested this thing. You've back tested it. You have journaled and data on this. When you're in the middle of your trade, your emotions are the worst person to take advice from. You are not smart when you're in a trade. You start being emotional, irrational. You just start doing stupid things. So always remember and recite this back in your head on repeat. Follow the strategy, not your emotions. The strategy, not your emotions. The strategy and not the emotions. Just follow it and execute on it. That is going to make trading a lot less stressful. Now, this is something huge for me. I had to detach from money, meaning I had to stop looking at trading as a way to make money. I had to look at it more so like a system that I was following, and then the money that I was making was my reward for following that system. The issue with attaching trading to money is it adds an additional layer of pressure on you. Because every trade you look at, you're looking at, okay, what can I buy if this trade wins? Or what can I not afford to pay if this trade loses? You need to just trade, like I said before, following your setup, following your strategy, following your plan, and letting the money be the reward for doing that over a consistent period of time. You need to stop watching the dollar P&L. There's actually something you can do in the settings on Tradeovate and TradingView where you're actually able to turn off the like when you're in the trade and it shows you P&L going up or down. That's in dollars most of the time. You can actually switch that so it shows it in ticks instead of dollars, or in percentages instead of dollars. So either way, I would suggest you switching it from dollars until you've mastered the mindset of detaching your trade from money, or detaching trading overall from money. This is a hard one, right? This is not a hard one. This is one I didn't realize, and I thought something was wrong with me when I started becoming profitable. I was so bored. Like, it was so boring. It became so boring to trade. Like, when I first started off trading, it was exciting. It was exuberating. It was so fun. I was so excited to come to the charts and trade because I was gambling. I was losing, but I had fun. But then you realize after a while that profitable trading is boring. And the reason that it's boring is because you're doing the same thing over and over again. You're risking the same amount every single day. You're coming to your charts at the same exact time. You're trading your exact setup the same way every single day. Like, it's just so repetitive, but that's what you need when it comes to trading. So the moment you start feeling bored while you're trading, that's when you know you're doing something right. If you're always excited and you're super eager to hop on the charts and you love trading with all of your heart and all of your soul and all of your mind, and it's the most fun thing ever, you're probably gambling, if we're being honest here. Principle number 4 is you need to have a structured trading routine. We just talked about this, but I just want to reiterate it because it is one of my 7 core principles. Wake up at the same time, have the same preparation before I get to the charts, have the same backtest warm up. I set the alerts the same way that I do every single day. The routine is what allows us to remove our decisions, removes our emotions, removes our thinking, because we honestly don't need to be thinking when it comes to trading outside of the rules that we have set in place. We should not be thinking, okay, what if this happens, but this doesn't happen? We should always have in plan what exactly we will do when each thing happens. So make sure you have a structured trading routine. That way you're not just haphazardly going about in your trading. You have to realize that losses are part of the game, man. It's I gave the analogy before about the coin flip. And no matter if your win rate is a 95, you're still going to lose 5% of the time. You can never know when that 5% is coming. It can come 5 times in a row, right? You'd be really unlucky, but it can come 5 times in a row. You need to accept the fact that losses are part of the game. If you see any trader online or any trader on social media or whatever saying that they never lose or they always win, they're lying to your face. And I think they might actually be calling you stupid, because every single person loses. And if they think that you don't believe that you believe them when they say they never lose, they're calling you stupid to your face, and you shouldn't allow that. Explain to them that losses are part of the game, and this is a real thing that happens. We all lose. None of us are going to win all the time. The issue is, or the plan is that our losses should not break us. We should be able to take losses and it not affect us mentally, not affect our account balances to the point where we can't trade anymore or we blow accounts when we lose. We should be we should have losses that are very, very manageable. Principle number 6 is backtesting is essential. Confidence comes from data, not feelings. Confidence comes from doing it and seeing it multiple times. It comes from repetition, meaning doing it over and over again. You have to put the time into backtest. If you can put in an hour a day, you'll see how drastic the change will be in the way you feel when you are trading in the live markets. You'll gain so much more confidence. Your trading will be much more smooth because you have done it so many times. Just make sure you're prioritizing backtesting. And then principle number 7 is to get a mentor or a community. I've mentioned so many times throughout this video to share this video with a friend or family or a group chat or something like that, because it's very hard to trade by yourself. It's doable. I did it. I mean, I had mentors. I paid for basically every single trading course out there when I first started off trading. That was really the only time when trading didn't feel like super stressful, is when I had other people to talk to. And then also having a mentor. I never really said I had like one specific mentor. I learned from so many different people. But if I had somebody who I just loved their trading style, who I loved the way they explained things, if I understood exactly what they were saying and I completely vibed with that person, and I had that type of mentor, that would have been so easy for me to get to the point that I'm at now much quicker. And that's honestly exactly why I built my inner circle. I've talked so many times about my inner circle. You guys see exactly what comes in the inner circle. We have live trades, meaning you get to trade live with us every single day, Monday through Friday. We send out every single trade we take, so you guys can take them with us. There's multiple coaches inside the inner circle, so even when I'm not available, you're still getting your questions answered. And a lot of them also have their own super amazing strategies and things like that. We have our dedicated trading psychologists, which I will continue to repeat all throughout this video, that the mental part of trading is the hardest part and the part you really need to master. You also get the full content library, meaning so much more content that I couldn't fit into this 10-hour video, and much more deeper things, a lot of live streams, a lot of little masterminds that we have done. We also get one-on-one trade reviews. So you send your trades in, we give you critiques on what you could have done better, what you might have missed, what you should do next time to improve and things like that. We're just trying to give you everything essentially that you would need to become the best trader possible. Then obviously you get access to that community. I'm going to be 100% honest with you guys. My inner circle community is like amazing. We're honestly a family. The live calls are so fun. They're so entertaining. They're so informative. I love doing the live calls. I love talking to everybody in there. We really treat each other like family. We have inside jokes. The culture is amazing. I don't know. I'm just speaking from my heart right now. I love the inner circle community. So if you're one of them and you're watching this video, I appreciate y'all. You guys are absolutely amazing. Yeah, but that's what you get inside of the inner circle. So it's, I've said so many times, it's super limited. It's really only for serious traders. If you're just trying to make a few $100 or like $1,000 or $2,000 a month or something, it might not be for you, if I'm being honest. This video is more than enough to get you to that point. But if you're trying to scale past that and really see expedited results, the inner circle might be something that would benefit. Well, it definitely will be something that'll benefit you. But here's my 7 core principles. Again, take this, print it out, put it on your wall as a poster. I don't know, tat it on your left hand. I don't know at this point. But just a quick recap: follow your strategy, not your emotions. Detach from money. Remember that profitable strategy is boring. Make sure you have a structured trading routine. Understand that losses are part of the game. You have to back test. It is very essential. And then get a mentor or join a community, or do both. That would actually be ideal if you did both. It'll help you out so much in your trading journey. All right, so I mentioned at the very beginning that trading can be extremely lonely, and that's the 100% honest truth. So one more time, take 7 seconds right now to send this video to a family or a friend or whoever it is that you're trying to lock in on this journey with. I promise you it'll be so much easier to hold each other accountable, wake up early, back test together, and honestly, you're just going to appreciate having somebody else that you can relate to during your trading journey. Now, if you want to get more personalized one-on-one help from me to guide you through every single thing that we went over in this multiple hours of content, no matter if you're a complete beginner or you've already started trading, click the link inside the description of this video to have the opportunity to join my inner circle. That's where I'll be able to work hands-on with you to get you to the point that you want to get to
as soon as possible. I've poured every single bit of information I have into this full course, and I truly look forward to all the amazing testimonials and messages that I'm going to get from people just like you telling me how this video completely changed their life. This isn't just about learning a new skill. It's about setting yourself and your entire family free. It's about having financial freedom, the location freedom, the time freedom to finally live the life that you've always dreamed of, the life that you honestly deserve. So I'm so grateful that you entrusted your time with me today to learn this insanely valuable skill. I'm excited for you to start this journey, and I genuinely look forward to the day that you drive past me in that freaking Lamborghini because you stayed disciplined and you reached your goals. Lamborghini, or I don't know, a classic Maybach, or I don't know, anything that you want. Now, real quick before you go, you have the strategies, you've got the routine, you've got the psychology, you've got everything you need. But the truth is, even the best strategies in the world won't change your life if you're only trading with a couple $100 of your own. The only reason that this whole system will actually be able to work at scale is if you have capital to actually back it up. And the easiest way to get the capital without risking your savings or your rent money is to use other people's money, just like we talked about inside this video. I made this video right here where I'll show you personally how I trade prop firms and how I scale using prop firms in my trading so I don't have to risk my own money. I'll see you there. Let's make this year the best one that you've ever had, and let's continue to milk these markets. God bless.